Bank audit, again, a interesting topic. Yes, it's little lengthy. We have divided it in 6 parts. There are introductory matters, then some investment related things, advances related things, capital and liabilities, concurrent audit, reporting and related things, and so on. What we are going to do, we are going to start with advances. So we are going to cover this portion first, and then we are going to go to the other portion, because I think this is little the first portion is little interesting, and more questions can be asked from there, but it doesn't mean that you leave the second part completely. You have to study that also. In this particular chapter, they'll be giving you more and more information about how banks operate, how they work, and also about more information about the financial items which are related to the bank, so that when you go in practical world, you are you can plan and perform audit comfortably. It's more information about how bank operates and what kind of financial items they have. Let's see, guys, one by one. Let's start with advances. The first question is audit of advances. We need to first explain that advances is a major part of bank's activity. It is a major part of the assets of the bank. When it comes to definitely when it comes to the proportion or volume, the biggest contributor to the assets of the bank's balance sheet is advances, and there are huge number of loans, large number of loans, lakhs and crores of loans are there, and there's a lot of variety also. So value wise, it is big. Number of transaction wise, it is big, and variety wise also it is big. It's a huge area. Advances in practical life, most of the time goes in doing audit of advances. Now we know that first we go for evaluation of internal controls, and that is nothing but test of controls. On the same lines, we have to go for test of controls. This is the latest material in the module. So let's understand step by step. The first thing is that every bank need to have their loan policy. RBI says that it's mandatory that banks frame their loan policy. They should clearly specify what kind of loans bank can give, and what are the maximum amount of loans they can give. What is the percentage allocation? What kind of loans they want to give more? Also, there should be hint about terms and condition. What can be the maximum tenure? What should be the minimum security? What should be the margin? Everything is decide. All these important decisions are taken and framed into a loan policy approved by board of directors. And this is a very important document which guides committees, branch managers across the bank for giving loan. So as a part of internal control, you should first see whether bank has framed a very good loan policy. Very good loan policy, that's a very important thing. Number one. Next, are they having very good internal control system for credit appraisal? They take all the income documents, salary slips, or P&L statements of past P&L statement, future P&L statements, ITRs, and asset details, asset records, everything, with the help of which they find out credit worthiness. Should we give loan to this particular person? Credit worthiness, or we say credit appraisal. So all with loan application, all these documents should come. Officers, you should see whether there is proper internal control system which ensure all important documents are taken for credit worthiness, whether they are properly evaluated, punched in a software, and software tells about the credit worthiness, whether loan should be given or not, and if loan should be given, what is the amount of loan which should be given. So there are proper system for credit appraisal, and if there is a credit worthiness, then proper proposal, loan proposal should be prepared. And next is it should get approved from proper authority. That's extremely important. So see, the first one is that you have a proper loan policy. Then you have good internal control system for credit worthiness, credit appraisal. Then there should be proper sanction. There should be proper sanction. There should be authority matrix that this amount of loan should be approved by this person, and so on. There should be proper authority matrix, and as per that matrix, sanction should be given. Once sanction is given, then bank should have systems to ensure that that security that proper security is obtained from the borrower. If it is immovable property, you will get the ownership documents. It's movable property, you may get again ownership documents. and you may sometimes get custody also. So where there's proper system to ensure that security exists, it is valuable, it is legally enforceable, and proper security documents are received. Once security documents are genuine, security is proper, then next loan document should be finalized. A proper agreement should be made. The proper agreement should be proper agreement. Agreement should be there, and all agreement and after agreement, all other procedures and documents should be properly prepared to support a loan. A proper bunch of documents should be there, and then finally, disbursal should be allowed and disbursal should be there. Then there should be proper system to ensure that money is used for proper purpose. So you will see that uh, employees of the bank, they go and check whether money is properly used or not, proper for proper purpose. Then ensure this proper accounting system. There should be a separate loan account. Loan account should be there. Periodically, interest should be charged. Then installment should be deducted. With proper accounting system should be there. Then periodically, say every quarter, you if a working capital loan is there, you will get stock statement, stock, debtors, creditors. On that basis, drawing power calculation. Drawing power. So in CC, cash credit facilities, OD facilities, initially a limit is calculated on the basis of financial health, past, present, historical data, past, present, and future. Sanction limit is calculated. Sanction limit, that is the maximum amount of exposure that can be given to this person. This is the maximum term loan, maximum CC limit, and so on. Then depending on present status of the current assets, because current assets are the primary security in CC, on that basis, on the basis of security and after deducting margin, what is the maximum amount of loan that can be given? That's called drawing power. What is computed initially is the sanction limit, and what is computed later on is a drawing power. So check whether there's a proper system which ensure documents are collected, drawing power is calculated, and the outstanding amount should not cross sanction limit as well as drawing limit, both. Then there should be proper system to review operations on regular basis, whether they are regular receipts and payments. Unusual withdrawals, payments will create doubt. Not getting money for a long time is going to get doubt. So there are proper software which reviews the operations, and something unusual happens, it gives the pop-up that something is wrong. Then whether prudential norms are followed for asset classification into standard performing assets and non-performing assets, and proper provision is made. And finally, there should be proper system for renewal of advances. So every year you have to renew your CC limit. There should be proper system for that. So there should be proper. So first there should be a policy. After policy there should be policy. Then when a person comes, there should be credit appraisal system. If credit appraisal is proper, then there should be proper sanctioning system. Then obtaining proper security and deducting margins. Then proper loan document should be there. Then after disbursal, end use of the money. Then proper accounting. After accounting, proper drawing power on quarterly basis, regular basis. Then ensuring, uh, then review of operations, prudential norms, and so on. Even if you remember out of these 11 points, if you remember 7 to 8, that will be good enough. But then try to remember it in a proper flow. If you remember in proper flow, you will retain for comparatively longer time. It will be easy to remember and recall also. Then next is substantive procedures. In that analytical procedures, you should compare loan amounts with the previous years. You should compute loan and ratios related to loan with the previous year and with others. That will be a very good source of information. Analytical procedures. See, so analytical procedures, and you can always use interest and corresponding interest and interest related ratios for this comparison. So after analytical procedures, then you go to test of details. Initially, what you can do, substantive procedures, initially you go and check the master data. So in substantive procedure, first you go for analytical procedures and interest related checking. Then you go for test of details. In test of details, you go for, first you check master data. Master data is data which generally doesn't change over a period of time, and it is used every time you perform a transaction, every time you give a loan or charge interest or you do a communication. Master data. So example of master data, so like borrower's master data. So name of the borrower, identity details of the borrower, PAN number, Aadhaar card number, address, then ITR details. So this master data is data which is going to remain same. So identity details, address details, past financial details, then amount of the loan, tenure of the loan, interest rate of the loan. So master data means data which generally doesn't change over a period of time, and it is very useful every time you perform the transaction. Every time you deal with borrower, master data will be useful. Every time you charge interest, every time you get the installment, master data will be useful. So in test of detail, first go and check the master data, whether that master data is appropriate. Then ensure whether system does tagging, whether system is tagging is done properly. Now, what do you mean by tagging? Tag, they're saying that all the loans of a particular customer should be tagged under one customer ID, so that manager knows at one click that what are the different types of loan which are outstanding from this customer, from this borrower. In this chapter, always think from the point of view of bank. Few times when you performing audit procedure, you think from the point of view of auditor. Few times. So first, go and check whether master data is accurate, properly maintained, whether all the loans of particular customers are tagged into one ID, so that at click of a button we know all the loans outstanding. Then you go for selection. Large and param is the shortcut. All the large advances, high value advances should be selected for test of details. When it comes to other advances, you go for random sampling and select them. Apart from large advances, param, P stand for, let's see, problem accounts. Problem accounts. All the problem accounts should be selected. Now, what do you mean by problem accounts? Problem accounts are all the accounts which are not yet NPA, but they are in SMA 1 and SMA 2 list. What is SMA 1? SMA 1 and SMA 2 list. See, SMA stand for special mention accounts. So problem accounts or special mention account, SMA, special mention account. SMA 1 means amount is overdue 31 to 60 days. SMA 2 amount is overdue 61 to 90 days. NPA is more than 90 days. So such problem account should be selected, because if there's a problem, there are chances that something is wrong in that account, more provision is required, or write-off is required, or there's some other issue. So large param, then A stand for adversely commented. All the accounts which are adversely commented. Adversely commented by whom? Adversely commented by RBI inspection team that you have not given this loan properly, or concurrent audit. The most powerful is RBI inspection team. Below that, concurrent auditors. A lot of different audits happen in bank. There's statutory audit, there is financial statement audit. Then there's an internal audit, full focus on internal control system. How good are systems? What are the deficiencies? How to improve it? And then simultaneous audit, concurrent audit. Simultaneous audit, as soon as transactions happen, simultaneously audit also happens. That's called concurrent audit. Concurrent audit, concurrent audits. And then we have revenue audits. In concurrent audit, important transactions are checked on simultaneous regular basis. And in revenue audit, so in some branches, concurrent audit is not conducted, revenue audit is conducted. Only go and check revenue transactions. That's it. So a lot of different audit. We'll study about them as we go ahead. So if RBI inspection team, or below that concurrent audit team, or below that bank's internal inspection team, if they have commented adversely, such account should be selected. Then restructuring. Whenever a borrower is not able to pay money, he comes to bank and says that, see, on the basis of estimates, loan was given, but business is not performing that well. I need more time and more money so that I survive, I grow and give back your money. Please understand my situation and give and reduce my load. That's called restructuring. That's called restructuring. His tenure will be increased, his EMI will be reduced, his interest rate will be dropped, he may be given additional money, his loan account will be converted into equity, more assets may be taken from him as a security. All these things will happen. It's called restructuring. So these things will be covered. Mortality accounts, that's very interesting. Accounts which slip into NPA within 12 months of sanction, that's called quick or early mortality cases. How bad is that? So when it comes to test of details, initially go and check master data and whether tagging is proper. Then selection, large balances, problematic accounts, adverse accounts. Then R is restructuring based accounts, and then mortality accounts. All of them should be selected. All of them should be selected for test of details. Apart from that, you should auditor should review. See, we are interested in accounts which need more provision, which need write off maybe. First, we perform test of controls, then we perform substantive procedures, then we review some important documents which affects recoverability. On quarterly basis, regular basis, you will be getting periodic statements, stock statements, debtor statement, creditor statement. Study them whether anything unusual decrease in the assets, unusual increase in the liability. Annual basis, you'll get latest audited financial statement, audit report. Study them. Once in few years, we'll get inspection of security. Study them. So all these reports will be very helpful in understanding the borrower's financial health and whether they will be able to repay things properly or not. Then presentation. So we went for test of controls, we went for substantive procedure. In that, we went for analytical procedures, test of details. We saw the recoverability. Presentation. Advances are presented in three types, depending on nature of advance, depending on security, and depending on place. These are the three ways they are presented. Let's understand. See, this is a real life example of HDFC Bank. It's an old report. So nature, depending on nature, very short term, bill purchased is a kind of loan given. Bill purchased, bill discounted is a loan, very short term. That comes first. Then CC, overdraft, loans, payment on demand, that is short term. That comes later. And then term loan is a long term loan that comes at the end. So very short term, and long term. This is classification depending on nature of the loans given. Then depending on security, that is secured by tangible assets. And RBI said that debtors, yes, debtors can come in tangible assets. Though debtor is simply a right to recover money. It is not something which you can see. You can see customer, but not the right to recover money. Debtors will be considered as a tangible asset because that is good quality debtors are as good or maybe sometimes better than the immovable property. RBI says that it's okay to include debtors in things secured by debtors as secured by tangible assets. So depending on security, secured by tangible assets, below that covered by government guarantee or bank guarantee, and below that unsecured. Then depending on place, or the advances given in India, how much you have given to priority sector, to public sector, to other banks. Most important is priority sector. Then public sector is government entities, government projects. Then banks, that is good. And then others, that is the biggest part actually. Outside India, how much loan you have taken, how much loan you have given to other banks, due from banks. Apart from banks, due from others, again, bill purchase, very short term, syndicated loans, others. So the same advances is broken in three types. If you see, that balance is going to be same, whether it is nature, whether it is security, or place, is going to be same. Okay, totally same. 465, 460, 464, 464. Okay, this total is going to remain same. Okay. The total of in India and outside India. So the same advance is broken into three types: nature, security, and place. Now, this is something very interesting. We have studied this in Inter. So NPA norms. When will you say that a particular loan has become non-performing? The shortcut is TCABS. Account has become non-performing. T for term loans. As I said, think from the point of view of bank. If bank has given term loans, then that in that term loan, they are going to get monthly or quarterly basis installments. What RBI says, if bank has given term loans and on due date, if you don't get money, next day it will become overdue. If any installment amount, whether it is having principal or interest, irrespective of that, if any amount remains overdue for more than 90 days, more than 90 days, so on 91st day, we will call that this loan, we are not getting money, and it has been more than 90 days, it will be declared as NP. Accounts team will declare it as a NPA and make a provision on that. C stand for cash credit and OD. So businessmen, they need lot of money for the business. They have to purchase material, they have to pay salaries, they have to pay electricity charges. They always need money, and whenever they get money from their customers, they get back their money. So they keep getting the money. So there's a CC limit, cash credit and overdraft limit, in which they can withdraw money whenever they want, and they can deposit money whenever they get from the customers. So for business requirements, there's a facility where you can withdraw money anytime you want, and you deposit money whenever you get it back. In this kind of facility, there is a maximum limit. As I said initially, looking at the financial health, a sanctioned limit is computed, and depending on what is the present status of the current assets, that is the security, drawing limit is computed. And generally, generally speaking, none of the limits should be crossed. Now, the problem with this CC and OD is there is no due date. Whenever they get money, they give it to us. So they have developed a new concept. There is no due date. So when will you call this particular facility NPA? Developed a new concept. They say that there's a concept of out of order. So whenever CC or OD becomes out of order, it will be called as NPA. Now, when will it become out of order? If amount outstanding in CC or OD crosses the limit. Generally, it should not cross, but it may happen. Why? Suppose limit was 10 crores and the person withdrew only 9 crores 90 lakhs. But then, because of the interest entries, outstanding amount has crossed 10 crores. It may happen that because of interest, amount crosses the limit. Or it may happen that because of some request, genuine request, that please approve this check. I am crossing the limit only by 1 or 2 lakhs. This is extremely important for me, please do it. Manager may agree. If outstanding amount crosses the limit because of any reason, because of interest or overpayment, whatever it is, and it remains like that continuously for 90 days or more, it remains like that for 90 days or more. Ideally, if a limit is crossed, as soon as possible, amount should be paid and outstanding amount should go below the limit. But if there is a breach of limit and it is continuing for 90 days or more, it will become out of order and NPA. If amount outstanding is within limit, but there are no credits, when borrower deposits money, when you think from the point of view of bank, if borrower gives money, will pass entry cash account debit to loan account credit. There are no credits. That means he has not paid any money for past 90 days. Not a single rupee was given in past 90 days. That's a bad sign. It will be called out of order and NPA. If there are credits, but they're not sufficient even to cover the debits of the interest, you have paid 50,000 rupees, but interest of that period itself is 2 lakh rupees. The payment you have made is not sufficient even to cover the debits of the interest. That bad is the situation. It will be called out of order, it will become NPA. So out of account will become out of order. There are two situations. Limit is crossed for continuously 90 days, or it's within the limits but no credits, or no or not sufficient to cover debits for continuously 90 days. Then we have concept of credit card. Then we have concept of credit card. Now credit card is again very interesting. See, term loan was very simple. There's a due date, next date will become overdue for more than 90 days NPA. For CC and OD, they came up with the concept of out of order. So if it's crossing the limit, there is one criteria. If it's not crossing the limits, is one criteria. Now in credit card, see what happens in credit card. It is a credit card statement. There will be a statement date. All the payments done till that particular date will be included in the statement. Okay, and that statement will give you total amount due. Now in credit card also, there is no installment amount. So every statement will have minimum amount due. That's like installment. This is the minimum amount you should pay on the due date. They will specify the due date also. Some credit card some banks will give 20 days time. Now here 20 days time is given. Statement date is 7th and payment date is 27th. Some will give 20 days time, some will give 25 days time, and so on. So that keeps changing. The amount of time given keeps changing. So minimum amount due you should be paid, not the total amount, minimum amount, so that on rest of the amount they can charge interest and earn money. Okay. Now what RBI says that if the credit card holder has not paying minimum amount due within 90 days from the next statement date, that's very interesting. Next statement date, they are not counting 90 days from the due date, because in the industry some people give 20 days, some people give 25 days. There's no consistency. So they have said that let's make it consistent. Let's make it within 90 days from the next statement date. So whatever is the next statement date, if within 90 days payment is not done, if within 90 days payment is not done, it will be this credit card holder, this credit card will be declared as NPA and provision will be made. RBI says there are few condition. Gap between two statement dates should not be more than 1 month. Generally, it is not. So due date is important to have a overdue status, but it is not important for NPA. After 90 days, inform credit information companies and levy penal charges also as you feel appropriate. So this is simple guidance. What is credit information company? So in India now we have a company which collect data of all the defaulters. So all the banks and financial institutions, everyone, they send the data of defaulters to this company. So there is a database of defaulters. There's a database of borrowers who have defaulted money. So anytime a bank is thinking of giving a loan, they will go and check this database. Oh, he's a defaulter. Let's not give loan to him. To discourage defaulters, to expose defaulters, there's a very simple concept of credit information company. Simply you give data to them and they will maintain the database. In fact, they compute the CIBIL score, very famous CIBIL score, credit information company. Okay. So once 90, it's not paid within 90 days from the next statement date, you can give information to credit information company and level penal charges. E-cabs, agriculture loan. In India, agriculture is extremely important, so they are considerate about it. If an agriculture loan is given, you go and see what kind of crop is there. Crop can be divided in two parts: long duration crop and short duration crop. If a crop takes longer than 1 year for sowing the seeds, for time to grow, that plants will grow, and then the harvesting and selling, the complete process, if crop is taking more than 1 year from sowing till harvesting and getting money, if it's getting more than 1 year, it's a long duration crop. And if it is less than 1 year, it's a short duration crop. So what they say, suppose a bank has given agriculture loan, and suppose long duration crop, loan for long duration crop, loan, loan will be given, they will be given time to sow the seeds, then to do the nurturing part of the trees and plants, and to harvest and sell and get the money. They will give you due date. Banks will give, in agriculture loan, they will give a due date that after harvesting on this date you pay us money. If money is not paid on that date, on due date, RBI says that wait for one more crop season after due date. If so, it's very simple. In case of agriculture loan, if it is a long duration crop, if on due date you don't get money, after due date, wait for one more season. Wait for one more season. You wait for one more season. You wait for one more season, and if you still don't get money, declare it as NPA. Declare it as NPA. Okay. Then next, we have short duration crop. In short duration crop, if when you give loan, again you give them due date. If on due date money is not paid, after due date wait for two crop season. Wait for two crop seasons. I'm not going in a lot of detail because it's not expected. After due date, wait for one crop season. If money is not paid, again wait for one more crop season, two crop season. and still if you don't get money, then declare it as an NPA. Now there's a state level banking committee which decide when the which crop will be short, long duration, which will be short duration, when season starts, when is the time to nurture the plants, when is the time to harvest the plant, what should be the due dates, etc. Everything state level banking committee decides. Okay, but in general, I am saying that after due date, one crop season means you will be getting almost 1 to 1.5 year. After due date, 1 to 1.5 year, that's what you are going to get in long duration crop. In short duration crop, after due date, you have to wait for same season next year. Same season next year. So, for example, original loan was given in June, and you are not getting make money by December. That was the due date. Next year, one more same season next year. So you are getting after due date, you are getting almost a year. Almost a year after due date, almost a year, because you have to wait for same season next year, and you don't get money again, wait for same season next year. So almost 2 years. In long duration crop, after due date you get almost 1 to 1.5 years. In short duration crop, after due date you almost get 2 years. Account will not be declared as NPA, and if this time is lapsed, money is not received, then it will be declared as NPA. This is only for direct agriculture loans. If you're given loan to some bank and financial institution, they are giving agriculture loan, they are not covered here. It is only and only for direct agriculture loans covered in master circular on priority lending sector. It is not applicable to you are given money to some banks and financial institution and they are giving it to agriculture. No, 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 that is not covered here. There is one more way of giving money, short term money, bill purchase and discount. When you buy a bill of exchange, you are ultimately financing, you are giving a short term finance. You are giving a short term finance, 3 month, 4 month finance. Okay. And if amount remains overdue unpaid for a period of more than 90 days, on due date you should get money. If it remains overdue for more than 90 days, it will become NPA. These charts beautifully cover everything. No need to study anything else. No need to study text. Then exceptions and clarifications of NPA. Exceptions and clarifications of NPA. Very simple, straightforward. Now guys, let's see. So NPA norms are there, and then they further explain that when you go in practical life, a lot of questions will arise. So they answered those questions. Okay. Suppose ICICI, so we have a small story for this. Suppose ICICI Bank gives multiple loans to Mukesh Ambani, 10 crores, 10 crores, 100 crores, 1000 crore, 10,000 crore. 4 loans are given, and Mukesh Bhai forgets to pay only one loan of 10 crores on time. Rest of the loans are paid on time. What will happen? Whether that only one loan of 10 crores, whether that will become NPA, or all the 4 loans will become NPA. Okay. Only one loan, all the 4 loans. And the answer is, if there's default in one loan, that loan will definitely become NPA. Rest of the loans will also become NPA. Yes, if one loan of a borrower, think from the bank's point of view. In case of bank, if multiple loans are given to a borrower, if one loan becomes NPA, rest of the loans will also become NPA. Betrayal is betrayal. Once you are betraying, all the loans will be treated as NPA. Then in investments, suppose there are multiple investments. Along with loan, we have invested money in debentures and bonds also, multiple debentures and bonds. In investment, we have same concept. If money is overdue more than 90 days, in case of debentures or bonds, it will become NPI, non-performing investment. Now what they're saying, final thing, if you have made multiple loans or multiple investments, and if any of the loan or any of the investment become NPA or NPI, all the loans and all the investments will become NPA and NPI. So if there is a single default, think from the bank's point of view, if there is a single default by the borrower, all its accounts will become NPA. We are talking about one bank. Each and every bank will have to think from their point of view, because they don't have data of the other banks. They have their data of only their bank. All the banks have their own data. So they have to think from their own point of view. If multiple things are there, Even a single thing is going to make everything NPA. Then next, Mukesh Bhai, the next example, Mukesh Bhai gives Antilla. Guys, in some of your books, this chart may not be there, so you will have to note it down, jot it down, maybe. Uh, Now, let's understand. Mukesh Bhai takes loan of 10,000 crores and gives home worth 10,000 crore. Will this loan ever become NPA? Yes. Security cannot protect you from NPA. Security cannot protect you from NPA. Even secured loans become NPA. If you are so proud of your security, sell it off, recover the money, finish up the loan, automatically you will be out of the NPA. Security value cannot protect you from NPA. In fact, suppose there are potential threats of recovery. Suppose businesses of Reliance are not performing well. Suppose I'm saying there are potential threats of recovery. There are some indication which are suggesting that it will be difficult for Reliance to repay their debts. Suppose I'm saying, suppose. Okay, I don't wish or intend something like this for a monies. Okay. And at the same time, value of the security is getting eroded. It is getting reduced. For example, sea level is increasing and Antilla is in front of the sea. And suppose water has started flowing in Antilla. Home which was worth 10,000 crores suddenly reduced to 4,500 crores. If there are potential threats of the recovery and at the same time, second thing is happening, value of the security is falling and it has fallen more than 50%. It has fallen more than 50%. More than 50%. Then guys, then there are classifications of non-performing asset. That account will be directly transferred straight away called doubtful asset. Will serve. In Inter, you must have studied about this classification, but still, I will tell you those classification also. And suppose value of the security has reduced so much, it has gone down to 800 crores, that even 10% of the loan amount cannot be recovered with the help of that security. Not even 10% not even 10% can get recovered. If this is the case, it will be directly transferred to the loss asset category. See, these are the categories. Look at the left side, due date. Till due date, asset is performing asset. After due date, performing asset. Till 90 days, it will be performing asset or standard asset. Till the time overdue thing reaches 90 days, it will be performing asset, standard asset. After 90 days, it will become NPA. It will become NPA, non-performing asset. Okay, non-performing asset. Now, if money is not recovered within 1 year, it will remain in substandard. In NPA, you have first category, substandard. So, loan will remain in substandard category for 1 year. If 1 year has elapsed and you are still not recovering money, you go to second category and that is doubtful. In doubtful, there are three subcategories: doubtful for 1 to 3 years, or doubtful for 1 year, 1 to 3 years, and more than 3 years. So from substandard, it will go to doubtful. In doubtful, it will go to up to 1 year. If money is not recovered within 1 year of doubtful, it will go to doubtful for 1 to 3 years. If it is not recovered within those 2 years, it will go for more than 3 years. So there is substandard, below that doubtful. In doubtful, you have up to 1, 1 to 3, more than 3. And suppose in the market, people are saying that everything is over. He has declared himself that I don't have anything to pay. I don't have any asset. I will not be paying anything. He has declared himself. Market knows about it. Now no recovery is possible. Why to wait for 90 days or 1 year or doubtful for 1, 1 to 3, more than 3? Directly you declare it as a loss asset. So if the value of security falls more than 50%, you will not go to substandard category, you directly go to doubtful category. And if the fall is so much that even 10% of the loan cannot be recovered, you will directly go to the loss asset. Okay. So counting from due date, we count 90 days. From 90 days, we count 1 year. And from 1 year, because it is the same doubtful category, from 1 year, we count next 1 year. And then from that 1 year only, we count 3 years. because category is same, doubtful only. These are the provisions we need to make. If it is secured loan, 15, 25, 40, 100, 15, 25, 40, 100. This is the amount of provision we need to maintain, not make. So if it is fully secured loan, you have all the assets backing the loan, still you are supposed to make provision of 15, maintain 15%, doubtful 25%, 40%, 100%, and so on. If it's an unsecured loan, as soon as it becomes unsecured, 25% and touches doubtful, 100% provision need to be maintained. You can stop the video if you want to. It's very simple. You have studied this in Inter. Still you want to record, you can stop and write it. Then taking the story ahead. So taking story ahead, story was simple, straightforward, that now if so first was the story of multiple loans, ICICI Bank, multiple loans, then Antilla, property cannot protect you, but it can definitely push you to the lower levels of NPA. Then he has taken loan for consortium loan. When multiple banks, two or more banks together give loan to any person, that's called consortium loan. Multiple banks together. The bank which gives highest amount of loan is called lead bank. And this lead bank is going to do all the administrative work. That is coordination with the other banks, making the documents, collecting money and giving the money as loan, recovering the installment and distributing it amongst all the banks. This administrative work will be done by the lead bank. And other banks are called participating banks. Now, suppose consortium loan is given to Mukesh Bhai. Okay. SBI is the lead bank, supposed to get money and divide it to everyone else. SBI is getting its money on regular basis. There's one more bank, Punjab National Bank, is getting money on regular basis. But Bank of Baroda is not getting money on regular basis. What will happen? TTMM, that's a Hindi actually. Tera tu mera main. That means everyone is going to see their own books. Everyone is going to see their own books. Yes, that's extremely important, very important. You have to see your own books. Okay. If you are getting money, it's a performing asset. If you're not getting money, it's non-performing asset. SBI need to see its own book. They are getting money on regular basis, performing. Punjab National getting performing. Bank of Baroda is not getting non-performing. Everyone is going to see their own books, whether they are getting regular recovery. There's one more word for recovery, that's called servicing. If people are paying their loans on time, it's called servicing. That uh, things that servicing is happening properly. Loans are getting serviced. So if there is a consortium, there's a lead bank, then others are participating banks, and everyone is going to see their own books. Participating bank will always keep following up with the lead bank. Please give our money, because you give us money. If there is a recovery, we will not declare it as an NPA. We don't have to make the provision. Sometimes participating bank will get the letter that yes, we have received your money, and there's some procedural issues. You will get money in 3-4 days, and in 3-4 days time you get the money. You get express consent that your money is with us and you will be getting it within few days from that date, and you get also this case. But 90 days are getting over within that period, we will not treat it as NPA, because there's an express consent letter from the bank that we have received your money, it is with us, we'll transfer it to you soon. It is happening also. So sometimes if there is a consent and subsequent recovery, it can save bank from NPA. So let's freeze the concept. If it's a consortium, multiple banks are there, everyone is going to look into their own books for NPA. Okay. But if at the end there is a consent and subsequent recovery, then that can protect the bank from NPA. Now, when you give loan, again think from the bank, when you give loan, many times there are obligation on the borrower that they have to submit some documents or do some procedural requirement. Let's understand. If bank is giving working capital loan, then current assets are the primary security. Stock, debtor is the most important primary security. and every quarter, every 3 months, they have to give data of stock, debtors, creditors, etc. And on that basis, drawing power is calculated. Now, the day loan was sanctioned, given, on that day we received complete statement. But then 3 months have passed. Now again statement was required. Statement is not received. What RBI says, if you have given working capital loan on the basis of securities as the asset, working capital current assets as the security, if you are not getting stock statement regularly, stock statement with you is older than 3 months, account will become irregular. Account will become irregular. And if such things continues for 90 days, then that account will be called NPA. Yes, that's very unique. Even in the case of erosion in value of security, and here also, even in case of erosion in value of security, erosion erosion in value of security. Okay, even if you are getting money on regular basis, still you will be declared NPA as per RBI norms. Here also, even if you're getting money on regular basis, but if stock statement is older than 3 months, irregular, it continues for 90 days, NPA, even if you're getting money on regular basis. So sometimes because of lack of documents and lack of procedural requirements, account can be declared as NPA. Now in CCOD, again, every year you need to renew that limit. So every year borrower needs to come, submit fresh documents, fresh application, fresh document. It will be reviewed and his limit will be renewed for 1 more year. Now, CCOD is due for renewal and it has been 180 days, renewal is not done, it will be declared NPA. If renewal procedures are not done with 180 days, 180 days from the due date, the date on which renewal should be done, it will be called NPA. Ad hoc credit. Ad hoc means temporary. Temporary. Ad hoc means temporary credit. Okay. Uh, it is temporary. It is going to get over. Sudden temporary credit. So borrower comes and says that, manager, you know that my 100 crore loan is sanctioned, but it will take time that I get that money. I want 5 crore rupees for a week. Can you please give me that money? Manager says, okay, take this 5 crore. Now it was responsibility of the borrower, if he has taken ad hoc, sudden, temporary credit loan, that repay that loan. It was his responsibility to repay that loan within 180 days. Repay that loan within 180 days, or submit documents and convert that ad hoc credit into a regular CC or OD limit. But none of the things are done. It will become NPA. See, in temporary deficiency, stock statement not submitted 3 plus 3 months, then 90 days, NPA. Renewal is not within 180 days, NPA. Ad hoc credit is not repaid and it's not converted to regular limit within 180 days, it will become NPA. There are 3 examples. Then Mukesh Bhai has taken loan for agriculture. And at the same time, natural calamities happen. Whenever agriculture loans are given and natural calamities happen, banks, they do reschedulements, renewals. They convert short-term loan to long-term loan. They change the tenure, they reschedule things, they renew things, and so on. In this case, RBI says that when it comes to NPA, you don't look at the old due dates. You look at the due dates after reschedulement. Those due dates will be taken for NPA purpose. So these are the clarifications and exceptions. Now next is saviors. Regularization. What do you mean by regularization? If borrower comes and pays all the overdue amount, if he comes and pays all the overdue amount, that means no amount is now overdue, then he has regularized, he has corrected, rectified his position, his account, then this loan will be again considered as performing asset. It should not be NPA, it will be considered as performing asset. If there is a regularization, then that account will become performing asset, no doubt about it. But if after analyzing you observed that there were only few credits at the end and money subsequently withdrawn, some 50 lakhs were deposited and within few days it is withdrawn, or you find that bank has given a new loan to the borrower so that he can repay the old loan, repay outstanding of the old loan. If you see that there are few credits at the end, the subsequent withdrawal or new loan was the source of money, it shows that borrower is financially weak. There is an inherent weakness, financial weakness in the borrower. We lose all the faith. Even if the amount is paid, that account will be declared as NPA and rest of the accounts will be also declared as NPA. It will be deemed as NPA. If there's an inherent weakness, it will be deemed as NPA. Now, can government guarantee save account from NPA? If there is a central government guarantee, that account will never become NPA, never ever will become NPA. But if guarantee is revoked, if guarantee is invoked, that is, we ask for money from the government and they said no, they repudiate, they say no, then this protection will go away. If there is a central government guarantee, this loan will never be declared as NPA, no need to make provision on this. But if after asking for money, invoking the guarantee, if they repudiates, they say no to the payment, this protection will go away. If state government will give guarantee, there will be no protection from NPA, no exemption from NPA. Then we have lovely super 5 securities, financial instrument. If you are giving loan on the base of term deposit, FD receipt, you can give loan only on the base of FD of your own bank, only your own bank, no other bank. That is not allowed. If you are giving loan on the base of term deposit, very safe, or below that NSC, National Savings Certificate, or below that KVP, Kisan Vikas Patra, or below that IVP, Indira Vikas Patra, or below that LIP, Life Insurance Policy. If you are giving money on the base of these 5 securities, these will not be treated as NPA. These will not be treated as NPA. Yes, they will be never treated as NPA. Never treated as NPA. If you're giving loan on the base of term deposit or NSC, KVP, that is the faith RBI has on these 5 securities. Then staff loan. See, there's a very regular thing that banks give a lot of loan to their own staff. There are a lot of lucrative schemes for the employees so that they stay with bank for a long period of time. They will be getting a lot of loan at duration of the loan will be on higher side, interest rate will be on lower side, EMI will be extremely low, a lot of benefits are given. If loans are given by bank in capacity of an employer as per policy of employees, then this loan amount will be shown in balance sheet under the heading other assets, others. It will be shown in others. It will not be treated as a regular advance because it is not a regular business transaction. If employee leaves the job, then this loan will be transferred to regular advances. If if bank gives loan as a banker over and above the normal loans as a banker, then it will be shown in advances. If loan is given as an employer under the employee scheme, it will be shown in other assets, others. If it will be given as a banker, it will be shown in advances. Now, sometimes the terms are such that a loan of 40 lakhs is given. Loan of 40 lakhs is given, and for first 4 years, 10 lakh rupees installment will be given to bank. It will be treated as principal recovery. And once principal is repaid, later on you will get money. Later on you will get money, and later on you will get money, and that money will be that will be interest. So for 4 years, bank is not getting any interest. They are getting interest after 4 years. RBI said that in staff loans, terms and condition can be different. In that there can be a lot of things. Principal recovery is first and interest payment later, so that it becomes very useful and beneficial for employees. Such things can happen. It is absolutely fine. Till the time payment is done as per due dates given in the agreement, due date given in terms and conditions, it will not be treated as NPA. It will not be treated as NPA. It is absolutely fine. Now, after these NPA norms, its clarification, let's go and see what RBI says. What RBI says about income recognition. So RBI has issued a circular and it talks about accounting treatment and presentation of different incomes. As the auditor, we should be aware about it because its non-compliance is going to affect true and fair view. Let's see. So the shortcut is rating revenue of PM and CM. R is for reversal. So RBI says that there can be 4 types of reversals. Number 1, as any advance become NPA, accrued income over that advance over NPA accounts should be reversed. Accrued income should be reversed, and after that, all the interest income on such NPA account should be booked only on cash basis. Only on cash basis. And this concept is applicable even to the advances which are guaranteed by the government, central government. Yes, that's very interesting. If advance is guaranteed by central government, then it will not become NPA. You don't have to make provision for NPA. That's correct. So guarantee can save you from provision for NPA. But guarantee cannot save you in revenue recognition. In government guaranteed accounts also, concept is same. If you are getting interest on regular basis, you follow accrual. Else, you reverse accrued income and shift on cash basis. So when it comes to revenue recognition, same rule is applicable to government guaranteed advances also. The final statement is government guarantee can protect you from provision for NPA. It cannot protect you from strict revenue recognition norms. Reversal of other income. That's interesting. As soon as any borrower's account become NPA, we reverse accrued interest and shift on cash basis. On same line, fees, commission coming from the same borrower should not be booked on accrual basis. It should be booked on cash basis, on realization basis. Then it may happen that because of wrong interest rate or some clerical errors, wrong interest income is recognized. Maybe the amount is wrong, accounting is wrong, whatever. Whenever bank come across such mistakes, it should be reversed. It should be reversed because it's a wrong income. If we come across that some accounts became NP and we forgot to reverse it. That time we should reverse it immediately. Or if required, you can make a provision for that. Ultimately, the effect will be same. Then sometimes borrower is going to send a letter to you and point out what mistake bank has done in calculating interest or charging interest, and his letter communication may be justified. In that case, you should accept where bank has gone wrong and again reverse. There are 4 types of reversal: reversal of the interest income, reversal of the other incomes, reversal when the wrong entry is being detected, and reversal on communication of borrower. Generally, all these reversals are of heavy amount, of big amount, and auditor should be careful about them. After that, we have allocation of bill discounted purchased. We all know that it's very simple. When it's a very simple entry, when any bank purchases bill, when they buy bill, we are getting the bill purchase account debit 100, to customer or cash account 90, and 10 rupees is discount income. So in this transaction, we are giving 90 rupees, bank is giving 90 rupees, and after a few months they are going to get back 100 rupees. That means they are getting 10 rupees as income. Now this is an interest income. When any bank purchases bill, they are giving short-term loan, and discount income is like a interest income for 3 months, 4 months, whatever is the tenure of the bill. Now, sometimes it may happen that bills are outstanding as on 31st of March. Part of the tenure goes to next year. If part of the tenure goes to next year, then corresponding interest income should also be allocated to next year. In that case, we transfer such income to rebate on bill discounted. For example, in this case, suppose this bill which is purchased is of 4 months. That means per month income is 2.5, and we came to know that 1 month belongs to next year. So 2.5 should be transferred from the income account to rebate on bill discounted. It will become income in the next year. Correct? So that's what they're saying, that it may happen when bills are purchased, some bills are outstanding as at year end. Then in that case, part of the tenure belongs to next year. Unexpired discount, rebate on bill discounted should be transfer, should be transfer, should be transferred to rebate on bill discounted. Now, so that it becomes interest income of the next year. Now, carefully, this rebate on bill discounted should be shown in other liabilities. See, it's a closing balance, it's a credit balance. You're transferring an income, it's a credit balance. This credit balance should be shown in other liabilities in balance sheet. And next year, it will automatically see it's like advance income. Advance income. This income doesn't belong to this year, this belong to next year. So transfer to rebate, and now we were not getting any heading where to put it. So we record it, we put it in balance sheet in other liabilities. Actually, it's not a liability. We are not supposed to pay it to anyone, but we were not getting a proper heading, and this was the most appropriate heading amongst all. Now, very interesting. Suppose bill which we have purchased gets rediscounted. That means we purchased a bill of 100. Now, in between, we are in need of money. So, we can sell this bill to someone else. We can rediscount it. We can rediscount the bill. Rediscount the bill. If we are rediscounting the bill, we are selling the bill. It's like we are taking short term financing. Short term financing, and there will be a discount expense. When we buy the bill, it's a discount income. When we sell the bill, it is discount expense. Now, what they're saying that this expense should not be netted off with the discount income. You should show discount income separately and discount expense separately. Discount income is interest income, discount expense is interest expense. Why so? So that people get full information that okay, this is what you earned and this is what you are expensing out. Don't net it off. Otherwise, people will not realize what exactly is happening. That's very interesting. That if part of the income belongs to next year, you should allocate it properly to the next year. And if by any chance you rediscount the bill, then the discount expense should be shown separately. It should not be netted off with the discount income. Now, rating. See, T is missing here. T is missing here. T simply stands for test check. RBI says that it's not possible to check each and every accounting entry when it comes to revenue. It's absolutely fine if auditors use test check sample basis for checking. That's really great. As such, our standards have already said that we can use sampling. They're further clarifying about it. Great. Now, income, investment related income. See, generally, banks, when they invest money in bond, debentures, or shares. So, income from investment is going to include interest income over bonds, debentures, etc. And they are going to include dividend income on shares. Dividend income on shares. This is the most popular. This is This is the most popular investment income in bank. Now they're explaining that sometimes we have to make some adjustments. We have to make some adjustments to this particular investment income, and they're explaining three things. Let's see. First of all, dividend from subsidiaries and joint ventures. They're explaining very simple thing, that supposedly you are earning dividend from your subsidiaries and joint venture. Now they're saying nature of this income is different. Suppose you are earning dividend from some shares, you have invested money and you are earning some shares. Okay. Generally, dividend from shares, it's a passive income. You don't play a major role. That entity does the business, they earn money, and then they are giving you dividend. You don't play a major role. But when it comes to your subsidiaries, joint ventures, the group has played major role in creating them, in boosting their business, in making them profitable. It's an active income. You're getting this point? So, if this is a bank and they are getting dividend from companies and dividend from subsidiaries, joint venture, listen, there's a difference in nature. There is difference in nature when it comes to both types of dividends. There is a difference. There is a difference, and let's understand. And let's understand what is this difference. When you're earning money from companies, okay, it's a passive income. Bank has not done any very special role in operations. But when you are earning from subsidies, joint venture, it's not a passive income, it's an active income. Bank has played a major role in considering the whole idea, creating these entities and their business operations, etc. So the nature is different. So RBI says that when it comes to dividend from other companies, simply put it in the investment income, it's absolutely fine. But if you're earning it from subsidiary and joint venture, you segregate it. You remove it from the investment income and put it in other income, because it's not a passive income. The nature is it is an active income. Then next, broken paid interest. There's nothing but accrued interest. When you must have studied investment accounts, you must have studied that whenever we buy debentures, we pay for accrued interest. Whenever we sell debentures, we get money for accrued interest. Suppose we are buying a debenture where interest is paid 6 monthly, and we are buying debenture and we are paying interest for 2 months. We bought debenture in Feb end. We paid accrued interest of 2 months. Okay. On 30th of June, we'll be getting, because we are the owners of the debentures, we'll be getting interest income for the whole 6 months. We are paying for 2 months, we'll be getting for 6 months. Net, we are earning for 4 months. And that is the 4 months we kept debentures with ourselves. March, April, May, June. Very simple example. So what they're saying that whenever you buy, sell debentures, you will be paying for accrued interest. That is also called broken period interest. This interest expense is not a real this interest expense you are going to recover as such. So do one thing for better financial presentation. This expense should be netted off with the interest income. Netted off with the interest income. You paid for 2 months, you got for 6 months. Net you are earning for 4 months. That is the period for which you kept debentures with yourself. That will be true financial presentation. That you are earning interest for 4 months, the period for which you kept the period for which you kept bond debentures with yourself. So they are saying all the broken period interest should be netted off against the interest income for better presentation. So see, so depending on the situation, advice change. Dividend of subsidiaries and joint venture should be shown separately in other income for better presentation. Here, it should be netted off for better presentation. Then on the same lines, sometimes when we buy debentures and bonds, we pay premium. That means redemption value was 100, but we bought the debenture for 105. We pay extra. Why we pay extra? We pay extra because we must be earning more interest on these debentures than the market. So generally, banks pay premium on debentures or bonds when they are earning extra interest. So when you write it off this premium, amortize this premium, it should be adjusted with the interest income. It should be adjusted with the interest income. That will give you true interest earned from that security. True interest earned from that security, real interest earned from that security. For better presentation, it should be netted off. So the first point, they say that show separately. Second point, they're saying net of accrued interest, broken paid interest. Third point, they're again saying net of amortization of premium with the interest income. So they explain what will go in income from investment, and then they show three adjustments. Profit on sale of investment will not go to investment income, it will go to other income. On the same lines, investments in banks are revalued frequently. We'll get an idea of this when we study audit of investment. This revaluation profit loss should be again, it should go to other income. It can be targeted in MCQ. Where will profit on sale of investment will go? Where will profit on revaluation of investment will go? Okay. Now, NPA effect on different types of loan. NPA effect on different types of loan. Let's understand. Finance lease. If a bank has given finance lease, it's like a loan given. If bank has given finance lease, it's like a loan given. Okay, and we have to book interest income over such finance lease as per AS 19. Now, if you are not regularly getting installments, from these finance lease, then this account will also become NPA. We'll have to reverse accrued income and book interest income on cash basis. So the rule which are applicable to a normal loan will be applicable to loan given in the form of finance lease. Then it's wonderful. Super 5 securities. Suppose we know Super 5 securities. Our own term deposits, that is FD, National Saving Certificate, Kisan Vikas Patra, Indira Vikas Patra, and life insurance policy. Suppose loan given is 100 and the security which is there with us is 125. So we have extra security of 25. That's margin, of course. Banks always keep some extra security, and that extra is called margin because value of the security may fall and we may have to recover more money than the loan itself. So we always keep margin. RBI says that if you have obtained super 5 securities, these 5 as your security, and if you're having something extra, continue to book accrual basis of income even if they have turned NPA. Even if these loans have become NPA, continue to book interest income on accrual basis to the extent of margin. Till the time you have that cushion of 25, you continue accrual basis. Once that cushion is over, then you have to shift to the cash basis. That's wonderful. That is the faith RBI is having in these super 5 securities. To the extent of available margin, continue booking income on accrual basis only. What is takeout finance? It's a very interesting thing. Many times there are large infrastructure projects. Okay. Suppose there's an infrastructure project of some 5,000 crore. SBI came forward and they said that we will finance this project of 5,000 crore. They did the assessment, they understood the risk, they took the risk, they financed the project. Project took 3 years to get completed. It got completed. It started functioning, it started its operations, and now it is generating revenue and repayments of the loan have started. That's wonderful. Now, SBI wants to finance more such projects, but the money of 5,000 crore is stuck in this project. What can they do? So what they can do is they can invite other banks and financial institutions and tell them, listen, guys, I am having a loan of 5,000 crore. It's an asset. And now it is a low risk loan because you are getting income on regular basis. I want other banks and financial institution to take over this loan from me to you. Take over this loan. Take this loan, and now you become owner of the loan. You will get regular installments and income. You are getting a ready-made loan generating income. But yes, definitely I will charge some premium. I have taken the risk, I should get some benefit. So if the loan is of 5,000 crore, I will transfer it for 5,500 crore. I will earn 500 crore out of it. Such things happen, that loans are taken over, and the other entities are absolutely happy. They said, we are more than happy. See, SBI, you were earning, say, 15%. Now, after making this payment, we'll be earning 12%. But that's absolutely fine. Earning 12% with low risk is absolutely fine. We are happy with it. So many times in finance world, loans are taken over from one bank to another bank or another financial institutions, so that banks can free up their money and continue their banking activities. Now, what they're saying, so first they explain the meaning, the whole concept. Now, sometime it can happen that NPA loans are transferred. Yes, we are going to discuss about this later also. Sir, who will take NPA loans? People will take NPA loans because along with loan, they are going to get security to recover their money, and they will be getting loan at a cheaper rate, at low rate. So they may go for it. So many times it happens. So look at the situation now. There is a bank, they have given a loan. This loan has become NPA, and now this NPA loan is taken over by other bank or financial institution for whatever terms they want to. For the selling bank, it is a relief that NPA has gone out of their books of accounts. It's a great relief. RBI says that yes, it's a great relief to you that the NPA loans are going out of your books of accounts. Now it is their headache to recover the money, whatever they want to do. It's a positive news. But that doesn't mean that you book interest accrued or outstanding on this NPA account immediately because of this positivity. No. Even if the loan is taken over, pending interest, or any interest related to this account should not be booked on accrual basis. It should be booked on cash basis only. And this cash you may receive from the taking over bank or financial institution, or you may get it from the borrower, from wherever you get the money. But you should get money, it should be booked on cash base only. So again, the message is pretty clear that even in case of takeover, the interest income should be booked on cash basis only. You may get cash from taking over institution or the borrower, that doesn't matter. General points: as auditor, you should always see there should not be unrecorded income. No loan should be left out when we are charging interest income. No debenture bond should be left out when we are charging interest income. No share should be left out when we are booking dividend income. So none of the incomes should be unrecorded. So auditor should go and check completeness, go and check all the sources of revenue, whether all the revenues are booked or not. Okay. Now what about recorded income? What about recorded income? So first of all, no income should go unrecorded. Everything should be covered. Whatever income we are booking, it should belong to bank. There can be consortium financing. It should belong to bank. Okay, it should belong to bank. That's important. It should be at proper amount. It should be of bank and not someone else. It should be proper amount and proper period. Current year income should be booked in current year. Next year income should be booked in next year. What about restructuring? Many times people will come to us and say that loan was given on the basis of estimate that business will start working by so and so year, and will start earning money, cash, and will start repaying the loan. But sometimes it doesn't happen. So borrower comes and explains the whole situation. Bank assesses, is borrower genuine? Is his concerns genuine? Whether this complete story is genuine, and whether whether his business has a promising future. Is it having a real future? If they feel the story is genuine and the business has the future and he will be able to repay the loan in future, they may go for restructuring. They will go for restructuring. Increase the tenure, reduce the interest rate, reduce EMI, convert loan to equity, and so on. Restructuring will happen. But then again, an additional money will be given. When it comes to restructuring, bank is again taking risk. So they will charge fees or commission for this. So whenever people come for restructuring, they are going to charge fees and commission. RBI says that don't book this income on immediate basis. It won't be wise. Already this account is showing weaknesses, financial weaknesses and problems. Don't book it on in immediate basis. Book it over a period of remaining tenure of the loan. If the remaining tenure is 5 years, book this income over a period of 5 years, and so on. Partial recovery. It can sometimes happen that, so example is installment which is overdue. Bank has to recover. Think from the point of your bank. Bank has to recover 10 lakh rupees. 10 lakh is the overdue amount. Out of that, 8 lakh is principal, 2 lakh is interest, and now the recovery is 1 lakh. Now the question is what to do. Whether this 1 lakh should be treated as principal recovery, because if it's a principal recovery, accounting entry will change, financial effect will change. Cash bank account debit to loan account credit. If you are to get interest income, again treatment will change. Cash bank account debit to interest income account. Now it's going to change. What to do now? What to do now? In this case, what should be the accounting treatment? It will depend on what is given the agreement. That is the most important thing. What is given in the agreement? If agreement says that, it should be booked as principal recovery, we'll do that. If it says that interest income, we'll do that. If it says proportionately, we'll do that. If it says 50-50, we'll do that. If agreement is silent, then bank has right of appropriation. Silent, the bank has right of appropriation. Right of appropriation. Now, that means bank is going to decide. Bank is going to decide. Silent right of appropriation. Bank will decide what should happen. But whatever bank decide, it should be consistently applied to all such cases. That means bank should have a fixed policy that wherever agreement is silent about treatment of partial recovery, bank will give the approach. They may give the approach of booking it proportionately. They may say that we should book it as interest income. That will be in favor of the bank. Whatever policy they decide should be properly framed, approved, and applied consistently, uniformly across all such situations. And depending on that, accounting policy, accounting treatment will happen. If it is a loan recovery, loan amount will get reduced. If it's interest income, income will be booked. Whatever the case may be, never book interest income when, if you come to know that this partial recovery is out of the loan given by the bank itself, a new loan, additional loan given by the bank. That means there is no genuine fresh source of money. So we have a customer, amount is outstanding, we are giving him, bank is giving him additional loan, new loan, so that he can repay the old loan. Never ever you should book income if this is the case. Okay, so it's very simple, guys, that whenever you are booking interest income in whatever situation, always keep in mind what is the source of money. It should be a fresh source of money. It should not be simple circulation of our own money. Materiality. RBI says that we will give you maturity level. If interest incomes are below maturity level, it's up to you. Whatever you want to do, no need to follow accrual basis. No need to follow accrual basis, because they are below maturity level. You can book income whenever you realize it. See, a lot of accounting pressure will reduce. In accrual basis, accounting pressure increases. First, we have to book accrual, and then we have to book recovery. So we have to pass two accounting entries. We have to do accounting two times. RBI says that we'll give you maturity level. If incomes are below this level, follow you can follow cash basis approach. It is absolutely fine because it's a immaterial amounts. Follow cash basis, follow realization basis. But if any interest income is exceeding this maturity level, strictly we should follow accrual basis only. Okay. So they are setting the maturity level. They are setting the maturity level. Below this, follow cash basis, go against the accrual. It is absolutely fine because it is immaterial. Above this, compulsorily mandatory follow accrual basis only. But whenever you follow accrual basis, and at the time of passing entry, just think about it whether amount is collectible. Can you we study this in AS9 that if you are booking revenue on goods, sale of goods and services, that's fine. Goods are delivered, great. Services are given, great. Primary condition is fulfilled. You should book revenue. Secondary condition, it should be measurable and collectible. It should be measurable. It should be measurable and it should be collectible. Now, what do you mean by it should be measurable? That you should be clearly able to calculate the amount and it should be collectible. Suppose if you are selling goods and services to a defunct company, it is not collectible. You should not book revenue. So whenever you are using accrual basis, always think about it. Whether as on today, you are confident about the recovery, about the collection. If you are confident, book the revenue. If you are not, then you should defer booking this revenue. Now, the maturity level, they have classified incomes in two parts. Incomes which are booked on gross basis and incomes which are booked on net basis. If the incomes which are booked on gross basis, that means interest income, dividend income, fees income, commission income, they are gross basis because there are no deductions out of them while getting the income amount. TDS is not a deduction. You get TDS certificate. See, TDS, definitely, you are not getting cash, but you are getting TDS certificate. When people deduct TDS, don't consider it as an expense. No. So suppose the 100 rupees the interest income and 10 rupees the TDS. What is the accounting entry? Cash bank account debit 90, TDS certificate, TDS receivable account 10 to income 100. So always keep in mind, when TDS is deducted, it is not an expense to the company. It is not expense to us. Okay? It is simply advance payment of tax, nothing else. We can get full refund of this income. It's only a advance payment. Okay, so interest income is booked on gross basis. Dividend income is booked on gross basis. Fees, commission on gross basis. Maturity level will be 1% of total income. 1% of total income shown in the PNL. That will be the materiality level. All the incomes below this, below 1%, can be booked on cash basis. Above that, follow accrual basis only. But ensure that it is measurable and collectible at the time of booking revenue. Now, income which are booked on net basis, that is profit loss on sale of investment. You take sale proceeds and then you minus book value. Then you get profit loss. That is net basis. Profit loss on revaluation. You take the market value, you see the book value, you take the difference, that is net basis. Now, incomes like profit loss on sale of investment, profit loss on fixed asset, profit loss on revaluation. For this, materiality level will be 1% of net profit before tax. 1% of net profit before tax. So it's very simple, straightforward. Incomes which are booked on gross basis, it's 1% of total income. The base is bigger. Income is bigger, base is bigger. When it comes to profit loss, net basis, base is small, so corresponding 1% of net profit before tax. I hope you realized why there is a difference and there are two maturity levels. Bills for collection, it's a very common practice. Bank will get bill. So in Mumbai, you may get a bill of 5 crores, which is recoverable in Kanpur. So they will say, send it to your Kanpur branch. That Kanpur branch will present it to the party in Kanpur. they will recover money and they will deposit money to our account. We will get the credit in our account. We will pay commission for that. And that makes all the sense. Customer going from Mumbai to Kanpur is expenses, taking people is expenses, staying there for a few days is expenses. Then bringing that money bringing that money back to Mumbai, there is a risk involved. Why do all these things? Let bank do it. We will pay commission for that. So banks present the bill, collect it, and deposit in the account of customer, and they earn commission on bills for collection. Now be careful. This income is a service income. This income is a service income. It is a service income. It's not an interest income. It is a service income. Okay. Now service income should be booked when the complete service is given and money is credited to the account of customer. Only after that. It should not be booked on accrual. It should not be booked from the day you get bill for collection. So there's a difference. Discounting income is of interest income. It is booked over a period of time. Commission on bills for collection is not an interest income. It is booked when the service is given, when amount is credited. Till that time, don't book it. So are you clear about this? When we talk about bill purchased and bill purchase are outstanding as on year end, some income is booked in current year and some income is allocated to next year. But in case of bills for collection, first of all, is not our asset. It is shown in footnote to the balance sheet. It's not our asset. It's shown in footnote to the balance sheet. We will book commission only when amount is credited to customer, not before that. Not before that. Okay. Only when services are given. There's a difference between discount income and commission for bills collection. Memorandum account. Now we know that when account becomes NPA, we reverse accrued income and we shift to the cash basis. That is absolutely fine. That is a prudence. That is conservatism. That's really great. But then we need to keep record of what is the loan amount, and then after that, how much is the interest income which we have to recover from the borrower. It is important for banks to keep a detailed record that how much money is recoverable for loan and how much money is recoverable for interest income, penal interest, etc. This record is required. So outside books of accounts, separate memorandum accounts should be maintained. For each loan, there should be a separate account. How much is the loan outstanding? How much is interest accrued, interest due? Everything should be recorded so that accounts team is aware how much is recoverable from each person. And recovery team is also aware how much is recoverable from each person. It is kept only for the purpose of information. That is not for the purpose of preparing financial statements, accounting purpose. In balance sheet, you will see only loan amount. You will never, if it's an NPA, you will see only loan amount. Only loan amount. You will never see loan plus accrued interest. Okay. In case of NPA, they're saying it's very simple, straightforward. Memorandum account is something which is outside books as such. So guys, it's very simple, straightforward. Use this mnemonic to revise it quickly. Now we have discussed about advances, that how to do overall audit of advances. Biggest issue is NPA norms, its exceptions, clarifications. We have also seen its impact on revenue recognition. Now, what is the solution of NPA? Restructuring. We have already discussed that loans are given to people based on judgments and estimates, and these judgments and estimates may not come true. So they may come back to the bank, explain things. Bank should see genuineness of the story, whether the business has the future, promising future. If yes, they may go for restructuring. In restructuring, basically, we grant concessions in interest rates, and we increase the tenure, reduce the EMI, convert loan to equity, and many other things are done so that even the additional money is given so that borrower Borrower gets chance to continue his plan to create a great business, to generate money and repay the bank. So first to explain meaning, what do you mean by restructuring? Next to explain that auditors should clearly understand RBI guidelines and ensure that restructuring is happening along with as per RBI guidelines only. Different accounts can be restructured. Standard account can be restructured, substandard can be restructured, doubtful account can be restructured. Whenever restructuring never happens on retrospective effect. Whenever restructuring happens, whenever whenever restructuring happens, okay, always this restructuring indicates that borrower is financially weak as on today. There is intrinsic weakness, financial weakness. Borrower is financially weak, and in this case, in such situation, we should carefully evaluate the financial position, chances of recovery, and we should adjust our provision for NPA. Further, if any restructuring is done, that account should be, if it is standard as on that date, it should be downgraded to substandard on immediate basis. For other NPAs, category will remain same. So if restructuring happens in case of standard asset, it should be immediately downgraded to substandard. But if restructuring is happening with substandard asset or doubtful asset, category won't change. This can ask in MCQ. So if you get a short note, you explain background and the meaning. What do you mean by restructuring? Second, you explain that RBI guidelines should be followed. Third, you explain that it can happen with any type of account and it shows there's an intrinsic weakness problem with the account and you should be careful in evaluating it and making provision for the same. Then you should explain the concept of downgrade. If a substandard asset is being restructured, it should be immediately downgraded to substandard. Or if other assets are getting restructured, no need to downgrade them further. Now, what is corporate debt restructuring? How it is different from restructuring? When we talk about restructuring, generally one bank is involved. When we talk about corporate debt restructuring, if borrower has taken loan from multiple banks and huge amount of loans are taken and now he is not able to repay because the judgment estimates have gone wrong, circumstances have gone wrong, now he want he want concessions, he want more time, he want additional financing, he wants reduction in interest rate, he want conversion from loan to equity, he wants concession. Then in this case, but the issue is there is no one bank, there are multiple banks involved. So when multiple banks are involved and borrower wants restructuring, it is called as corporate debt restructuring. RBI has made guidelines for corporate debt restructuring for CDR, and there is a proper CDR cell in RBI. So in case of loan from multiple parties and organizations, if you want to go for restructuring the CDR, you can, any borrower can go for CDR, provided, so the multiple people, lot of suits, legal cases are there for recovery, he can go for CDR if lenders which are of at least 75% by value and 60% by number should agree to this restructuring. This is the basic criteria. So any borrower can go for CDR, corporate debt restructuring, as per RBI guidelines, provided his lenders which are at least 75% by value and 60% by number should agree for the CDR, corporate debt restructuring. That means, suppose if loans given, if 10 people have given loan of 500 crores, 500 crores, then in this case, lenders who have given at least 375 crores, that is 75% by value, and out of 10, at least 6 people, so value wise 75% and number wise 60% should agree, then only any borrower can go in CDR. So explain meaning of CDR first, explain that borrower can go in CDR provided its lenders, that means its creditors, agree, which are 75% by value and 60% by number. If any case is pending in front of NCLT, it will not be eligible for CDR because NCLT is already into it. NCLT is already into it, and they are going to decide. They are going to decide what they want to do, how they want this, what they will decide, that how to bring entity out of the financial problems, how to ensure they are up again and running. It's NCLT. But if it is a very large value CDR, very large value CDR, and specific recommendation is given by RBI's core CDR group, then then in consultation with NCLT, they may become eligible for CDR. May become CDR. So if case is pending in NCLT, CDR core groups makes the recommendation, sends it to NCLT, NCLT approves it, then it can happen that even such cases can be covered in CDR. What kind of things are done in CDR? Okay, so interest rates will be slashed, tenures will be increased, interest rate will be slashed, EMIs will go down, loan will be converted into equity. So a lot of concessions and sacrifice will be done. If interest rate goes down, that's a sacrifice by the bank. Sacrifice by the bank. Additional loans will be given. So these are the terms which are similar to restructuring only. When it goes to CDR, generally two types of agreements are important: debtor-creditor agreement and intercrater agreement. So there's a debtor. Who is a debtor? Borrower is the person from whom we have to recover money. He's a debtor and we are the creditor. And there are a lot of creditors. So there's the intercrater agreement. These agreements are either framed at the time when loans are given to the borrower, or maybe at the time of CDR they are made. These agreements will have a lot of important clauses. For example, that creditor should not take any more loans. He should take loan only from the CDR as per the CDR process. Then creditors will be showing standstill. They will not take any legal action in court or any other authorities for next 90 days to 180 days. If anyone breaches the contract, there will be a penal clause. There will be exit clause. If any creditor doesn't want to participate in CDR, then he will be paid and he will exit. But the payment terms will be not very lucrative. He will have to take haircut, loss of 30-40% as the case may be. Classification of account. If any account is in CDR, then existing classification will continue and carefully evaluated whether further downgrade is required. But only because CDR package is approved to upgrade the category, that is not the solution. So there's a short note on CDR. You explain what's the meaning, you explain eligibility, you explain who is ineligible, you explain terms, you explain two agreements are important and terms of those agreements are important. They will have impact on the recovery process, and accounts should be classified as per IRAC norms as it is. There should not be upgrade only because package is approved. So if there are NPA issue, restructuring is the solution. CDR, corporate debt restructuring, is the solution. Now, what do you mean by now sale purchase of NPAs? Sale purchase of NPAs. Let's understand sale purchase of NPAs. Guys, yes, this happens in practical world, that banks sell their NPAs, other banks purchase NPAs. So if any bank is frustrated, they are not able to recover money from the non-performing assets, they may sell to the other banks. The other banks may be having good terms with the borrower, they may be able to recover it, or they know the trick, or they know how valuable is the security which is received along with the loan. They value that security a lot. So one of the very interesting way of getting rid of the NPA is buying and selling NPAs. Bank should have a proper policy of buying and selling NPAs. They should frame policy. They should have committee which evaluates each proposal and decides carefully whether to go for buying and selling NPA. Now RBI has given some terms and conditions. RBI has given some terms and conditions. Now there are terms and conditions when we are selling NPA. First of all, bank can sell NPA only when the account has remained NPA in the books of the selling bank for at least 2 years. That means they should try. You can sell NPA provided you have made enough try of the recovery. They should be NPA in the books of selling banks for at least 2 years. You cannot sell NPA immediately. You should try for it. You should try to recover. It should have remained NPA in the books of selling banks for at least 2 years. Then sale should be only on cash basis. Only on cash basis. Only cash. No credit. You are already selling a bad asset. You don't want to take further risk. You don't want to take further credit risk. So sell it if it is in your books for at least 2 years. It should be only on cash basis. Price should be fixed. It should not be contingent. It should be a fixed price. No contingent price. It should be without recourse. Once we sell, we get money. Now we are not concerned whether you are recovering money or not. You cannot come back to us without recourse. You cannot come back to us. Purchasing bank will take all the risk henceforth. You cannot come back to us. We will not assume any legal, operational or any other risk. These are the terms on which sale of NPA is allowed. If all the conditions are fulfilled, a proper agreement is framed and executed, we will remove that NPA from the books of the selling bank. But these conditions are important. At least 2 years, only on cash basis, price is fixed, no contingency, without recourse, does not assume any legal, operational, any other risk, removed from the books. Now, if you get low price, there's a shortfall, you book a loss. If you get more price, don't transfer profits to P&L. Transfer it to provision for NPA. Let's see. Supposedly loan is 100. Provision for NPA is 70. That means the net book value is only 30. And suppose it is sold, selling price for 20. Now you are selling something for 20 and the book value is 30. There is a loss of 10. We are getting money 20 debit. We are finishing off the provision. Why? The loan is removed from the books. Even the provision should be removed. Provision is removed by debiting it. Loan is removed by crediting it. Balancing figure is loss on sale. It will be transferred to P&L. Will book a loss. But suppose it happens that it is sold for 45 crores. So 15 crore extra is a profit. Understand this. Cash bank debit 45, cancel the provision 70, cancel the loan 100, profit is 15. This profit should be transferred to provision for NPA. It should not be transferred to P&L. It should be transferred to provision for NPA. There's a difference. So the how you treat loss is different and how you treat profit is different. How you treat loss is different, how you treat profit is different. That's what they're saying. If you get less than the book value, book it as a loss. If you get more, then that profit should be transferred to provision for NPA. It should not be transferred to P&L. The profit should not be booked ultimately in P&L. Are there any terms and conditions for the purchasing bank? Of course. You should never buy a NPA loan which you only sold originally. So it should not happen. It should not be that you sold a NPA to A sold to B sold to C sold to D, and again you are buying it. Purchasing bank can never buy a NPA which they themselves sold in the past. No. Purchasing bank will take over the loan, have new understanding, terms and conditions, give time to the borrower that you start paying the amounts, give them new targets, due dates, etc. And now we will have the purchasing bank will have NPA classification and NPA provisioning, NPA classification and NPA provisioning as per status of recovery in their books of accounts. And not what selling bank was doing. So it's very interesting that You cannot buy which you sold. After buying, you have a arrangement, understanding, and now NPA classification and provisioning as per the new due dates and not what selling bank was doing. Whenever recovery will happen in these loans, first it should be treated as recovery of cost. Whenever you are going to get money on such loans, it should be treated recovery of cost. And if you get more than the cost, then it should be booked as a profit. What do you mean by that? Suppose purchasing bank purchased a loan for 45 crores. Whatever money you will get, you will first recover the loan amount. Cash bank debit to loan, cash back debit to loan. You will finish off the loan first. And whatever extra you get above 45 crores, suppose you get 60, you get 15, that you will book as a profit. So whatever money you get, first recover your cost and then you start thinking about booking profit. Now this is an asset. We'll study this while computing capital adequacy ratio. You must have done this in CA Inter also. Capital adequacy ratio. We have to multiply assets with the risk weightage. Cash is 0%. Balance with RBI is 0%. Okay. And this NPA which you have purchased is definitely 100% risky. So multiply it with 100%. Upgradation. A simple thing that RBI has framed detailed guidelines for upgradation of the account. Don't be in a haste. So whenever NPA happens, it slips into different categories. There is a category of substandard, then category of doubtful for 1 year, 1 to 3 years, and more than 3 years. So there are these categories. Okay, these categories are there. Now, when if borrower starts paying the outstanding amount, overdue amounts, that's really great. We'll think about upgradation. But RBI has framed detailed guidelines for upgradation. And it says that be extremely careful. Always ensure the whole overdue amount is recovered. There should not be a partial recovery. Whole overdue amount should be recovered. Further, if these are restructured loans or CDR loans, RBI further says that be extremely careful. Let 1 year pass with proper recovery. Let 1 year pass with proper recovery. Then only we'll go for upgradation. Sometimes RBI says that this is the cutoff date. By so and so date, they should clear their dues. Then only we'll do the upgradation. So if it's come in exams, you should explain that if people don't pay money on time, it becomes NPA, they're different classification. And if they start paying money, recovery starts happening, their account is upgraded. But RBI guidelines are there, you should be extremely careful. The complete overdue portion should be recovered. That's very important. Further, if they are restructured CDR accounts, then there are further conditions attached to it. That recovery should happen within so and so cutoff dates. Recovery should continue, proper payment should continue for so and so period. Then only upgradation should be done. How to audit classification of NPA and provision for NPA. Let's understand. See, so this chart is again not in the notes, so I will request you guys to note it down. Let's understand. It's very simple. First is, so you may not write it in the substantive procedure. It is a law related point. First thing auditor is supposed to go is to go to RBI circular and then download IRAC norm, income recognition asset classification norms, and go and understand what is the present norms. What are the present norms, latest norms after all the changes? When loans will become NPA? What will be the different categories? What are the different provisional rate required? And so on. First, have a proper understanding of the latest amended requirements. Then go and test controls. Go and understand their internal control system, how the loans are classified into NPA and their subcategories, and how provision is computed. There can be a module of core banking software, core banking system. There can be a separate software altogether. There can be Excel sheet. Whatever it is, obtain its understanding. Understand what criteria they are using for classification, what rate they are using for provision, and ensure that it is as per RBI's latest circular. Then substantive procedure, obtain total amount of standard assets and different categories of non-performing assets. These are total standard assets, these are non-performing. Breakup, this is substandard, this is doubtful for 1 year, 1 to 3 years, more than 3 years is loss asset. Obtain complete classification. uh, Total balances, then get the loan wise breakup, randomly select loans from each category, and now go and check them. If it is standard, whether classification is appropriate. If it is substandard, classification is appropriate. Doubtful, its category is appropriate. Loss, that classification is appropriate. Go and check the classification. If classification is correct, then go and recompute whatever the total amount you had. Apply proper rates as per the categories, as per the classification, and recompute the provision which you get. It should match with the provision which bank has recorded. First comes law, then comes understanding and testing controls, then comes substantive procedures. First getting things on totality basis, and then getting things on totality basis, then go for individual loan sampling, check the classification, finally do the recomputation. Very simple, straightforward. Drawing power. Now again, we discuss this in great depth and great length in Inter. Whenever borrower comes and says that he wants a short-term financing facility where he can withdraw money whenever he wants, withdraw money wherever he wants, for the business purpose, for the business expenses, he's asking for CC limit, OD limit. He's asking for CC limit, he's asking for OD limit, he's asking for working capital loan. Now looking at his present, looking at its past, present financial position and future, keeping overall financial health in mind, bank decides sanctioned limit, that is the maximum amount of loan which should be given to this borrower. And there's a further breakup. This is the maximum term loan, this is the maximum working capital loan, this is the maximum uh, work guarantee which can be given, letter of credit which can be given, and so on. So initially what we compute is a sanction limit as per the overall financial health. Then borrower starts sending quarterly debtors, stock, debtors, creditors, everything. Now these current assets are our primary security in working capital loan. So we take this security and we deduct few things, margin, and we get how much loan should be given depending on the status of the security. Depending on present status of the security, how much loan should be given, maximum loan. That's called drawing power. That's called drawing. So first clearly explain what do you mean by sanctioned limit, and then what do you mean by drawing power. Then you explain that as an auditor we should go and check how drawing power is computed. The formula which is used, the methodology which is used, the percentage which is used is extremely important. Earlier, there used to be a standard bank policy approved by made by board of directors, approved by auditor. But this has changed. Modi is yet to change it. It has changed. If you go to guidance to run bank audit, they have changed it. Now, the way drawing power will be computed depends on what is written in the sanction letter. Generally, it is stock minus existing creditor. They will take away that much portion, minus bills payable. Bills payables are nothing but creditors, again they will take that much portion. Okay, then the balance amount, we will deduct the margin, say 25%, and we'll get uh, on stock how much loan should be given. Similarly on debtor, we'll deduct some debtor, then margin, how much loan should be given on debtor. So in totality we'll get how much maximum drawing power should be depending on debtors and creditors, depending on stock and debtors and creditors. So it will be on sanction later. So first explain that computation of these limits was earlier as per the policy made by board of directors, approved by auditors, but now it has changed, and now the way of calculation should be as per sanctioned letter. Then as an auditor we should check, are we getting data on quarterly basis, on regular basis? We want data of the stock, of the creditors, of the bills payable, of the LCs and guarantees issued to these guys, LCs and guarantees which are issued on the base of the stock, on the base of the stock, the debtor level, ineligible debtors, how much we should get all these data. This data is important because on this basis we are going to compute compute drawing power. We should also check the margin, the percentage which will be reduced. Okay. So first explain meaning, then computations, then data is proper. You're getting this data on a regular basis, quarterly basis, it's appropriate. Then whether file calculation margin is deducted properly. If it's a consortium loan, consortium working capital loan, lead bank will do all these activities. Lead bank will collect all the data. Lead bank will collect the working power limit, drawing power limit, and allocate it. How much drawing power should be there for all the participating banks? If it's a construction business, they have to move their machinery and a lot of asset from one side to another. So they are given mobilization advance. If it's a construction company, mobilization advance is already given. Whatever drawing power you have, minus that advance which is already given. For example, if drawing power is coming out to be 100 crores and we have already given 20 crores as mobilization advance, that should be deducted. Only 80 crore is the further financing which can be given. If amount crosses a particular limit, that is generally more than 5 crores, more than 5 crores, okay, particular limit, then in that case bank should order stock audit. In stock audit, bank appoints an external CA firm, that you go and check on our behalf. Are they having this much stock? Are they having this much debtor? Are they having this much creditor? And all the details you go on our behalf. Okay, so if you explain these points, that will be a short note on drawing power calculation. Presentation of advances depending on security, we are aware about it. Secured by tangible asset. There is the finest security you can get: tangible assets, land, building, gold, bullion. Tangible asset is the best security. And RBI says that book debts can be considered in tangible asset. Even the book debt is the best type of security. It's a good security, so you can cover book debts in tangible assets. That is allowed. Then next is guarantee by government and guarantee by banks, and the remaining is unsecured. So now we know the meaning of security, tangible assets, and it includes book debts also. It includes book debts. There's a very simple way of allocating it. Suppose there's a loan of 100 crore. First, see the primary security. What is primary security? Asset for which loan is principally given, that is primary security. If loan is given for building plant, then plant is a primary security. If there's a 100 crore loan, understand what is the value of the plant. Suppose value of the plant is 60 crores as on today. So that much portion is secured. Then you see whether there is an additional security, that's called collateral security. Suppose we have 20 crores of collateral security. So 60 was primary, 20 is collateral, total 80 crore will be secured. Then you ask, are we having any guarantee? Suppose we are having guarantee of 10 crores. 10 crores, suppose guarantees of 15 crores. 15 crore will show in the second part, covered by bank guarantee. And remaining 5 crores will go to unsecured portion. So whenever we have the loan, first apply value of primary security, then apply value of collateral security, then apply guarantee, and remaining balance, if any, will go to unsecured. That should be the sequence in which we need to apply things and determine how much will go in secured, how much will go in guarantee, and how much will go in unsecured. Margin. Suppose margin requirement is breached. So what do you mean by that? In loan, it was written that if a loan is of 100 crores, security value should be minimum 125 crores and there should be margin of 125. Now what has happened? That value of security has reduced. Now it has reduced to 110. Agreement said that you need to maintain security of 125 crores, but you are maintaining only 110. So there is a breach of 15 crores. What will happen? RBI says that if there is a breach in margin requirement, borrower should be called, he should be reprimanded, he should be penalized, he should be punished. You should ask for the extra security. But that doesn't mean that you show loan in unsecured. Even if margin requirement is breached, till the time there is adequate security to cover the amount of loan, it will be shown in secured only. Even if margin requirement is breached, till the time loan is covered, to the extent loan is covered, it will be shown in secured only. Government guarantee will include not just, it will include central government guarantees. We are not talking about NPA, we are talking about classification, presentation. It will cover guarantee by central government. It will cover guarantee by state government. It will cover guarantee by government owned controlled entities. IDBI, IFCI, ICICI, ECGC, Export Credit Guarantee Corporation, Deposit Insurance Credit Guarantee Corporation, DICGC. It will cover guarantees from these guys also. So when we talk about guarantee from government, it is from both the state, central and state government, and even corporation owned and controlled by them. Bank guarantee is guaranteed by others. So if other banks simply sign a negotiable instrument in favor of, and we are having that negotiable instrument, it will be considered as a bank guarantee. If a DD is issued by them, it will be covered as a bank guarantee. If amount is exceeding guarantee, it will go to unsecured. ECGC, DIGC guarantee will be definitely considered. Now here, suppose generally these ECGC, DICGC, they whenever there is a default, they start paying money part by part. There is a loan of 100 crore, okay, and ECGC, DICGC, they started paying money of 20 crores. But as on today, the complete amount is not received. Full and final settlement is not received. So what bank has done, cash bank account debit to sundry creditor. Whatever money is received, they have received the money and credit sundry creditor. What RBI says, this sundry creditor should not be shown on liability side. It should be netted off with the loan, and the net amount should be shown 80. Net amount should be shown will be 80. Okay. So ECGC, DICGC. So it's very simple that if there's a partial recovery and sundry creditor is created, don't show it in the liability side. Doesn't make sense because you don't have to pay this money back to anyone. You don't have to pay it back to anyone. You simply show it as sundry. You simply deduct it from the loan side and show loan on net basis. Supply bills. Now, what is supply bills? It's very simple. See, borrower will be having his own business. He will be selling goods and services to its customers. Suppose he has sold goods worth 100 crores. Now he has sold goods to the customers. Customers have accepted bill of exchange. So customers have signed bill of exchange and said that yes, we are going to pay 100 crores to the person after 3 months, 4 months, 5 months, 6 months, as the case may be. So supply bill is ultimately a bill of exchange which is accepted by the customers, by the customers of the borrower. Now it is an asset. So they are submitting supply bill to us. This supply bill doesn't have any value. It is simply promised to pay. Already borrower has promised to pay us. Now his customers promise to pay. Doesn't make any sense. The supply bill cannot be considered as a security. It cannot be considered as security. We cannot put that loan in secured advances. We cannot put it in advances guaranteed by government or banks. Unless and until it is backed by some collateral, some tangible asset, it will not be considered secured. Borrower is giving self-check. Check signed by him, self-check. This self-check are again promises to pay. Doesn't have any value. It will be still treated as unsecured. Only supply bills, bill of exchange, unsecured. Self-checks, unsecured. Guys, we are through with advances. That was a huge part, big part. Okay. Now let's see fixed assets. See guys, fixed asset is not a very important asset when it comes to banks balance sheet. But still, there are some important points related to fixed asset in bank audit. Let's see. I've made a small chart on this. Most important thing is that there's a section 9. There's section 9 of Banking Regulation Act, which says that if bank acquires immovable property, purchases it, or obtains it in the form of loan settlement, that is technically called against satisfaction of claim. That means a borrower was not giving money, So we took over his immovable property. So if they receive immovable property by purchasing it or by obtaining it as a settlement, if it is for own use, they can keep it with them, they can keep it on their name, they can hold it for any number of years they want. If this property is for own use, they can hold it for any number of years they want. Simple, straightforward. But if it is for any other purpose, like it's not for own use, they have just kept it, it's idle, they are not going to use it in their banking business in head office or any branch, it's idle, then government doesn't want banks to get into real estate business or real estate sector. That will not be a good idea because they have huge money power, and then they will be one of the influencers or manipulators in real estate sector. It is said that they cannot hold such immovable property which is not for their own use more than 7 years from date of acquisition. That's extremely important. They cannot hold for more than 7 years from the date of acquisition. That's why you see so many auctions. One of the best way to get property is that you go to bank's site, auction site, and you bid for it. See, it is obligation on the bank to sell those properties. Is the best circumstances opportunity to get property at a cheaper price. But be careful. You should not get stuck. You should not get badly involved in that you lose your principal amount also. So section 9 is important. Uh, ex- uh, Explain section 9. Then the audit approach. First of all, when it comes to audit of fixed asset, major fixed asset will be at head office, regional office, or zonal offices. So this audit of fixed asset, this particular thing is relevant only for these offices. They may not be relevant at branch office level. At these level, the focus should be on the process. Was proper approval taken by from board of directors or authorities? Proper acquisition process was followed. Tender was floated, and then proposals were evaluated, best selected, and after selection, then a purchase was approved and payment was done and property was transferred in the name of bank, etc. The process is very important, and whether proper records are maintained, whether manual records are maintained, manual fixed asset register, or there's a fixed asset management software. So in audit, we are going to focus on these things relevant for audit of HO, regional, zonal process and records. When it comes to detailed audit procedures, use your internal knowledge. Simply think about it. How will you verify existence of the asset? How will you verify existence? How will you verify completeness? How will you verify uh, valuation and rights and obligation and so on? So that's all about the audit of fixed assets. Now, so after advances, we saw fixed asset, then we have other assets. And one of the most interesting of the uh, other assets is inter-office adjustment account. That's very, very interesting. Let's understand. See, one of the very good things of bank is they have huge network of branches, and they can give very good services where multiple locations are involved. Now, for example, let's take an example of a DD that you. So we think from the bank point of view, customer comes and he says that take this 10 lakh rupees cash or 10 lakh rupees through my account and make a DD for me, demand draft for me, which is payable in Kolkata, payable at Kolkata. So Mumbai branch, suppose we are in Mumbai, say let's take example as on the screen, Mumbai and Delhi. So person comes to our branch in Mumbai, he gives 10 lakh rupees and says that make a demand draft. So what Mumbai branch will do, Mumbai branch will take the money, will make a demand draft, name of the person for whom this demand draft is, then payable at Delhi. So this can be withdrawn in location of Delhi. Account pay, it will be transferred directly to the person only. And then there will be DD number, electronic number, unique identification number of the DD, amount, signature of the person. So Mumbai branch is the receiving branch. They are receiving money and issuing DD. Okay. Now payment will be done at Delhi. So as soon as Mumbai receives money, they issue DD. they are going to send intimation. That's called advice. Intimation. Official intimation is advice. They will send intimation, advice to all the Delhi branches on their system that listen, we have issued DD on so and so date, so and so number, so and so amount. It may come for payment at your location. You match the number, amount, person, all the details, see authenticity of DD and pay it. So this communication will go from Mumbai branch to Delhi branch. Then Delhi branch, any of the Delhi branch, they will get DD for the payment. They will verify it, look in the system, see yes, there is an intimation. They will pay. They will pay the DD. They will take the DD and make the payment. Maybe cash, maybe account, as the case may be. Account maybe. They will inform Mumbai branch. Debit advice. Listen, Mumbai, we have paid the money as instructed by you. Transaction is over. So Mumbai branch will be called a receiving branch because they're receiving money, and Delhi branch will be called paying branch. So this happens very often, that one branch is receiving funds and one branch is paying funds. They belong to same bank. That's why it's possible very easily. This can happen in the form of for DD. This can happen when check is issued. Customer's account is in one branch and payment is happening from the another branch. This can happen from customer is withdrawing money from some other branch. Customer's account is in one branch, withdrawal is from other, or he's depositing money in one branch and his account is in other. It can happen that time also. It can happen bills for collection. Customer's account is in one branch and bill is collected in the another branch. So in case of branch, there can be multi-location transactions. And it can happen that transaction starts from one branch and ends at another branch. Like this DD. It started from Mumbai and ended at Delhi. So this can happen in DD, checks, withdrawal of money from different branches, depositing in different branches, bills for collection, and many other places this can happen. Now in this, because there are two branches involved, see how accounting will be done. Like Mumbai, they will say that money received, cash account debit. But the other part will be done by the Delhi branch. So we will be crediting inter-branch adjustment account. When Delhi will make payment to cash account credit, they will debit inter-branch account. Ultimately, this account will nullify. Now try to understand. Whenever inter-branch transactions happen, inter-branch adjustment account is used. It is a temporary account because when the transaction is completed, debits and credits will knock off each other, will match each other, and this account will be nil. I hope you understood multiple branches, concept of multiple branches, how transactions start at one and end at another branch, how accounting take place. Whatever receipt payment is happening, do it and give other effect to the inter-branch adjustment, and ultimately it will nullify. On 31st of March, you will always find some balance in this account. It may happen that there is a debit balance. It may happen that there is a credit balance. Credit balance means net credit balance means some branches have received money and this amount is due to be payable to others from other branches. Credit balance means they have received money and it is due to be paid by other branches. Debit balance means money is already paid. Money is already paid some branches and it is due to be recovered from the other branches. So if it's a net credit balance, it will be shown in other liabilities. If it's a net debit balance, it will be shown in other assets. So after understanding the mechanism, let's see. So first explain the meaning. That there are a lot of transactions which happen within the branches, and for that inter-branch adjustment account is used. It's a temporary account. Ultimately entry is done in such a manner that debit credits will get nullified. This account should be ideally zero, but in practical life, as transaction happens on continuous basis, on 31st of March you may find net credit balance or debit balance. As an auditor, you should see whether these system ensures that transactions in the inter-branch account are properly reconciled. So within the account there can be segment. There is a DD segment, there is a check segment, there is telegraphic transfer segment. We'll discuss about it later. Segment, there can be different segments. Entries should match with each other. That's called reconciliation. There should be system which ensure that entries are reconciled with each other. Generally at central level, entries are reconciled and knocked off. Okay, so this reconciliation is extremely important. Auditor should ensure system does reconciliation. Uh, and if any entries are not reconciled by system, so manually staff should go and see each entry, see why it is not reconciled, and ensure that it is properly reconciled. Debits and credits should match. Even after doing that, there will be outstanding entry. It's absolutely fine. Maybe the other half of the transaction is yet to happen. Outstanding entry should get nullified within few days. Within some days, if you see subsequent year transaction, it should get nullified. If they are not getting nullified, it should be recorded that which are these transactions. Further analysis should be done, especially debit entries, debit balances. Because if there are low chances that money will be recovered, then provision should be made or it should be written off. LAFR reporting, we'll study more. Long form audit report. Apart from audit report on financial statements, one more report is prepared, and that is called as long form audit report. Long form audit report. This report is in the form of questions which are framed by RBI, and it covers all the important departments and functions of the bank, like deposits, cash, investments, advances. So this is a questionnaire on all the important departments and functions of the bank, and these questions focus on how well departments are functioning, how well internal control systems are functioning. The main focus is on that. You keep answering the questions. You keep answering questions, and automatically we will understand whether departments and functions are performing properly or not. In this LFR, auditor need to report till what date segments of interbranch account are reconciled. How many entries are outstanding? Separately, debit entries and credit entries. Debit entries are extremely important. That means payment is made. Now recovery is pending. Credit entries are less important. That means money is received. Only payment is pending. Payment will happen. Whoever need to ask for payment, it will happen. If there are some errors, discrepancies, mismatches, then it should be rectified. It should be discussed with the management. Generally, you will find about the inter-office adjustment, the issues related to it from branch audit reports. Explain the meaning, explain reconciliation is important, explain outstanding entries are analyzed, scrutinized, explain LFR reporting, discrepancies, and from where you will get all this information from branch audit reports. So you'll have a wonderful short note on inter-office adjustments. Now this thing, miscellaneous debit balance, we are going to cover it later. So there is a repetition. Simply cut this particular concept because it is covered later. Now, what about TDS and advance tax? TDS and advance tax. It may happen that many people who pay interest to the bank, that they may deduct TDS, and pay it to the government. So these guys will send TDS certificates to the bank. So first you explain that the concept of TDS. Explain that bank receives a lot of income from various sources. Incomes may be received by head offices or branch offices. When they receive income, third parties may deduct TDS. They may deduct TDS and pay to the government, and they send TDS certificates as a proof that yes, your TDS is deducted and paid to the government. Now, everyone should collect it. Branches collect it properly, account for it. Branches should transfer these original TDS certificates and balances to head office books of accounts, because it is head office where income tax return will be prepared and submitted. That time this information will be required. How much TDS certificates we have, how much TDS we have, because that will be used for paying taxes. Actual payment will get reduced to that extent. So you are going to need these certificates need to be transferred. So first explain the concept, explain that how these certificates and balances are transferred to HO. Then explain that you can further get details of TDS and credits in form 26AS. So you'll get TDS details from TDS certificate. You can get TDS certificate details from form 26AS, which is available on income tax portal. Now, on the base of these two things, TDS certificates and 26AS, ideally both the balances should match. Ideally, both should match, and the same amount should be taken as deduction, in income tax return. Not just deduction, same should be taken as a payment of taxes in income tax returns. These two things will justify taking credit. These two things will justify taking credit about TDS in income tax returns, and all these three should ideally match. As an auditor, you should see that all these two things are available, it match with the returns, and these two things will justify taking credit of TDS. So explain the concept of certificate, explain the concept of 26AS, explain that what happens at HO, they prepare return, and they, for taking credit, these two things are required. As an auditor, you should see, while taking the credits, are there enough justification supporting evidence? These certificates and Form 26AS is going to be that support. Now, stationery and stamps. See, when we talk about stationery, what we recall is paper, pen, rubber, pencil, scale, okay, books, notebooks. This is what we recall, correct? Now, regular stationery items like all these things, books or paper or ink, pen, rubber, pencil, etc., is not covered here. It doesn't cover here. That may go to the office expenses. Here it covers exceptional items. They are high in value and purchased in bulk. Like revenue stamp. So every time, what is revenue stamp? Revenue stamp is a small stamp, okay, 1 rupee stamp. So whenever bank makes the payment to anyone, what they are going to do, they are going to take their signature on the payment receipt, and at the time of wherever signature is taken, they are going to put revenue stamp, and then they will ask to put signature, half on revenue stamp and half on the receipt. So whenever banks make payment receipt, they take signature half on revenue stamp and half on the receipt, because Indian law says that if revenue stamp is applied to any payment receipt, it will be considered as valid in court of law. So bank is going to do that as a proof. So regular stationery items don't come here. Exceptional items which are purchased in bulk, revenue stamp, stamp papers, security paper. Okay, so DD and a lot of important things are made on security paper. Even that may get covered here. So in fine print, you will see that SBI is written, IDBI is written. It's very difficult to copy. Even that can come here. Okay, now let's understand. Regular stationery items won't come. Things which are purchased in bulk, having a lot of value, revenue stamp, stamp paper, semi-legal paper, security paper, they will come. Generally, this purchase is done at head office level, and then it is supplied to the branch level. There should be strong internal control system. Wherever the stock goes down, proper purchase requisition note should be prepared. It should be approved. Things should be purchased from the official vendors, and then it should be properly stored. It should be safe. Regular physical verification should be done. System should be strong. When it is purchased, it is recorded at cost. And over a period of time, as we consume these stamp paper, revenue stamp papers, security papers, semi-legal papers, they will be transferred to the P&L. So accounting treatment, how they should be booked at cost, transferred to P&L, and then valued at cost only. And end of the year, physical verification should be done to ensure whatever stock we have, it exists physically. Okay, so you first explain the meaning, then explain at what level it happens, then explain internal control systems, then explain accounting treatment, purchase first time, then how it is transferred to cost is transferred to P&L, closing stock, then physical verification. Now next is non-banking asset acquired in satisfaction of claims. Many times borrower doesn't pay money and bank has to overtake the security and many times it is an immovable property. So banks get property as satisfaction of the loan money, satisfaction of the claim on the borrower. And a lot of time immovable property is received. That is called non-banking asset. So this doesn't occurred from banking. This was not this considers non-banking asset. This is not out of normal banking operations. Because money was not recovered, that's why unfortunately we are getting this. That's why it's called non-banking asset. So first explain what do you mean by non-banking asset. Explain that how default happens, we have to take over the security, and then it is transferred to the bank, and they get a lot of immovable properties, tangible assets. And so bank has no intention to use it for own purpose. They're planning to dispose it off. That comes in non-banking assets. If you want to check these assets, take the list. How many assets are there? Take the simple list. And after taking the list, okay, after taking the list, simply see the items in the list and see corresponding documents. Whether this list corresponding documents. Okay, documents are also talking about these properties, and we have these properties. These properties look genuine and proper. Nothing is missing. Nothing is missing. So look at the documents. Look at the documentary evidence that such properties exist. Look at the documentary evidence to understand bank is a free owner. There are no disputes. There are no claims. Bank can simply sell this property wherever they want. If there are disputes and some claims against the bank because of the property, adequate provision should be prepared, and provision should be as per AS 9. Always keep in mind section 9 that if it's not for own use, it cannot be held more than 7 years. Otherwise, there will be breach of section 9 and bank will be penalized. Accounting is very interesting. It should be accounted for value of market value of the asset or book value of the loan, whichever is lower. It should be recorded at that amount. So whatever land building account debit, non-banking asset account debit to loan account credit, and it should be recorded at either market value or net realizable value or value of the advance which is cancelled in the process, whichever is lower. So it should be valued at lower. Explain the meaning, explain why documents are important to check existence, validity of the property, ownership matters, provision may be required, section 9, and it's accounting at whichever is lower. There can be MCQ for this. So within other assets, you get one more heading, and that is called as others. And there are interesting accounts here, others. And the first account we have in others is non-interest bearing staff. It may happen that the banks, they love their staff a lot. So it may happen that banks give interest-free loans to their employees as per policy of the bank for specific purpose, for specific time frame, after certain conditions are fulfilled. That's great. This is not a regular advance. This is not a business activity. This is not a regular advance given by the bank. So they should not be shown in advances. They should be shown in other assets, in others. Interest-free loans given to the uh, employees, loan given as an employer. Take the list, check the policy of the bank, see the documents, whether these loans are given as per the policy, are there valid documents supporting it? Great. Till the time that employee is in bank, it will be treated as others in other assets. In other assets, they'll be heading others, and there we are going to keep it. If this employee leaves his job, then guys, then in that case, this loan will be transferred to the advances. It will be transferred to advances. It's very simple. Explain the concept, explain how you take the list and verify it, explain where it should be shown, explain what will happen if employee leaves the organization, leaves the bank. Now, next is miscellaneous debit balances on government account. miscellaneous debit balances, miscellaneous debit balances on government account. Now, what is it? Let's understand. First, to explain what is this miscellaneous balance on government account. Many times, see, central government and state governments, they announce a lot of schemes. The explanation is given at the end. A lot of schemes are announced. There will be Kisan Samman Yojana, where farmers are paid. Payment is done to farmers. Then there will be Ayushman Bharat, where payment is maybe done for medicines, medical facilities. So there are a lot of schemes, and in a lot of schemes, monetary payment is done. There will be unemployment allowance. There will be payment of scholarship to students. So what government will announce the schemes, and government will say that, okay, whoever are eligible for the scheme, whoever wants to take benefit of the scheme, gather all the documents which proves that you fulfill the criteria of the schemes. Gather all the documents, gather all the proofs, and then get it verified from the government. Get it verified from the government department. After all documents and all the verification, take these document to some banks and their branches. The government is going to tie up with some nationalized banks, PSU banks, and some of their branches will be designated. That you go to these branches, show all the documents in the scheme. Person will check all the documents, check in his system whether the person is eligible or not, and if it's eligible, will collect the documents, make the payment, make the payment, and take the signature on the receipt. So branches. So what I'm saying is, some nationalized banks, their designated branches are going to make a lot of payments under various schemes. Verify documents, look it through system. If it's approved, make the payments, make all the payments. Okay, they will keep making payments on behalf of government. This is a scheme first you need to understand. Now, these branches will ask for reimbursement of money. These branches will ask for reimbursement of money. Reimbursement of money from the government. On regular basis, they will lodge claim for reimbursement of money to central government or state government, as the case may be, and they will recover their money. So first, explain the whole concept, that there are government schemes, and what government says to the people, how these schemes are processed. Explain the process, how some designated branches keep on making the payments. After that, how periodically they make the list with all details and send reimbursement claims to the government. So when payment is made, accounting entry is very simple. Claim receivable from the government account debit to cash account credit. Debit to cash account, debit to cash account, debit to cash account. And if they get money, it is cash bank account debit to claim receivable from government credit to commission income credit. So they will get some money as a commission also. Okay. If now this miscellaneous, this claim receivable account is a temporary account, ideally it should become nil, it should become zero. But as on 31st of March, it will be always there. So that miscellaneous debit balance receivable from government is shown in other assets, in others. It will be shown here. As an auditor, you should take the aging, since how long this balance is pending. Less than 30 days, 30 to 60 days, 60 to 90, 90 to 180, more than 180, more than 30. Make the aging. If there are old outstanding accounts, identify them, sit with the branch management, why these debit balance are outstanding so long, ask for the reasons, justification, go for confirmation of these balances. If there is no proper justification and no proper confirmation, we'll have to ask management to make provision. If there's a proper justification, confirmation, so depending on justification and confirmation, you have to decide whether provision should be made or not. Explain the concept, explain how claim is lodged, explain how aging is prepared, old outstanding is identified, explain how justification is asked, confirmation is taken, and if they are not, provision should be prepared. Suspense account. In bank, a lot of transactions happen on continuous basis. Lot of transactions happen on continuous basis, and many times it takes many times there is no sufficient information to do accounting with the accountants. So those whenever you receive money, cash account debit or cash account credit, corresponding effect is parked in the suspense account. Many times when bank receive or pay money, they don't have enough clarity to understand what should be the accounting treatment, which account should be debited or credited by what amount, and how it should be done. So they park the other side of the entry into suspense account, and slowly as they get information, they transfer from suspense account to maybe income account, expense account, asset account, liability account, whatever the account they want, they transfer it. And suspense account will again nullify, it will be temporary. So suspense account is supposed to be temporary. Where there is lack of information, an accountant doesn't know how to do accounting, they post other effect which is unknown on the suspense account, and suspense account should, over a period of time, as we get more information with proper accounting, it should nullify. So first explain again the concept. If there are old outstanding entries, especially debit entries, we should ask for the reasons why these are debit by entries pending. It should be written off. Why it is pending? What is the reason? Go in depth. Okay, and if there's no proper justification asks for provision or write-off. Provision or write-off should be done. So everyone is worried about old outstanding entries. Security deposit. Banks keep on making a lot of payments, and this will include security deposits. So in other assets, you will find security deposits also. Security deposit can be given to authorities, or it can be given to others also. It can be given to authorities. It can be given to authorities. It can be given to others. It can be given to authorities like telephone department, electricity department, to others like for rent, premises taken on rent. For that, banks may keep giving a lot of security deposits. Okay, now a lot of security deposits. As the auditor, take the list, how many are given to authorities, how many are given to others. Take the list, take the supporting document, which are paid under which particular order or scheme or agreement or understanding. Have the documents, whether it looks justified, proper, appropriate, with proper, appropriate. If it's fine, it's good. We check deposit given to authorities and deposit given to others. Always keep in mind while checking, where are we supposed to get back the money? What is the due date? If the due date is yet to come, it's great. If some event is yet to happen, it's great. If due date has already passed or event has already occurred, and if the amount is not recovered, we should ask for the reasons and justifications and think about it again, whether we need to make provision or to write it off. Let's move ahead. Let's go to the capital and liability side. In capital, we have a very beautiful concept, and that is capital adequacy ratio, or you can call it CRAR, capital to risk adequacy ratio. What is this ratio? This ratio is what are the capital funds available with the bank divided by what are the risky assets into 100. So numerator is capital funds, denominator, you take assets, but you multiply assets with the risk weightage and then take the sum. So cash is having risk weightage of 0%, balance with RBI 0%, balance with other bank 20% is risky asset, and unsecured loans 100% risky assets, and so on. Weightage are specified by RBI itself. So it is total capital divided by risky assets into 100. Now guys, what is the importance of capital? If a bank is having capital funds, that means equity share capital reserves of say 100 crores, that means this bank owners can bear losses up to 100 crores and still there will be no default. Not a single rupee of others will be lost, will remain unpaid. It will be paid. So more is the capital funds, more is the loss absorbing capacity of any bank. So it shows capital fund shows loss absorbing capacity. And then denominator, risk weighted assets. This is risky asset. How much risk bank has taken? How much risk bank has taken? So that is risk weighted assets. Assets into percentage. In there is a weightage. We multiply that, it will become risk weighted assets. And then we have off balance sheet items like guarantees. We have guarantee, that's off balance sheet item. In that also we may have to pay some amount. Okay, so even that is considered. Now RBI, as per international norms, as per Basel norms, so Basel committee was an important committee which said that across the world banks should be safe and sound. If banks collapses, it not only affects that particular country but also affects international receipts and payments and international trust levels. So that important is bank. So for safety of bank, okay, they say that every bank should maintain 9% of capital adequacy ratio. 9%. Now how will you read this 9%? How will you read this 9%? Let's understand. 9% means, even if, suppose, I further, how we got this 9%? Suppose we have capital of 90 and risky asset of 1000 into 100. So these are our capital funds and these are our risk weighted assets. These are our risk weighted assets. Okay. Now, 9%. They want to say that there should be enough capital with the bank that even if they lose 9% of their risky assets, 9% of their risky assets, still bank will be able to absorb the losses and survive, and no loss will be transferred to depositors and other stakeholders in the bank. No loss will be transferred to them. So that much should be the capital. So because of this ratio, there's always enough capital to absorb the losses, and financial health of the bank is always good. Uh, they won't be collapsing because of any huge losses. Okay, so this ratio ensures enough capital, enough loss absorbing capacity. And further, it says that if you want to expand and take more and more risk, bring more and more capital. Expand, take more risk, give more loans, but bring more capital also. So that is how you should grow. Take risk, but you can take limited risk. You can take risk as per what your capital permits. If your capital is 90, you can take risk of 1000. So they have linked risk and capital together. So both need to grow together. More risky assets, more capital, and so on. So this is a very interesting ratio, capital to capital adequacy ratio, capital to risk weighted asset ratio, and it should be minimum 9%. If any bank is not maintaining this, license will be cancelled. Yes, they're very strict. License will be cancelled. Not just penalty, license will be cancelled. They will be out of the business. And they're giving further examples. Like if there's a secured, mind you, we have enough security. Secured loan up to 75 lakh, RBI says give risk weightage of 50%. And for those above 75 lakhs, it is 75%. And if it is a commercial loan, then it is 100% risk weightage. So they're explaining that how RBI changes the risk weightage depending on type of loan. Small housing loan, people generally don't default, money is recovered only 50%. Big housing loans, it is risk weightage 75%. Loan for commercial properties, 100% risk weightage. Now let's understand what goes in numerator. So there is a circular of RBI which explains what will go in capital funds. And in that circular, they have divided that circular in two parts. How capital will be calculated for Indian banks and how capital will be calculated for foreign banks. How it will be calculated for Indian banks and how for foreign banks. Basically, there is additional clarification, additional information with respect to foreign banks, how their capital will be calculated. Now, going further, if you go into capital of Indian banks, it is divided in two tiers. Tier 1 capital and tier 2 capital. Tier 1 capital is the highest quality capital. It can absorb losses effectively, easily, without any problem. Because this money, this is pure money of shareholders, equity share capital, and reserves. So this money is available. If loss happens, they will absorb the losses. They can absorb the losses easily without any problem. That is tier 1 capital. Okay. And then we have tier 2 capital. What is tier 2 capital? Now, tier 2 capital, when it comes to tier 2 capital, it is not a very high quality capital. It cannot absorb all the losses very easily. It's not very efficient in absorbing the losses because this money is payable to someone. So it is going to include like revaluation reserve after deducting 55%. You must have done this maybe in inter classes, deducting 55%, because the complete revaluation reserve may not come true. That much appreciation may not come true in practical life. Okay, so only limited portion is taken that, okay, this can absorb some losses. If tomorrow something goes wrong, this can absorb some losses. Then subordinated debt. Subordinated debt means debt which will be paid at the end. After all the debts are paid, at the end it will be paid. So subordinated debt will be paid at the end. That means once shareholders capital is over, they will bear all the losses. They will be getting money at last. That means all the money will be used to pay other debts and then its number will come. So that means even that is after capital, they are going to absorb losses. Okay, so it goes in tier 2 capital. It comes to, so we spoke about the ratio, its importance. Then we spoke about numerator, we spoke about denominator, and that's it. That's the ratio. That's the short note for the capital adequacy ratio. Now, Basel Committee is a very famous committee across the world, and their message was very simple. They wanted safe. They want safe bank across the world. When bank collapse, it affects nation, it affects international market also, because every bank nowadays is connected internationally. They are involved in some receivable or payable. So, was explain Basel norms, and to keep banks safe, to keep, their objective is to protect depositors and shareholders, to protect depositors and other stakeholders, and also take care of the shareholders. First comes depositors and then come shareholders. The way they do it is that they ask banks to maintain capital adequacy. If there's enough capital, then loss will be absorbed and people will not suffer losses. So explain what is Basel Committee, Basel norms. Right now, Basel 3 norms are going on. Then explain what is their objective. Then explain number 3. Then number 3, explain, first to explain Basel 3, then explain what is their objective, then explain capital adequacy. So these guys make norms. They make norms, and these norms will be very helpful for the countries to make regulations. Like RBI has made circulars based on these norms. It will be very helpful for making regulations at national level. To make regulations, they will be very helpful in supervising. We can supervise financial health of the banks with the help of capital adequacy ratio, and it will be also helpful to keep risk under control. All the banks can take risk, but they have to maintain 9%. By doing this, risky assets are under control. So a lot of benefits flow from this. Regulations flow from this, supervision flow from this, risk management flows from this. And because of this, banks always use capital in most efficient manner. They take calculated risk, proper risk. Okay. So ultimately, now again, that is what their objective is, to develop something so that banks can easily absorb the shocks and losses, to develop something with the help of which banks can be supervised, governed, risk management can be taken care of, and to develop something that banks continuously report their risk profile. Okay, this is our risk. There can be a short note on Basel 3, explain what it is, explain their objective, explain their capital adequacy requirement, its usefulness, and that's the ultimate aim these guys are having. That's the ultimate aim. Okay, that regulations can be framed easily. Now, there's again interesting concept after Basel 3 norms is stress testing. What is stress testing? So in this stress testing, we assume that adverse events happen. Ukraine Russia war will happen, it has already happened. China Taiwan war may happen, world war may happen, or some global warming impacts will happen. So in this stress testing, we assume that adverse economic events will happen, and in that scenario, will bank be able whether bank will be able to absorb the losses which will occur and still survive and pay all the depositors and lenders. So this is done in stress testing. It is mandatory for all commercial banks excluding RRBs, regional rural banks, LABs, that is local area banks. Foreign banks, when they come to India, open the branches, they are called LABs, local area banks. So it is mandatory for all the commercial banks. They need to have a system with the help of which they do stress testing. That they should have stress testing framework. It should be part of their risk management system, integrated into risk management system on a regular basis, periodical basis. They should assume that adverse economic events happen, and they should see what is the impact on the bank, how much losses they will have to bear, whether they will be able to absorb and still survive and continue without a problem. That's called stress testing. Now, audit of deposits is very simple, straightforward. So first opening. So during the year, randomly select some deposits. So in deposits, you will have savings account. You will have current account. Saving account is generally opened by individuals, HUF, and some approved institutions like trust and educational institute. Even they're approved. And current account is opened by companies, partnership firms, proprietors, proprietors doing business. They will be opening current account. Apart from that, recurring. Apart from this, okay. So these are very famous two deposits. Apart from this, there can be term deposits, FDs, term deposits. In that we have recurring deposits, etc. So randomly select few accounts which are open during the year, whether it's savings account and current account or other fixed deposits, etc. Take these accounts and then check whether KYC norms are properly followed, whether identity proof and address proof were taken, Aadhaar card was taken, to ensure that these are genuine customers. These are genuine customers and not the fake customers which will be used for money laundering. So do that first. Then, so check account opening, whether proper accounts are the explain types of accounts, who open them, and whether they're opened properly, and most importantly, KYC norms. Check it on sample basis. Then next, so savings account generally they will get low interest rate, and current account they won't get interest. To check whether savings accounts are paid properly, monthly or quarterly, as the case may be, as per the policy of the bank. Properly, their calculated interest is credited to them. And then also see about current account. Then also see current account, that generally no interest is paid on that. So ensure that no interest is paid. Then closing balance. Take the list of the accounts, check it through ledgers, whether closing balance tally. Take the list. We have deposit, take the list, take the breakup, take the list, whether it matches with the ledger. Then also go for the confirmation process. Bank auditor should go for confirmation process and ensure that this is the balance which is outstanding and customers are not having any issue with it. So confirm the balances. Then when it comes to disclosure, we know disclosure. Now, current accounts, if they are having current accounts, they will be generally having credit balance. So it's like deposits, it's a liability. But sometimes people overdraw their current accounts, it becomes debit balance. Now, overdraft is not a deposit. Overdraft is a kind of a short-term loan given. It should be shown in deposits. First talk about opening, then talk about interest, then talk about how to check balances, then it's disclosures, and then very interesting inoperative account. Now, this can come, this can come in exams, inoperative accounts. Now, what is this? What is this inoperative accounts? Now, accounts where there are no transaction or past over 2 years, they become inoperative accounts. Okay. Now, these are very high risk accounts. There are very high chances that fraud may happen. Employees and other people which are connected to the account who are aware about it, they will know that no transaction is happening. So they may misuse the opportunity to withdraw money from this. So if there is a sudden decrease in inoperative account balances, it should be checked carefully. Maybe someone has without proper authorization withdraw the money. Someone has done something wrong. This account can be used for illegal transactions. Transaction may be passed through these accounts. Okay, so they should be carefully. Auditor should see what are the inoperative accounts and what is the change in the balance, what are the transaction which has happened here. Maybe it may happen. Then it should be checked that it is revived or closed. We should check what has happened subsequently, whether it was revived, whether it is revived for proper permission. So if account is inoperative and if you want to do if you want to do any transaction, there will be revival process. Bank will find out who wants to perform transaction, why wants to perform transaction, is the person genuine and real and the real owner of the account. So revival should be done or it should be closed with proper procedure and proper authorization. So if you talk about these things, about opening, about then after opening interest, so this is what happened in sequence. First happens opening, then happens interest, then happens closing, then happens disclosure, then we talk about inoperative. And that 2-year criteria is extremely important. Term deposits. You talk about different types of term deposits. So FD is a very, very popular type of term deposit, fixed deposit, where customer comes, gives money, 1 lakh, 2 lakh, 3 lakhs, decides the tenure, and then we have the interest rate. This interest rate will be there will be interest rate, and after the end of the term, customer will get money along with the interest. So that is FD. Then there is a concept of recurring deposit. Recurring deposit. In this, of every month or every quarter, money will be a fixed amount. Generally, a fixed amount of money will be deposited. So continuously, money will be deposited. Deposit will keep growing. And along with that they will also get the interest, and then after some years it will mature and money can be withdrawn. Then there's one more thing, cash certificate. So some people are not aware about cash certificate. What is cash certificate? So suppose there's a cash certificate of 1 lakh. Customer doesn't have to pay 1 lakh. He has to pay initially only 20,000, and then he is given the dates that you have to pay more money, say about more money up to 75,000 for so many months or quarters or years as the case may be. And after so much time, you will get back 1 lakh. So in cash certificate, they have to pay certain amount of money over a certain period of time, and interest will get accumulated, and they will get full value of the cash certificate on maturity. So if cash certificate is of 1 lakh, they will get 1 lakh at maturity. If it is of 5 lakhs, they'll get 5 lakhs at maturity. First, explain that different types of deposits. There's a fixed deposits. Then we have recurring deposits. Then we have cash certificate. Okay, first explain that. So once you explain different types of deposit, then again opening. Ensure that there's a proper internal control system to make fixed deposits, to make recurring deposits, to make cash certificates. And this should include a very important control, that deposit receipts, when FD is made, FD receipt is given, cash certificate is given. In case of recurring deposit, a recurring deposit passbook may be given. It should be serially numbered. It should be serially numbered so that none of the deposit receipts, cash certificates, or recurring deposit passbook is any of these goes unaccounted. It should be serially numbered. So check while opening proper systems, is it serially numbered, and there should be dedicated registers where all the details should be there. If they are bulk deposit 2 crore and above, when we call, what we call bulk deposit, if it's 2 crore and above, 2 crore and above, okay, then careful, the terms change. Generally for bulk deposit, terms change. Interest rate may change, tenure may change, there will be more facilities. See that there are different terms which are applied to them, okay, especially interest rate. First talk about types, then talk about opening of these deposits, then talk about interest. Check whether interest is credited to these accounts on a regular basis. On regular basis, proper interest on sample basis, check that. On maturity, check whether proper payment is done and the deposits are closed and the certificates are cancelled. Okay. If there is a early, if there is a if there is a early uh, withdrawal of money, if there is early withdrawal, if there is withdrawal of money before tenure ends, that means they're breaking the FD, breaking the cash certificate or recurring deposit, then there will be a foreclosure penalty. That means early payment penalty will be there. We need to check that early payment penalty. So we're talking about savings account, current account, talking about deposits. Okay. Now, deposit designated in foreign currency. Non-residents can open a foreign currency account with the Indian banks as per RBI directions. Yes, they can come to India, select a bank, open foreign currency non-resident account, deposit their foreign earnings, dollars, pounds, whatever they have. They don't need to convert it into Indian rupees. Keep it safe here for whatever duration you want to, and you can withdraw this money whenever you want to. That is foreign currency non-resident accounts. So first explain the meaning, explain that it should be as per RBI directions, debit, credits, and the amount should be as per RBI directions. When it comes to accounting, now bank needs to do accounting. In books of banks, everything is in rupees. So this FCNR needs to get converted. Needs to get converted. They should be converted at proper balance. Their opening balances, transactions, closing balances should be converted at proper exchange rate. If there is a difference, resultant increase or decrease in balance should be taken to PNL. So first explain the concept as per RBI direction, then explain debit credits will happen as per RBI direction, then talk about interest. They should be paid interest on the basis of 360 days in a year. 360 days in a year, not 365, 360 days in a year. Then talk about how accounting will happen, conversion, and the profit loss will be treated. They are giving more and more knowledge. Now, again, we have very interesting NRE and NRO account. Non-resident external account, non-resident external account, and non-resident ordinary account. So now we have FCNR is a type of account. There are more types of account, NRE and NRO. What is this? So now NRI can open NRE or NRO account with Indian banks. Now these are generally in foreign currency only. Again, they are in foreign currency. So FCNR, okay. See, so these are also in foreign currency. So you will ask, what is difference? FCNR is generally in the form of fixed deposit. So see, just like we have FD, we have current account, savings account. So FD and accounts are different. On the same lines, FCNR, foreign currency non-resident, it is a foreign currency term deposit of 1 year, 2 year, 3 year, 4 year, or 5 years generally. Okay. And NRE, NRO are regular accounts. So again, NRI has option. He can open FCNR account and make deposits, fixed deposits in foreign currency in FCNR account. Or he can open NRE and NRO. NRE is for foreign earnings. So if NRI is earning outside India in foreign currency, he can come and deposit that in Axis Bank's NRE, non-resident external account. Okay, this will be completely tax free. This income is earned outside India, so this will be completely tax free. And whenever NRI wants, can withdraw the money and repatriate it back to the foreign countries. No issues, no problem at all. This money has been earned outside India, only deposited in India, and that's good for India in general. They get forex reserves. Okay, they get foreign reserves. So, and it's not taxable, and you can repatriate, take it back completely as you want. When it comes to NRO, non-resident ordinary account, when NRIs earn income in India, that is deposited in non-NRO account. Now, specialty of now this little extra I'm telling, specialty of NRO account is it can be in foreign currency also, and it can be in Indian currency also, because Indian earnings are deposited there. Okay, and definitely tax will be applicable on this earnings. Tax will be applicable. Only interest component is repatriable. Other components can be repatriated up to a limit. So there's a $1 million limit you can repatriate to foreign countries. These are different types of foreign currency account. There is FCNR, there is NRE, there is NRO. So fixed deposit in foreign currency, there is FCNR. Regular banking transaction, NRE, NRO. For foreign currency, it is NRE. For Indian earnings, it is NRO. And different rules and regulations. So there are RBI guidelines. Simply just ensure RBI guidelines are followed and explain more about NRE, NRO. In general, this is very interesting. So they first explain audit of deposits, then they explain about term deposits, then they go for foreign currency deposits, FCNR, NRE, NRO. In general, they say that ensure that deposits are not inflated. And they're giving a beautiful example. They say that banks may do this. Banks have target to increase deposit to a particular level, their advances to a particular level. So what they may do, they may give 50 crore to Mr. A. 50 crore to Mr. A as a term loan. This Mr. A will make deposit of 50 crore in the bank. So they are giving him loan and he's making the deposit. So practically money is still with the bank. It has gone, it has come back. But advances also increased and deposit also increased. Both are inflated. Okay, this is window dressing, this is manipulation, artificially increasing the advance balance also and then deposit balance also. Further, on the basis of FD which he has made, he can take more loans. He can take more loans. So again, advance will increase. And on the basis of that money, he can make more deposits and the cycle can continue. Banks can very easily inflate their advances and deposits through this circular working. And achieve their advance target, achieve their deposit target, and tell to the world that they're working hard, they're achieving so much. That is manipulation, window dressing. We need to check it carefully. Then accrued interest, interest which is accrued right now, not payable. It should never be shown with the deposits. It should go in other liabilities and provision. Accrued interest, because that is not due, that is not payable right now. It will create confusion in the mind of the depositors. So never show it there. Borrowings. First thing is simple. You first explain what is money at short notice, money at call, and money at short notice. When you borrow money for a single day, for overnight purpose, this generally happens. See, banks cannot say no to anyone. If customers come, they have to make payment. They cannot say we'll pay tomorrow or day after tomorrow. That cannot happen. So in any banking system on daily basis, there will be some banks, there is a shortfall of 10,000 crore. There's some banks, there's a surplus of 10,000 crores. So they do 1 day borrowing. So these guys, they go for 1 day borrowing and 1 day investing. Yeah, 1 day borrowing, 1 day lending is very common in banking system. So when you borrow money for a single day for overnight purpose, it's called money at call. And when you borrow money up to 14 days, not single day, but more than 1 day, but up to 14 days, it's called money at short notice. Generally, this happens at head office level, but if branch is authorized, it may happen at branch level also. Let's explain in general what is the meaning, what is the location, then talk. For any borrowing to happen, to start, to initiate, a proper authorization is required. And bank's authorization matrix explains what kind of authorization, who can do it. So ensure that proper authorization is done. At the time of authorization, they also mention what kind of interest rate, terms and conditions should be there. Ensure that same terms and conditions and rate are there. First, in any borrowing, explain important types of borrowings which they discussed here. Then explain that how important is to have authorization matrix and how approval should happen as per that. So first, for all the borrowings we are having, you should randomly select and check whether proper authorization was there. Then you should check documents. There should be supporting documents, like there should be correspondences, there should be correspondences, there should be agreement, the supporting document should be there. They should be properly classified. See, classified as secured versus unsecured, depending on whether we have given security or not. Then next is rediscount versus refinance. Now, what is this rediscount versus refinance? Very interesting again. Suppose you are having a bill of exchange. You are having a bill. You are having a bill, and you are selling this bill. You are selling this, but you are selling this particular bill. Okay, that's called rediscounting. When you sell a bill, you are raising money, but that will not appear as a borrowing. That will not appear as a borrowing because you are selling your asset. You are raising money by selling your asset. Okay, so rediscounting is a type of raising finance, but in the process you are selling the bill, so it's not going to appear as a borrowing in balance sheet. But refinance, when existing loan is repaid by another new loan, that's refinance. Refinance will definitely appear as a borrowing in balance sheet. External confirmation, at the end, see what are the balances and get external confirmation as per SA 505 and ensure that these are the only outstanding borrowings. These are the important terms and conditions. We're talking about audit of borrowings, explain the types, explain authorization, then explain documents, then you can explain interest maybe if required, then end closing and external confirmation. Again, it's in a flow, it's a beautiful flow process. When we talk about when we talk about other liabilities and provisions, okay, so there's very interesting bills payable. Very interesting bills payable. Okay, now what is this uh, bills payable for a bank? When bank has obligation to pay people, it becomes bills payable. When that obligation arises, first explain meaning types. When bank takes money and issues demand draft, it becomes their obligation to pay this amount. When they take money and issue traveler's check, so traveler's check is a document which a customer can go to foreign country, show to foreign banks and get money. They will get the money and foreign banks will recover money from the Indian banks. So when bank take money and give DD, it's obligation of the bank to pay. When they issue traveler's check, it will be obligation to pay to foreign banks whenever the money is withdrawn. Then mail transfers. People give money and give instruction that you send this money immediately to so and so city, so and so account. So that's a very popular money order. Money order in post office, it used to happen that you want to send money at your hometown. There was a very famous money order that you will say that okay, there's a money order of 1000 simply from Mumbai. Money order is booked, and Calcutta, you go to post office. At post office, you'll get 1000 rupees. 1000 rupees. So instruction money is received in Mumbai and payment is done at Kolkata. So again, that's a bills payable. So first explain bills payable means there's an obligation to pay. It can happen when banks issue DD, when banks issue traveler's check, or when bank makes mail transfers, telegraphic transfers, where there's obligation again to pay people. Okay, so first explain what is the meaning. Then after explaining the meaning, you explain the meaning, explain internal control system. So whenever banks issue these DDs or traveler's checks or they go for mail transfers, there should be standard procedure to do it. There should be proper form in which they should apply. There should be proper form in which DDs are given, traveler's checks are given, or acknowledgement of mail transfers are given, or mail transfers are given. There should be proper format in which it should be done. And whenever it should be done, there should be proper signature. When it comes to mail transfers, telegraphic transfer, there should be private secret code. Only few people know how to decode it. Okay, so when it comes to internal control systems, there should be proper forms to make applications, then proper format in which these documents will be issued, proper format in which mail will be sent, telegram will be sent. There should be signatures, there should be signature specimen, there should be signature, there should be signature specimen book at all the branches where they can verify whether the signature is genuine or not, whether the proper person has signed or not. There should be private code. Suppose Mumbai branch wants to send a message that pay so and so person so and so rupees. They will have to or credit so and so person's account. So there should be secret codes. With the help of that codes, instruction should be sent and executed. Okay, these codes should be secret. Otherwise, anyone will send instruction from Mumbai, pay so and so person so and so so much. So miscommunication should not happen, and unauthorized people should not send the communication. Unauthorized communication should not happen. So there are private reliable codes. So explain the meaning, explain system, explain that there will be standard forms. Okay, unused forms should be kept in proper safe custody. Explain about signatures, reliable private codes. Okay, and whenever receiving branch does anything like this, receiving branch issues DD or issues traveler's check, or they take the accept telegraphic transfer, they should intimate paying branch that we have accepted so and so thing, we have issued so and so document. Whenever paying branch pays the DD or pays the traveler check, or they traveler's check, or they make the telegraphic transfer payments, they should intimate debit advice. So when we intimate each other, that's nothing but advice. That's called advice. Okay. Now, and when multiple branches are involved, we know that there's an inter-branch account through which these transactions will be executed. It should get nullified. If there are old outstanding entries, if they are pending, then you should go and inquire why they are pending. They should be reconciled. They should get knocked off. They should be reconciled. If not, what is the reason? Large value, why they are not knocked off? Okay, there should be correspondence about it. Why it doesn't match? Like for example, sometimes payments are made without advice. Sir, what do you mean by that? There's a paying branch. They saw a DD. DD looks genuine. There's a proper paper, semi-legal paper, the proper name, the proper signatures. There's everything in proper format. But DD number here and DD number in the system where they get intimation, it doesn't tally with each other. They have to pay without advice. Sometimes they have to pay. They cannot say no to the customer. You will get all the details. They will confirm properly and make the payments without advice. Then they will follow up with the receiving branch. Listen, why we are not having the intimation? We have paid the DD. Why there is no intimation? What is the mistake you have done? Whether you have done mistake in the DD number or the amount or the party or the location, whatever it is, rectified so that we can knock off these transactions. If there are large value items, we should be inquiring. And debit balance, we think about provision and write off. So explain what comes in bill payable, explain internal control systems, explain what should come in internal control system, 4 things. Then how intimation should happen, how outstanding item should be dealt with, and finally provision if required. If inter-office adjustment is in credit, it should be shown in other liabilities. If it is in debit, it should be shown in other assets. Interest accrued should never come along with the deposits and borrowings. It should be shown separately under other liabilities. It should be never shown along with the deposits or borrowings. Otherwise, there will be miscommunication because this amount is not yet payable. Contingent liability. Contingent liabilities. Now, what are the famous contingent liability? So we have arranged that in a sequence. Most famous contingent liability for bank is it arises because of guarantees given on behalf of constituents, that is nothing but customers in India or outside India. That's most popular. Then when they sign bill of exchange on behalf of their customers, so acceptances, endorsements, and other obligation, LCs, letter of credit, will come in other obligations. Letter of comfort, sometimes they promise that if required they will give loan to their customers. So letter of comforts, that is other obligation. Then if they're having partly paid investments, so call can come and they will have to pay for the call. Again, that is considered contingent liability here. Then I know that uh, as per the okay, as per schedule 3, now this goes in commitments, liability for partly paid investments. So if they partly, but then here in bank it is still in contingent liability. Then if they have signed for forward exchange contract, foreign currency forward exchange contract, okay, forward contracts, because of that And they do that because they need foreign currency on regular basis. So they enter into foreign currency forward contracts, and in that the profit loss may arise, receivable payable may arise, so it can lead to contingent liability. Then there are many people, they can be depositors, there can be customers, there can be employees, their unions asking for money, but it is not yet recognized as debt in the books of accounts, so it becomes contingent liability and other items. So most popular is guarantees, then acceptance, endorsement, other obligation, then after that partly paid investments, then after that foreign exchange forward contracts, then claims not acknowledged as debts and other items. And in footnote, they also talk about bills for collection. Let's see audit procedures one by one. Let's see. So first is audit procedure for overall contingent liability. Primary concern. Primary concern is simple, straightforward. We is very simple, straightforward, that auditor wants to check whether all the contingent liabilities are identified and disclosed in notes to accounts, and are they disclosed at proper valuation. Two things: that none of the contingent liabilities should be left out, and it should be shown at proper value. So these are the primary concerns. Okay. Now, for this, he's going to check a lot of documents. He's going to check all the types of different guarantees issued, bill of exchanges signed, comfort letters, etc. All the type of documents which are issued from banks, and he should check whether they are properly shown as contingent liability or not. Okay. Now, for all the contingent liabilities which are appearing in balance sheet, he's going to select few of them and check whether these contingent liabilities are, whether he's going to check whether these guarantees, bill of exchange, etc., these off balance sheet items are issued to regular constituent customers. Banks generally issues guarantee, letter of credit, etc., for their regular customers whom they know properly. They know that they have good business, there are regular receipts and payments, regular repayments of the loans, and they have financial muscle and strength, and we can issue guarantee for them, letter of credit for them. They generally do it for them. If anyone else comes to them for guarantee other than their regular customers, they will talk to their bankers and financial institution that how good is their financial health, what is their net worth, net assets, what the profits, turnover, will they be able to pay these amount for which they are taking the guarantee, and so on. So first thing, so first, as you said, we are interested where everything is identified and disclosed at proper value. Then we randomly select some content liabilities and check are they given to proper customers. Then authorization is important, whether it is authorized by proper person. Authorization, this content live, it should be this again authority matrix, who can authorize guarantees and letter of credits and comfort letters, whether proper person has done that. Terms and conditions should be as per the master circular of RBI on guarantees and co-acceptances, etc. On letter of credit, terms and conditions should be as per RBI circulars. RBI specifies what should be the tenure, what should be the amount, what should be the commission, etc. Then accounting. See, when it comes to contingent liability, accounting is not done in books of accounts, but definitely records are kept. Proper record should be kept uh, for all the content library. There should be proper registers, proper document for each and everything. And you can also maintain account, dummy account. So in Inter, you must have studied AEO, acceptances, endorsement, another oblique, AEO asset account and AEO liability. These are dummy accounts. For every letter of credit you issue, you debit AEO asset, credit AEO liability. So you keep doing that, and you will know that how much letter of credits or guarantees you have issued. And as they as these guarantees come to an end, reverse the entry: liability account debit, asset account credit. So sometimes accounting is done, they are memorandum accounts, they are dummy accounts only for information. Moment you start issuing these LCs and guarantees, debit credit, debit credit, debit credit, if the balance is 25 crore, we know that they are 25 crore content liability, and whenever they get over, reverse the entries. So by doing this, you will keep track of what is the actual amount of contingent liability on the bank. End of the year, obtain confirmation. Go and ask the third party that these are the only The substantive tests for completeness and existence go and ask for a confirmations, that these confirmation procedures include substantive testing. Go and see documents and confirmation procedures that these are the only outstanding contingent liabilities, guarantees, and letter of credits. Reasonableness, compare with the with previous year, and see whether the amount is reasonableness acceptable. Special point, comfort letters. So comfort letter is a kind of a promise. Comfort letter. Comfort letter is a kind of a promise, kind of a promise, kind of promise which is given to third parties that, listen, these are our customers. He's a good person, good financial health. If ever they need money while doing the project, we promise to give loan. It's a promise to give loan. We need to study comfort letter wordings and promises carefully, whether it is just a assurance letter or bank is under real obligation to give money. If they're in real obligation to give money, it will be shown as other obligation contingent liability, or it is only a assurance letter or simply a supporting letter. Only you can say you are simply comforting other. You are not promised to pay. You are simply comforting and not promised to pay. Then no need to show it. We need to study the wordings carefully. Guarantee in respect of trade credit. See, trade credit can be of two types. Generally, what happens? Importer. We have an importer. Importer needs money to make payments. And he can get this money in two ways. Either a foreign bank or financial institution. He can take money from foreign bank and financial institution to make the payments. That's called buyer's credit. That is called as buyer's credit. Or so he himself is going to banks and getting it arranged. Or exporter himself may give the credit. That means loan. That is called seller's credit. So importers need money to do import. That's called trade credit. And there can be from the foreign banks, it will be called buyer's credit. It can be from exporter himself. It's called seller's credit. But these guys will give loan only when they get guarantee. They get guarantee for that. So guarantees are many times issued for the trade credit. It can be buyer's credit or seller's credit. Both can be there. The tenure of the guarantee and tenure of the credit should match with each other. If loan is of 2 years, guarantee should be for 2 years. If it's for 3 years, it should be for 3 years. It should match. So these are the general points. First, you go for primary concern, then you select few of them with a regular customer, or there's authorization, terms and conditions are proper, records are proper, substantive procedure confirmation is proper, reasonableness, and then special points, comfort letter, and guarantee for trade credit. Then written representation for contingent liability. Written representation. So as an auditor, we should ask written representation from management, that you give it in writing on letterhead that, number one, while issuing guarantees, LCs, or bills of exchange, we have followed all the procedure. We have followed bank's policy and procedures systematically. It is in tune with the standard procedure. Number two, each and every contingent liability is supported with documents. There are documents to prove how it was initiated, how it was authorized, approved, and how it exists as on today. We have maintained proper records. We have maintained proper registers, proper account where the proper records are there for the contingent liability. You give it in writing to us. Give it in writing to us that proper procedures were followed. You give it in writing to us that it is supported by documents. Give it in writing to us that is properly accounted. Okay. Then give it in writing that it is properly disclosed in notes to account. These are the sequence in which things happen. First, assure us about the procedures, then documents, then accounting, then disclosure. Then assure us further that contingent liability which have crystallized into liability, which has become actual liability, actual loss expense have happened, and it's liability of the bank to pay it. It is not shown in contingent liability. If sometimes we have to pay, but we are not aware about the exact amount, in that case, provision should be made as per AS 29. Best estimate, best possible, best estimate. Realistically, how much we'll have to pay, that estimate should be made, proper provision should be made for that. If there's a guarantee on behalf of directors of the bank, then bank should collect enough resources from the directors, so that money has to be paid from their resources and not bank's resources. As such, we cannot banks cannot give loans and advances to directors. It is prohibited under section 20. If the chances of payment are remote possibility that payment will come, obligation will come, is remote, it should not be shown even as contingent liability. It should not be shown in notes to accounts. So written representation, you confirm all these things. There can be a question. Each and everything we are studying is from module. Okay. Then claims against the bank not acknowledged as debt. Claims against the bank not acknowledged as debt. Take list of such claims. There, so it can be because of customers, it can be because of employees, it can be because of trade unions. So see the correspondence with respect to that. There can be some correspondence, there can be claim from the people, there can be communication from the unions. See supporting documents, how much money they're asking for and how much we have shown. Then go and read minutes of board of directors. Understand in minutes what they're discussing, what they think is the realistic amount, how to tackle this realistic amount that may be required to be paid. Okay, see these minutes, contracts, agreements, arrangement, how much we'll have to pay. See it carefully. So if people are claiming money, go and see relevant evidence. It can be correspondences, it can be communications, it can be minutes, it can be agreements, arrangements, how much money need to be paid, legal cases. Okay, that will give you idea about the amount. Then understand the status. What is the present status right now? The dispute is going on, where it's going on, what is the status? Are we supposed to pay money? What is the probability? And what is the amount we are supposed to pay? Subsequent events. See events which are happening after balance sheet date, whether the money payable is increasing or decreasing, and what are the effect on the probability, and make the changes accordingly. So see correspondence and basic documents. Go and see important documents like minutes, contracts, agreements, arrangements. Then go and see the status, subsequent effect of subsequent event. We will be able to check whether the contingent liability claims against the bank not acknowledged as debt, it is shown as proper amount. Forward exchange contract. Explain. Banks deal in a lot of foreign currencies, and they need foreign currency on continuous basis, and their receivable payables in foreign currency. For the purpose of hedging, they may enter into forward exchange foreign currency forward exchange contract. It's a very common thing to enter into forward exchange contracts. Very common thing. Okay, so see how they keep record of foreign exchange contracts, how they keep complete record of foreign contracts, where there's a register, manual records or computerized records. See that will be useful information to understand how many contracts are pending and how much amount is payable is payable on them, how much should be shown as contingent liability. Okay, when you are seeing the registers, records and documents, you may also come across options and interest rate swaps. Okay, even they can lead to contingent liability. Forward contracts are derivatives, options are derivatives, interest rate swaps are derivatives. All of them can lead to contingent liability. Guarantees given in behalf of constituents. We all know customers. How to check them? You can simply repeat what we have studied about contingent liability, or they are on same lines. Whether there's a proper internal control system for issuing guarantees to the customers, whether there's a proper proposal which comes up, after proposal it's properly evaluated about credit worthiness, okay, with the proper internal control system framed for issuing guarantees, whether proper security is received and from security margin is deducted before issuing guarantees, letter of comforts, etc. Whether proper sanction, the first internal control system should be there, security should be received, proper margins, then sanction should be as per proper limits. Unused guarantee form should be kept in a custody of reliable person, otherwise it may get misused. Once guarantee is issued, proper register should be maintained. Uh, in guarantees, expired guarantees should not be covered. If guarantee tenure has been over, it should not be covered. All outstanding guarantee should come. If it should not come. Okay. If there is a if it has not expired, it should definitely come. If you're not sure about the amount, make the best estimate as per AS 29. So these, see, in majority of cases, just imagine the things from start till end. If you imagine things from start till end, automatically a flow will be created. Acceptance endorsement obligation, same as above, no need to study it again. On the same lines, acceptance endorsement obligation is the thing, but again, signing bill of exchange is like a guarantee. Okay, on same lines, bills for collection. First explain the concept of bills for collection. So what is, first explain the concept of bills for collection. So customers give bill so that it can be presented to people who may be in the other city. Money will be collected and credited to their account, and for this, bank is going to charge commission. That's bill for collection. So there will be list of bills of collection. Okay, bills for collection, and you want to check these bills. Now the bank which receives the bill for collection and then they send it to other branches, for them it is outward bill of collection. So every bill of collection, if it is genuine, it should appear in outward bills of the receiving branch. For all bills of collection, they will specify who was the receiving branch and which branch is for which branch it was outward bills of collection, for which branch it is inward collection. If it is outward for someone, it should appear in the outward bills for collection register. It is inward for someone, physical copy should be with them. Then check whether subsequently collection is made or not. If collection is made, it proves bills for collection is genuine. If connection is not there, uh, okay, uh, if it's not there, it will get lapsed. Fine, but then it is, there should be proof that it got lapsed. The internal control system should be strict. How bill will be presented, how money will be collected, how it will be credited, how commission will be charged. It should be specified. Internal control system. No income should be booked for outstanding bills for collection. It is different from bill purchased. There is no accrued income over it. So first, explain bills for collection. Explain there is outward for one branch, inward for one branch. Explain it should appear in outward register. Explain it should appear in inward register, and physical copy should be there. You should see whether the physical copies are there. Check randomly and check subsequently what has happened. Whether subsequently what has happened, whether the money was collected and deposited in the customer's account, proper system for doing that was followed. If yes, it proves existence, that's very important. And if it's not, again, if it's not, it is not realized, correct, even there should be proper proof for that. Commission should be charged. And lastly, no income on outstanding bills for collection. When one branch issues bill to another branch, they are drawing bills on each other. That is not bill for collection. Okay, that is not, that is inter branch transactions. That is not bill for collection for sure. Now let's see concurrent audit. Let's first understand what do you mean by concurrent audit. Bank is a very important organization, and crores of people are dependent on it. So banks should not collapse. They should be financially sound. And keeping this in mind, different types of audits are planned with respect to bank. Number one is a financial statement audit, which is also called as statutory audit because it is mandatory as per law, which is also called as external audit. Then next, internal audit. See, in financial statement audit, external audit focus is financial statements, whether they give true and fair view. In internal audit, focus is completely on internal control systems, whether systems are designed properly, are they operating properly, what are the deficiencies, how to improve them. That is the focus. Then we have concurrent audit. Concurrent audit means checking transactions simultaneously as they happen with minimum gap. So it can be on daily basis, it can be on weekly basis or monthly basis. So simultaneously checking all the checking deposits received, loan given, investments, foreign currency transactions, and so on. Simultaneously checking things, so that if anything goes wrong, it is identified at the earliest and corrective action is taken. And then in branches where concurrent audit is not done, bank can think about revenue audit, that at least check revenue transactions. If not, mini department, at least revenue transactions. So there is a statutory audit, there is an internal audit, there is a concurrent audit, and there is a revenue audit. Apart from this, there is a stock audit that sometimes banks appoint CA firms to go and check stock and debtors which are there at the borrower's organization, borrower's location, and that is stock audit. So many audits are connected to bank. We should be thankful to bank for a lot of work which is generated for chartered accountants. So now we know meaning that simultaneously, continuously, concurrently checking transactions which are happening, that is concurrent audit. In no way it is a preparation for the main audit. You cannot call it as a pre-audit or base for the statutory audit. No, not at all. Both are different independent activities with different objectives altogether. In concurrent audit, major focus is whether the transactions, deposits received, investments done, loans given, foreign currency transactions, are these as per policy of the bank? Are these as per the internal control system which is designed by the bank? Whether everything is as per the book. That is the main objective, and they are going to comment upon the same. Whether the standard policies and procedures are followed or not. That's it. They are no one to question decision making. They are only going to see whether systems are followed or not. That's it. It is applicable to public as well as private sector bank. It can be done by internal inspection staff. Yes, there can be internal staff of the bank doing concurrent audit, or it can be done by a CA firm, external CA firm. Both the options are available. Generally, people go for external CA firm because that is cost effective and better quality. If you are going to employ people, you are going to increase a lot of cost. So instead of doing that, simply outsource the work. That is going to be cost effective. And CA firms are expert. In less time, they'll be doing better job. So as I said, people prefer it. Now, scope of concurrent audit. We know about scope. Scope generally means coverage. So what concurrent auditor is going to cover, what departments and what functions of the bank it is going to cover. That is scope. It means coverage. It also means what kind of examination procedure it will be performed. Here it only means coverage. Concurrent auditor, what departments and functions concurrent auditor is going to cover. That depends on bank's inspection and audit department. So there's an inspection and audit department which looks after complete audit function of the bank under the guidance of supervision of audit committee of board of directors. So they say ACB, audit committee of board of directors. So scope of concurrent auditor will be decided by inspection and audit department. Inspection and audit department under the consultation and supervision of audit committee. Generally, they are going to target high risk transactions. Like foreign currency transactions are high risk transactions, and large transactions and balances. So wherever there is a high risk or volume wise something is very big, concurrent generally banks will plan that concurrent audit should happen, and it should cover high risk transactions, high risk areas, and large volume areas. So the objective is pretty simple and straightforward. Scope will be decided by these guys, inspection and audit department in consultation with audit committee, and they will be focusing on covering high risk areas and covering large volume areas. As per guidelines of RBI, they have explained what kind of areas can be covered. So the shortcut is A, B, C, D, E, F, G, H, I. A to I is the shortcut. A to I is the shortcut, but remember to exclude B, E, G. A for advances, B is blank. C for cash, D for deposit, E is blank. F for foreign exchange, G is blank. H for housekeeping and investments. So these are the popular areas which will be covered by concurrent auditors. That will be advances. There will be advances, cash balance, foreign exchange transactions, housekeeping, investments. When we talk about housekeeping, okay, it doesn't mean cleanliness. Okay, don't think about hotels housekeeping department. Housekeeping simply means here we're going to discuss it. Okay, we'll come there, we'll see there. So that scope simply explain who decides it, generally what they cover, and what RBI guidelines say. Now, type of activities to be covered. Listen, guys, we have just discussed which areas can be covered by concurrent auditors, which function, which department can be covered. There's so many things which are generally covered by concurrent auditor. In module, they have taken things one by one and discussed what audit procedures concurrent auditor can apply. See, all these items we study in the other part of the chapter. Like advances, we have already seen what kind of test of control substantive procedures can be done. Okay. So, and cash, we are going to study. Doesn't make sense to again study the audit procedures. It is a mere repetition. So we have removed it. We have not considered it. So when it comes to how to perform concurrent audit, simply explain the same audit procedures which we study in general. I have covered only two areas: foreign exchange transactions and housekeeping, because they are relatively new, something different, better to understand. Now let's discuss housekeeping. Here, housekeeping in bank, it simply means whether all the registers and records are maintained properly. Whether registers and records, they are under proper physical security, they are secured, they should be kept in such a manner that they should not be spoiled, there should be proper opening balances, it should be ensured that all the transactions are posted, are recorded and then posted in it. Proper balancing should be done. After balancing, proper transfer should be done in other records. On regular basis, you should reconcile them with the control accounts. I hope you remember what is control account. We have studied this earlier, that control accounts are generally accounts. Control accounts are accounts which represent some particular type of accounts. Like we have studied that we can split ledger in three parts. So this is general ledger, this is debtors ledger, creditor ledger. Debtor ledger will have all the debtors at one place, account of all the customers. Creditor ledger is going to have list all the suppliers. Then we have general ledger. Now, ledger is split in three parts. General ledger will not tally because it is not having debtors account and it is not having creditors account. To fill this gap, we make DLA and CLA. DLA is debtor ledger adjustment account. It simply represents total debtors. Every month end, entries are passed in debtor ledger adjustment account on totality basis. All the credit sale debit, all the receipts credit, all the discounts credit, all the bad debts credit, and so on. So accounting is done in DLA on monthly basis on the base of total data. Same is CLA. It represents creditors. And accounting is done on monthly basis. Now listen guys, we have ledger is split in three parts. General ledger is not going to tally because there are no debtors accounts, no creditors account. To compensate this, we created DLA and CLA. DLA represent total debtors, CLA represent total creditors. Now, if we add these two accounts to general ledger, now trial balance of general ledger will tally in itself and we'll be able to find out whether the ledger is accurate or not, whether accounting is accurate or not. So basically, DLA and CLA are dummy accounts which are created. Dummy accounts which are created to ensure that general ledger tallies. Okay, and DLA will match with debtors ledger, CLA which match with creditors ledger. So housekeeping department also ensures that things reconcile, things match, like DLA should match with DL, CLA which match with CL. They ensure that things reconcile. Also, they ensure that temporary accounts like inter-branch adjustment account, suspense account, sundry deposit account, DDR, direct debit request account, draft account, all these should get nullified over a period of time. Okay. So housekeeping function is very important to ensure proper registers, records, ledgers are maintained as per the requirement of the system, and they are having physical safety and security, they are not spoiled. Then opening balance are properly posted, transactions are properly posted, arithmetical accuracy is done, balancing is proper. After balancing they are transferred, balances are reconciled with the control accounts, temporary accounts like interbank adjustment, suspense, sundry deposits, etc., they should get nullified. uh, this is they should get nullified. If they are not, why it is not happening, it should be discussed. And wherever we find difference, adjustment entry should be passed. Now this is what is the function of the housekeeping. This is what housekeeping is. So concurrent auditor is going to check whether the housekeeping of the records is done properly or not, whether the records are properly created and maintained, to ensure that we keep getting continuous information without any problem. So in foreign exchange transaction, we are going to study later. Let's talk about appointment of concurrent auditor. It is at discretion of the bank. If they want, concurrent can be done by the own staff, or it can be done by external auditors, external CA firm. If it's own official, they should ensure they have adequate staff and it is well qualified and experienced staff. They should be well qualified, experienced staff. They should be properly trained. They should be properly trained also. That is own officials. Otherwise, you have an option that you can outsource this work. You can give this work to external CA firm. Generally, it is given for 1 year. If that work is fine, then the contract is extended for 3 years. On the same lines, just like appointment, they can be removed if there is serious act of omission or commission. If they do something against their duties, if they themselves are involved in fraud, something like that, they can be removed. Their appointment can be cancelled, and it can be reported to RBI and ICI so that further action can be taken on these guys. So now we know what is concurrent audit. We know what kind of things are covered in concurrent audit. We also know that who is going to do it. Now coverage, as said earlier. So it's depart now. Coverage here, it means which branches will be covered. It is description of the bank, they will decide it. So it is again inspection and audit department. Inspection audit department and internal audit head of the bank, they are going to sit with the audit committee and decide it, which branches should be covered in concurrent audit and which should not be. And the criteria is very simple, straightforward, as we have discussed before. Risky areas, risk sensitive areas will be given more weightage, they will be covered. Transactions which are value wise very high, they will be covered. The broad areas of that is based on risk and that is based on volume, value of the transactions. Now, in fact, before this, now in recent module, they have removed it. They said that there was a 50-50 criteria. That means enough number of branches should be covered in such a manner that at least 50% branches contributing at least 50% of the deposits and branches contributing at least 50% of advances should get covered. They said that take the list of all the branches with deposits and advances, sort them in descending order of advances. Now keep selecting all the branches so that 50% of the advances should get covered. Now check whether 50% of the deposit criteria is fulfilled. If not, again sort the list in descending order of deposits and keep adding new branches so that 50% criteria of deposit is also covered. Okay. So this was there in the old module, and maybe one of few of the MCQs are based on that, but then that is removed from the recent module. That there was a 50-50 criteria, 50% coverage of the advances, 50% coverage of the deposits. This was the criteria to ensure that proper coverage is there of branches when it comes to concurrent audit. Now, reporting system. When we talk about reporting system, every bank should ensure that there is a fixed structured format for preparing concurrent auditors. So all the concurrent auditors who are working for the branch, they should be informed that there is a structured format in which their report is expected. Okay. Generally reports are given on monthly basis or quarterly basis. Both the things are possible depending understanding between the auditor and the bank. But the point is there should be a structured format, and it should clearly this format should ensure people understand what was the scope, which area is covered by the auditor, what kind of procedures are performed, and what kind of deficiencies are identified during the concurrent audit. Now, it should clearly specify what are the minor irregularities and serious irregularities. Minor irregularities should be generally rectified at the same time immediately, and serious irregularities should be communicated to the controlling offices, zonal offices, regional offices, head offices, higher office for proper action. Now, uh, job rotation should have been done every single day. That was the requirement, but they are doing every second day. Every second day. Now, this is not a big thing, but then it should be informed and we should ask to rectify them and they should rectify it. But something like locker room is not properly locked, anyone is going and coming out, then that is a serious irregularity. Serious irregularity, anything can happen. Okay. So there should be structured format for the reports. Deficiency should be problems, irregularity should be pointed out into minor and serious. Fraud should be highlighted separately. They are extremely, it should be reported to inspection audit department, to chief vigilance officer, to branch manager, immediately to branch manager, above that chief vigilance officer, above that inspection audit department. Fraud should be reported to the to everyone who are concerned, who take actions, should be reported to them. Generally, report is prepared branch wise, and then periodically all the irregularities are collected and zone wise report is prepared. And the zone wise report is, all the findings of the branch wise report are included in the zone wise report and presented in front of audit committee on quarterly basis. Control auditor should ensure that whatever suggestions, improvements he has, issues he has pointed out, bank has worked on it, they have rectified it, improved on it. So when it comes to reporting, a good format, properly distinguishing irregularities, highlighting frauds, branch wise reports, then accumulating it into zone wise report, and then ensuring that follow up action is taken. Foreign exchange transaction, basically they are giving more and more information about the foreign currency to foreign exchange transactions and nothing else. Let's see. Fan of foreign exchange trading, that's the shortcut. F stand for FCNR. Non-residents can come to India and open foreign currency designated account and make FDs for 1 year, 2 year, 3 year, 4 year, 5 year. That is FCNR facility. RBI has issued RBI guidelines regarding that what kind of FCNR facilities banks can provide, what can be duration, what can be interest rates, etc. Okay. So they're simply giving examples where foreign exchange will get involved. When bank gives FCNR facility to its non-resident customers, foreign exchange will get involved. Then there are foreign exchange forward contracts, there are extensions, rollovers, cancellations. Again, foreign currency will get involved. Whenever foreign exchange contracts are entered, corresponding profit loss can be there because of exchange fluctuation. There'll be further need to be profit loss if you need to extend, if you want to roll over, if you want to cancel. Again, foreign currency will be involved here. F stand for foreign bill negotiation. Once exporter export goods, he will have all the document that he has delivered the goods. So he will have all important documents, proof that goods are delivered and things are payable to him. He may have a bill of exchange. He may have a letter of credit issued, a letter of credit issued in its favor. Exporter is going to have a lot of documents. As soon as exporter exports, he is going to have a lot of documents to prove export is done, export is proper, and he may have a letter of credit of the seller also. All these documents, he will take all these documents, go to the bank, see, it's a proof that I have done sale of 100 crore. So give me money, give me at least 70% as money. As soon as I get money, I will repay it to you. That's called foreign bill negotiation. Then there will be remittances, money sent from India to abroad, abroad to India. Very interesting account is Nostro account. What is? When Indian banks, they go to Citibank and open an account with them, a dollar denominated account, that's called Nostro. We go to foreign countries, we contact foreign banks, we open foreign currency account with them, we open dollar account with them. that is nostro. And when these guys they come to India and open rupee account, that's called vostro. Nostro, vostro. Okay. So when we go and when we go and we put our nose to in their country, that's nostro. When they come, that is vostro. Now, guys, it's going to be interesting. So, nostro account. Nostro account is in complete foreign currency. So, it everything needs to be converted, and a mirror account is created in books of accounts of the bank. That's called nostro mirror account. See, it's common sense. Just like we have passbook. When we see passbook and we see our bank book, they are exact replica of each other, but just opposite. In passbook, you will see credit. In our books, you're going to see debit, and vice versa. On the same lines, in our books, a Nostro mirror account is exact replica is created. Okay, so Nostro account can lead to foreign exchange involvement and ensure that again it is as per RBI guidelines. Nostro account balance as per our books and balance as per our books and balance balance as per the statement from Nostro account, it should match with each other. A proper reconciliation should be prepared if it's not matching, and effort should be taken to match them. Apart from this, as banks need a lot of foreign currency, they go for trading. So they may be buying dollars and pounds and euros and yen and etc. Lot of dealing, lot of foreign currency transaction will be done by them. Ensure that foreign currency levels, foreign exchange contract levels are of reasonable. There is a reasonable position. Ensure there is a reasonable position. So, fan of foreign exchange trading, FCNR, forward contract, foreign bill, accounting of remittances, Nostro account, foreign exchange trading. That's one thing. Auditor's report. What's the good news? Auditor's report is copy paste same overall structure remains as it is. Audit report of banks is governed by SS 700 series. 700, 701, 5, 6, 10, 20. Every damn thing is applicable when you are making audit report. So when you make audit report of bank, all the standards will be applicable. First thing. A unique thing which comes in public sector banks is that they have separate branch auditors and they have statutory branch auditors and statutory central auditor. So there are separate branch auditors and there are separate central auditor. Okay, so they have to go and appoint auditors for a lot of branches. Now, some branches remain unaudited. It is absolutely fine. They are so huge and spread across India that it's absolutely fine if some branches remain unaudited. But detail should be given in audit report that so many branches were unaudited. So many branches were unaudited. It contributes, you should quantify how much percentage of advances, how much percent of deposits, how much percent of interest income expense, you should quantify. It should be quantified and it should be presented in audit report of balance sheet, the details about unaudited branches. It is absolutely fine if you don't audit some branches, it's okay. It's okay. As such, we check things which are above maturity level. So format remains same. Unaudited branches generally we see in public sector entities, that needs to be highlighted. Then there are standard things which come as per any law, which you write on the second part, report on other legal and regulatory requirement. As per SBI Act, Nationalized Banking Regulation Act, you have to mention, auditor has to mention whether any transaction in the company at HO or branch level is against the power of the company, is anything against the power of the company. Okay, so we have to see whether transactions are ultra vires beyond the power of the bank. Then whether proper accounting is done by the branches and proper returns is sent by the branches and officers to the head office, and that is sufficient for the purpose of accounting. First come transaction, comment on it, then comes returns, comment on it, whether balance sheet gives full and fair view, whether P&L shows true profit, and whether proper information explanation is obtained before giving these commenting on these matters, any other matter. So audit report is going to remain almost same. The only change being that there's a we need to highlight and specify unaudited branches. Now, so SS 700 need to be followed. Banking regulation will get applicable. Banking Companies Act will also get applicable. Companies Act will also get applicable. But not Caro 2020 because it is specifically exempted. Rule 11. Guys, Rule 11 under 143, Rule 11 Lafda, even that is applicable. So 700 is applicable, Banking Regulation Act is applicable, Companies Act requirement are applicable. So many things get applicable to report of a bank audit report. LFR, long form audit report, is a questionnaire. It's a questionnaire covering different departments and functions of the bank. There are questions about deposits, there are questions about investments, there are questions about advances, there are questions about foreign currencies, there are questions about a lot of important departments. They are questioned, and these questions should be read, and information need to be given in this questionnaire. Question is drafted in such a way that it is going to identify deficiencies, issues, problem with the bank. So long form audit report is going to be eye opener. That's going to open eye of the people with respect to banks. And RBI is very serious about it. RBI says that it should be submitted to the statutory central auditors, management auditor. It should be presented in front of the audit committee. It should be presented in the front of audit committee, and one copy after, and they're supposed to answer all the problems, deficiencies identified. And then LFR with management's explanation should go to RBI within 60 days. Now, in the earlier version, they focused on 30th June. Now they are focusing on within 60 days. Within 60 days of submission. So explain what do you mean by LFR. It's applicable to public sector, private sector, foreign banks, everyone, branch auditors, central auditors applicable. First explain what it is, applicability, submitted to the management, then management answers on it, and then report and reply is sent to RBI within 60 days. Fraud reporting. Whenever fraud happens in bank, it needs to be reported to RBI. RBI has clearly mentioned procedure of reporting fraud. Depending on the amount, they have given the procedure where it should be reported, how it should be reported. Every small detail is given. So it is responsibility of the auditor to go and understand RBI's circular on fraud reporting, and whatever they specify need to be followed with respect to amount of the fraud, its reporting, and further action needs to be followed. So yes, if you come across fraud, you have to report to the RBI departments. Further, if you come across fraud, you have to report as per section 143 subsection 12. Section 140 subsection 12, you need to go to the MCA and inform them about the fraud. If fraud happens, reporting to RBI is required, reporting to Companies Act is also required. Our reporting principle is simple. We were appointed to evaluate financial statement whether they give true and fair view. During the process, we go and test internal control. We do a lot of risk assessment, test of control, substantive procedure. If we come across fraud, if we come across any instance of fraud, okay, then we should go and report to highest authority, RBI, below that chairman of the company, then managing director, chief executive, in fact all above them government. We should inform then everyone, okay, big governments, then RBIs or chairman, managing director, chief executive, and so on. So reporting principle, yes, we report. Standards on auditing support us. SA 240 says that yes, there should be communication with respect to fraud. Clearly say that there should be communication with respect to fraud. It says that communication should be done. SA 250 also says that that requirement of law will override confidentiality. It is absolutely fine to go and report things. So fraud reporting, RBI reporting should be done RBI circular as per Companies Act. Reporting principle is simple, and standards on auditing also support us. Do you think financial statement report is the only report which bank auditor has to give? No, not at all. There are a lot of things, a lot of reports which auditor need to give. Shortcut is italics. I stand for IRAC. Auditor need to clearly specify whether HO and its branches has complied with income recognition asset classification norm. That's a very important thing. Separate report should be given whether IRAC is followed or not. E for treasury options. Treasury means cash, investments, gold, bullion. So treasury operations. Okay. Again, It's very sensitive. Movement of cash, balances, investment, very sensitive activity. Treasury operations. Okay. So in this case, report on treasury operations. Report on treasury operations should also be given to RBI. So report on IRAC norms, report on are they performing treasury operations as per the RBI instructions. Then adverse credit deposit ratio. So government said open branches across the India, even rural areas. In some branches, adverse credit deposit ratio. That means deposits are less and loans are more. Credit means loan. Loans are more and deposits are less. Okay. So even the report on adverse credit deposit ratio was required. Then we know italics L long form audit report. We already discussed about it. If it's a banking company, then report on IFCR, internal financial control over financial reporting, even that will get applicable. Then compliance with, there is a Ghosh committee which talks about fraud and malpractices. Jilani committee which talks about strengthening controls. Even that knowledge will be really helpful. Report now, Ghosh, so whether people are complying with this, that needs to be reported. Whether SLR requirement is fulfilled, again it needs to be reported. Italics. Report on IRAC norms, report on treasury operation, report on adverse credit deposit ratio, long form audit report, report on internal financial control, financial reporting, report on compliance of Ghosh committee, Jilani committee, report on SLR requirement. Special consideration in IT environment. Definitely banks are different. Banks are so huge, they are they are so huge and spread across the nation. Banks are different altogether. To ensure bank is moving in correct direction, they all are working together. It's very, very important. It's very important that the IT systems, see, IT systems are going to play a very important role in functioning of the bank. IT systems are working properly. This is special. As an auditor, you should go and see IT policies. How many branches, zones, divisions are uh, are computerized, and how many are still on manual basis. What is the policy? 100% change, or important things should be computerized, some things should not be. Understand IT policy, whether IT should be implemented uh, throughout the organization, is implemented throughout the organization or in bits and pieces, and what kind of softwares we are relying on, who is appointed for this, the overall IT policy structure environment. Then whether proper manual should be prepared for transaction processing and accounting process. So overall IT systems structure environment and accounting, and manuals, having manuals and reading those manuals, okay, that will give a good understanding of overall IT department. Then data processing, how they process data, what software, how they process data, what is the interface, is it a software, is it a web based software, what is the interface. So data processing, see guys, here we are discussing that IT is very special and important, very special and important for bank, and as an auditor we should have knowledge about the overall policy, overall structure, manuals, and also how data is generated for financial statements, disclosure of information, financial statement. You should have information about data processing, which softwares are doing that, whether the softwares are compatible with different things. So, and then data integrity, how they ensure that data is genuine data, there is no breach, how they ensure business continuity plans and disaster control plans. Business continuity plans and disaster control plans are extremely important. Business continuity, if something happens, data is lost, you should have some way of getting back data, and there should be plan and approach on how to do it. So go and understand overall IT department, go and understand data processing and key. Then controls, are there proper controls for key aspects? For key aspects like account head, booking head should remain same, and there should be absolute clarity which expense should be put in which heading. controls on e-banking and internet banking. Then MIS report, monthly information system report. MIS reports, and lastly exception report. Our IT department is does a lot of things. Things are heavily dependent on IT, so we should go and check IT policies, structures, manuals, how disclosure, data related things, and overall system related things. Now, what kind of controls will be important if there's a IT environment, a lot of computers? So we have made lay cadimums. Lay cadimums. Number one stands for ledger reconciliation. Ledger reconciliation. Ensure that there are internal control system which on regular basis reconcile things. There should be internal control system procedure to ensure reconciliation should be done. That there should be internal control system to ensure that balances of general ledger adjustment, creditor ledger adjustment, they are tallied with the overall ledgers. So important balances and transactions should be matched, they should be tallied. There should be internal controls for exceptional reports, high value employees, zero depreciation items, etc. So there should be internal control system to ensure exceptional transactions are reported. There should be control, important things should be reconciled, exceptional transactions should be reported. There should be control that if there's a change in parameters, rights of the users are changed, automated entry, interest rates, balances, period is frequencies changed. There should be good internal control system only so that only authorized changes take place. Then ensure that only authorized people can access the IT department, go to the IT department, sit on the computers and run the programs. Ensure segregation of duty, that every login has its own set of laws, rules and regulation. They have to work on that. Segregation of duty. Then control to ensure there are no fourth, and then guys, fifth. Ensure data processing is proper. Data is not processed again, multiple times. Nothing is left out. Changes to their internal control to ensure that changes to heads, balances, master heads, master data is done after proper approval. Whenever there's an interruption because of power, mechanical, any other reason, it should ensure that the whole processing starts. The processing which was not complete is reversed and the whole processing starts again. Controls that there are no authorized changes to the programs. There are controls over the manual calculations and accounting also. Control over segregation of duty. There should be proper segregation. Proper segregation. Workload should be balanced. Control over general ledger account code. Verify all general ledger codes authorized by head office are in existence in the system. See, these are the IT based system which should be there. We have given the shortcut. Read it once, that will be sufficient. Now we have internal, we have central, we have inspection and audit department. Inspection audit department. Now what they're saying that we have inspection, central audit and inspection department. Inspection and audit department is very important. It looks after the complete audit function of the organization. Chief audit executive, just like we have CEO, CFO, we have chief audit executive should be there. So there should be chief executive audit, chief audit executive. We have a complete inspection and audit department team. Many of the functions are centralized. Audit committee along with the department decides what needs to be done, and some things are decentralized, which local branch level people can do. Was explain about the department. Then a lot of audits come under them. internal audit comes under them, and it should be a risk-based audit. That means wherever the risk is high, you should give more efforts. Concurrent and revenue audit. It is responsible. Now this department, along with approval of audit committee, is going to appoint concurrent auditor, give their scope, what they need to do, meetings with the concurrent auditor, discussing issues, conducting training, doing the work of the concurrent auditor. So this is appointment, who is going to be the auditor, what's going to be the scope, then meeting that person, explaining the issues to them, then training them, and then reviewing their work. So inspection and audit department does cover a lot of audits. When we talk about risk-based audit, find out the business risk. What are the chances that banks lose their money? What is the business risk? Once you get the business risk, okay, with the help of that, it can help you in your audits risk of material misstatement. To find out the business risk, how good are the controls, control risk. Then again, understanding how big is a particular risk, how small is a particular risk, assessing them properly, risk matrix into account. So if it's a risk-based audit, understand business risk, control risk, different types of risk matrix, that will be very useful in taking decisions. Audit committee is mandatory in all the banks. It is mandatory. There's RBI guidelines with respect to this. It is mandatory. And again, the function is total audit function with the help of inspection and audit department. These guys will be closely involved, and they will give consultancy to inspection, and they will give consultancy to inspection and audit, internal inspection and audit department. Here again, as I said, audit committee is going to decide things along with taking help of the your department, and they are going to meet periodically to understand the complete progress. Not that important, guys. Simply keep in mind they also look after the audit and do important things with respect to audit. Now guys, let's see initial part of audit of banks. Now the first thing is, what are the characteristics? What are the characteristics that is important things, different things, unique things in bank as compared to any other commercial entity? Shortcut is large brown. L stand for large volume of monetary items. Yes. In case of banks, you have in large volume, you are going to have cash. In large volume, you are going to have cash. Large volume, you are going to have investments which are easily convertible. In large volume, you are going to have negotiable instruments, bills. So as compared to any other commercial entity, these things are in huge volume. And because of this, physical security of these assets and internal control systems related to these assets become extremely important. So this is how bank is different as compared to other commercial entities. Definitely each entity is different, but these are the unique things in bank. L stand for large volume and variety of transactions. Yes, you are going to see transactions in large volumes. There are crores of receipts, crores of payments, huge number of deposits, investments. All the transactions are in huge number, and there is variety. There are variety of deposits, variety of loans, variety of investments. So there is volume as well as variety. Then location. So there are n number of transactions which start at one location, they are processed at one location, and they'll come to an end to another location. For example, they have given example here that transactions, okay, which initiate at one location. So credit card is swiped at Indore. So it started in Indore. Then it is processed and recorded in Pune. There is a Pune server which sees whether there is a proper limit in the card, which approves the transaction and then records the payment. And then there is the IT team in Bangalore, IT department in Bangalore, which ensure everything is running smoothly. The transaction is initiated at one location. It is processed and recorded at another location, and it is managed from the Bangalore team. So multiple locations are involved. Then Brown B, branches and departments. In case of bank, there's a huge network of branches and departments. So a lot of powers are given to them. There is delegation of power, decentralization is there. A lot of powers with respect to deposits, loans are given to them. They take the calls, they execute the transactions, they record them, they process them, they make reports out of them, they account. Okay, so a lot of powers are decentralized, are delegated. Brown B then R, regulatory requirement. Something unique in bank is there's RBI. RBI is a regulatory authority with n number of circulars which are applicable to bank on every aspect, whether it is opening branches or it is processing. At in each and every aspect you are going to have regulatory requirement. They influence the way transactions are processed, the way it is accounted, and the way it is audited. O stand for off balance sheet items. Yes, banks issue so many guarantees, letter of credit, comfort letters. They enter into so many arrangements and contracts that receipt payment may not happen as on today, but receipt payment may happen, may be triggered in the future. So they are off balance sheet. They are not obligation as on today. Off balance sheet item means which are not obligations as on today, but they may become obligation tomorrow. Payment may be required tomorrow. So banks have a lot of off balance sheet items. Brown W, lot of transactions happen automatically without intervention of any employee of the bank. Credit card payments happen, net banking happens, ATM withdrawals happen. None of the employees of the bank are involved. They happen automatically. Then N, national international system integration. Lot of receipt payment system, RTGS, NEFT, IMPS, UPI. These are national payment systems. They get integrated with the systems of the bank, and bank gives this facility, to others. It integrates these all facilities with their systems and give it to the customers. International settlement systems like Swift, UPI is also becoming international, Visa, MasterCard. Again, there's a systematic risk. There's a risk that the whole system may collapse, something may go wrong. So these are some of the features which make banks different altogether, different from the other commercial entities. Then the next question is on same lines but little different. Why is it so that you need special audit considerations, special audit procedure, different audit procedure? Now we have discussed how bank is different. They are summing up it now. They are simply summing up the whole thing, and they are saying it is because of this reason. Banks are going to need different audit procedures. New dawns in banking. N stand for new products and services. N stand for new product. These guys, they keep coming up with the new products and services. So earlier they came up with accounting account used to be only in one branch. Then they came up with multiple location accounting, multiple location banking. You can bank from any location. That was a new thing. Internet was a new thing. Then NEFT was a new thing. RTGS was a new thing. IMPS, then UPI, and now they are giving cashbacks, credit points. They continuously come up with new products and services. This makes things very challenging because there are new products and services. There is new technology. There's new way of accounting for them, and as an auditor you need to be updated and you need to design new audit procedures. Then DONS, D stand for dependency. When transaction happen at such a huge volume, you are highly dependent on IT systems. If you want to work in large scale, you need very good computers and IT system. Work of the bank is fully dependent on IT. So as auditor, you need to have good knowledge of the hardware, software, network, how things are getting processed at the bank. Then O stand for operations. Operations happen at huge scale, large scale. If even a small thing goes wrong, it is going to have huge implication because lakhs and crores of transactions are going to get affected. nature of risk are different. We have cash balances, movements, lockers, investment. It's different from other commercial entities and statutory regulatory requirements. So they're simply summing up what we have discussed earlier. Because of new products and services, dependencies, operation levels are so high, nature of risk is so different, statutory and regulatory requirement. Because of all these reasons, the way you audit bank has to be little different as compared to other commercial entities. The kind of team, the kind of knowledge, the kind of approach which will be required will be different. Maybe you will need more automated IT dependent checking as compared to manual checking. And this is going to affect the way statutory central auditors and statutory branch auditors are going to function. Now, next is legal framework. If you go to audit of bank, you should be aware what are the laws which are applicable. Broadly, what are the laws which are applicable to banks? So, we have categorized it in two parts. First, there were laws which were made to ensure that banking services reach nook and corner of the country, everywhere. They should reach everywhere. In 1934, there was the RBI Act. RBI was created to ensure that banking services reach every corner of the country. But then it was not powerful. So 1949 we had Banking Regulation Act. 1949 we had Banking Regulation Act to make RBI powerful. 1955 we have State Bank of India, again to give banking services. Finally, again the service still big part of the India was not catered. So State Bank of India Subsidiary Act was made in 1959. Still, we were not able to reach a lot of places. So in 1970, a drastic step was taken. Banking companies acquisition and transfer. Private banks were transferred to the government. Nationalization took place in 1970. 1976, there is RRB, Regional Rural Banks, and 1980s again banking company acquisition transfer, again nationalization. These steps were taken to ensure that banking services reach to different parts of the country. 34 RBI, 49 Banking Regulation, 55 SBI, 59 SBI subsidiaries. Then we have 70 nationalization, 76 RRBs, and 80 again nationalization. To improve quality of services. To improve quality of services, okay? To improve quality of services, more acts were introduced. Now, what are the more acts were introduced? Now, what are these acts? So we have Information Technology Act 2000, so that IT based services can be given. Then PMLA, to prevent use of the banking system as money laundering system. 2002 again, Securitization and Reconstruction of Financial Assets and Enforcement of Security Interest Act, so that banks can free their money which is stuck in NPAs. Payment and Settlement System Act 2007. Finally, Companies Act in 2013 and Cooperative Society Act in case of cooperative banks. In 2000 is IT Act, 2000 again SURFACI, 2002 SURFACI Act, 2002 PMLA Act, 2007 Payment Settlement Act, 2013 Companies Act and Cooperative Act. These are the laws. Broadly, these are the laws which are applicable to a bank. Auditor should have knowledge of important sections which affect financial income, expense, asset, liabilities, accounting and auditing. Now next is form and content of financial statements. So we have Banking Regulation Act. First, we have Banking Regulation Act, and in that we have third schedule, not schedule 3, third schedule. And in third schedule we have Form A for balance sheet and Form B for P&L. That gives the basic format in which financial statements of the bank should be prepared. That is the most relevant law with respect to financial statements. So we have Banking Regulation Act, which gives basic format of financial statements. Then next relevant is Companies Act. Companies Act is applicable. Accounting standards which are applicable to companies, same accounting standards are applicable to banks also. So accounting needs to be done as per accounting standards, and even disclosure as per accounting standards. But keep in mind, if they contradict with the RBI circulars or the format of banking regulation, specific will override general. Specific law which are made for banks, they are going to override accounting standards. Then very interesting thing, We know Ind AS. RBI has deferred application of Ind AS to the banks. It happens, it will be a big change. Chartered accountants will be rewarded because there will be a lot of work for them. Then, if it's a listed bank, SEBI regulation including LODR also gets applicable. So when it comes to financial statements, Financial Statement Banking Regulation Act is applicable, Companies Act is applicable, and SEBI regulations, LODR is applicable. Okay. Now we know that there are three principal things which govern, which governs financial statements. Now let's understand. Banks have to prepare consolidated financial statements and standalone financial statements both. They need to prepare both consolidated financial statements and standalone financial statements. Now, very interesting thing. Now this is different in public sector banks and private banks. In public sector banks, they prepare financial statement at branch level. Audit is conducted at branch level, and then all the financial statement of branches are consolidated to prepare standalone financial statements. But that's not the case with the private sector bank. That is not the case with private sector banks. They are highly centralized. All the accounting is automated, happens on core banking system softwares that is integrated. They directly prepare. Things are centralized. They directly make trial balance of the bank and standalone financial statements. So you should know these features, that format is governed by three laws, accounting, and then what happens. Then we talk about standalone and console, and then we talk about how things happen in public sector bank and private sector bank. Now, regarding appointment of auditor, audit should be done as per section 30. Audit should be done by such a person who is qualified to do audit of the companies. So that is none other than practicing chartered accountant should do audit of banks also. Now, very interesting thing, in case of nationalized or public sector banks, it is mandatory that four or more, very important for from MCQ point of view, four or more accountants should, four or more firms should be appointed as joint statutory central auditors. That's something very unique and special. Joint auditors are mandatory. That's not the case with the private sector banks. It's up to them. Generally, they appoint big fours or one big firm. Now this is about appointment. Don't look into Google. Don't look into practical. Whatever given in the module is given in our notes, and that is relevant for us. So first, now it's who is going to appoint auditor and who is going to decide remuneration. See, what we have done is, we first, let's see this column. The biggest bank is SBI and its subsidiaries. Below that we have nationalized banks. Below that we have other banking companies, and below that we have RRBs. So these used to be the situation: SBI, nationalized banks, other banking companies, and RRBs. Let's talk about appointment of auditor. The biggest bank is SBI. Appointment will be done by CNAG. With consultation of central government. CNAG is going to do appointment in consultation with central government. Then below that we have subsidiaries of SBI. When it comes to subsidiaries of SBI, appointment will be done by SBI itself. Then we have nationalized banks. When it comes to nationalized banks, they are run by board of directors appointed by the government. So BOD is the most powerful thing in nationalized bank. They are going to appoint with prior approval of RBI. SBI, biggest auditor, CNAG in consultation with central government, subsidiaries, SBI itself. Nationalized banks, board are the most powerful people. Board will appoint with prior approval of RBI. Then next is other banking companies will appoint auditor at AGM, again prior approval of RBI. So wherever you see appointments are generally two authorities are involved. When it comes to RRB itself will appoint, but they will take approval of central government. When it comes to remuneration, RBI knows in and out. Don't argue with them. So when it comes to SBI, RBI in consultation with central government. When it comes to subsidiaries, again RBI in consultation with central government. When it comes to nationalized bank, RBI in consultation with central government. So wherever government money is involved, it's RBI in consultation with central government. When it comes to other banking companies, it is section 142. So that is, it will be decided in AGM. by shareholders and they can delegate it. When it comes to RRB, appointment and remuneration are same. So we have seen the same thing. So study this table. First study the first column, then the second column and third column. That is the best way to go through that. Appointment letter. Appointment letter of statutory central auditor is going to have very interesting thing. Number one, it's going to have details of the previous auditor, who were previous auditor, so that it is easy for auditors to go and talk to them, communicate with them and understand if they have any issues. Then they're also going to give details about the other joint auditors. So we have 4 joint auditors. They're going to give details of other joint auditors. There will be a clear statement of division of work. Who is going to cover which particular region, which particular branches, which particular departments. There should be division of work, and who is going to work, who is going to review, and work responsibilities, review responsibilities, reporting responsibilities will be clearly defined. Then next period of appointment, for how many years they are appointed as auditor, 1 year, 2 year, 3 years. Then procedural requirement of accepting the assignment, how to accept the assignment. So they need to confirm their firm details. So for accepting, first they need to give firm details. Then they need to have a letter of acceptance in a particular format. So first give firm details, then give letter of acceptance, and then you give declaration of faithfulness, fidelity, faithfulness and secrecy, that you will work in a faithful manner to take care of the shareholders and take care of the shareholders and all the stakeholders. Then scope, that is area which will be covered by the auditors, and kind of scope will cover both coverage, type of activities need to be performed. So it will have coverage, it will have kind of activities which are expected to be performed, and also different types of reports and certificate that needs to be given. We have studied that statutory central auditors need to give a lot of reports, so that detail will be here. When it comes to, so see, it's in sequence. First we talk about previous auditor, then auditors who are working with us, then appointment period, then how to accept it, and the scope. The appointment letter of statutory branch auditor is going to be on same line, similar line, except that branch audit is generally conducted by a single firm, and when it comes to a single firm, and when it comes to main audit, it's conducted by joint auditors. Now, stages of conducting bank audit. Now this thing is not I can say this thing is not very important, but then should not be taken lightly. You should be simply aware about stages. It is similar to how we conduct audit as per standards and auditing. So there is the initial stage. Here you should first communicate with the previous auditor. You should think carefully whether to accept the assignment or not. First communicate, then decide whether to accept or not. Once you decide to accept, then see whether you are indebtedness, get the declaration of indebtedness ready. See, if you are indebted more than the prescribed limit, you cannot do audit. Then go and see, are you performing any internal assignments? Leave them. You cannot do concurrent audit, revenue audit, stock audit of the bank if you want to become statutory auditor. So check it, leave it, make declaration with respect to that also. So once you are ready, then terms of audit engagement letter should be prepared and signed by both the parties, and then establish an engagement team. So this work should be done initially. Talk to previous auditors, think carefully whether to accept and continue this assignment, then check the indebtedness, give the declaration, check the status of internal assignments, make declaration for that. If everything is fine, then make terms of engagement and then make the team. So that is initial consideration. Then you need to go for understanding. You need to understand what is the real business, what is the business of the bank and its environment, including internal control system. You need to understand in which geographical areas they are very strong, where are they spread, from where they get a lot of deposits, where they give a lot of loans, where they make a lot of investments. So understand the business, then understand who are the decision makers and what are the criteria for making decisions. Understand internal control system. So understand business of the bank, understand people who are involved in doing this business and internal control system. After understanding, try to go and obtain understanding of the risk management system of the bank itself. Understand risk management system of the bank itself. How good is the risk management system, risk management process of the bank, because its understanding can help you a lot in deciding risk of and identifying and assessing risk. So understand bank, understand their risk management system, understand their business processes and accounting process. how the primary books are made, how posting is done, how trial balance is made, how adjustment entries are passed, how consolidation is done. After obtaining all this understanding, you'll understand the weak points. You'll understand where the banks are weak, where a lot of judgment is required, where a lot of complexity is there. Next step is, with the help of this, you'll be able to identify and assess risk of material misstatement. You'll be able to identify risk of fraud, risk of money laundering. You'll be able to identify risk which is related to outsourcing if any of the activity is outsourced. You'll be able to assess specific risk like cyber risk. With all the information, you'll get RMM, risk of fraud, risk in outsourced activities, specific risk. After getting this risk, you go for execution. You first call the team meeting and everyone come and discuss their understanding, their risk assessment, come and discuss everything. Once you discuss everything, everyone is aware, everyone is on same page, decide the audit materiality. What should be the materiality level? Okay. Also discuss, is there any going concern issue and how it should be addressed. Once you have done this basic discussion, then you decide how to perform audit procedure, test of control, substantive procedure. That is called response to risk. In that, first establish overall audit strategy. On that basis, establish audit plan or audit program, and then make a summary of the audit plan. That is called audit planning memorandum. So after doing the basics, go for the response, go for the strategy, go for the program, and on that basis, you develop audit planning memorandum, summary of audit plan. Then you go for reporting on financial statement, long form audit reporting on financial statement, long form audit report, and other reports as required. These are the 5 stages: initial stage, understanding stage, identify and assessing risk, execution stage, and lastly reporting phase. Next is effective risk management. Banks face n number of different types of risk. When they're established, they face on continuous basis regulatory risk. They may breach requirement of RBI and get punished. Then when they get deposits, there is a risk of money laundering, that fake people, deposits are made in the name of fake people. There are chances that money laundering may happen. Then when employees work, there are chances that employees do something wrong. So that is operational risk. When they give investments, they may lose money. That is market risk. When they invest money, when they give loans, it can happen. Borrower can do defaults. So that is credit risk. Guys. So these are n number of different types of risk they may come across. So first thing is that TCWG, those charged with governance, most knowledgeable, experienced, and powerful people in the organization, they should take keen interest in risk management. They should be involved in making policy with respect to risk. They should clearly specify these are the important risks. These are the very important critical risks. These risks should be measured and monitored. This is how it will be measured. Different risks will be measured in different manner. For example, credit risk. We will see how many risky loans we have given. When it comes to investment market risk, we'll see where have we invested money. So the different type, this TCWD will be involved in framing policy for risk management. In policy, they should identify these are the important risks. This is how risk should be measured. This is the maximum limit of the risk. What kind of system should be established to compensate the risk? All these things should be written, expressed in the policy. Okay, and when we frame policy, ensure that regulatory requirements and management expertise considered when framing this policy. So TCWG should be involved in framing policy with respect to risk management. That's the most important step. Then now let's implement this policy. Let's identify different risks, measure them, see how they are doing against the approved limit, and how to compensate them. So go and measure legal risk. Whether in past we have gone across some laws, rules, and regulations. Are we close to some particular limits? Are there chances that we'll breach law, something like capital adequacy ratio, etc.? So for each risk should be identified. Each risk should be measured by the formula approach which is decided, compared with the approved limits, and decide how to reduce this risk. The best way is control activities that can mitigate the risk, like segregation of duty. If a particular transaction is very sensitive, don't keep it in hand of one person. Go for segregation of duty. Then you set limits. Who is going to have how much authority? and then approval will be done as per the limits which are set. Okay, so in while executing transactions, there should be segregation, limits should be sent, approval is required for all the transaction should be accurately measured and recorded. Then once the recording happens, reporting should be done. Exceptions, unusual items should be prepared in a report, and management should look into the exception reporting. Records should be reconciled with each other, reconciled with the physical existing items, and there should be a good safety for physical security for the assets and data both. So there should be segregation, limits should be set, there should be approval, there should be measurement, recording, reconciliations, then reporting, so on. On regular basis, management should assess whether the approach, methodologies, models, assumptions, calculation methods, whatever which we are using, whether any change is required. Should we change things? Whether new risk should be included? Whether new method should be adopted? Reporting of risk. Banks should report in detail in their annual report the complete risk profile. That these are the different types of risk which are affecting the bank, and they should explain its meaning, its background. It should explain that this is the level of the risk, how it is measured, approved limits, everything should be properly presented. So reporting of the risk is extremely important. It should be made in such a manner that TCW should be able to understand easily. Next is, see, when you talk about risk, the only thing which is going to compensate are internal control systems. So first, our general internal control system. General, what kind of controls? So we have made a story. There's a professional manager. So few controls can be associated with him. Then there is a store in charge. Few controls can be associated with him. Professional manager, then professional manager, then store in charge, then dedicated employee. Let's see one by one. So there's a professional manager. What are the controls which should be there in a bank? First of all, financial powers should be clearly defined. It should be clearly defined who is going to have how much authority. Financial powers of officers of different grades should be clearly defined. Who can approve loans of how much? Who can approve expenses? Who can approve loans? It should be clearly defined. Okay, financial piece for power. Power should be clearly defined. Then position. There should be regular shifting of employees from one position to another, so that work of one employee is automatically checked by another. That's also part of internal control. So there should be well defined power structure. There should be system where positions are changed on regular basis. There should be uh, insurance policies should be taken for different types of losses, including natural calamity, theft, infidelity, so that bank is protected. Then eyes for inspection. There should be surprise inspection of head office and branch office by internal audit department. So these are the general controls which should be there in the bank. There should be power allocation. There should be position shifting. There should be insurance. There should be inspection. When it comes to store in charge, bank forms like checkbooks, DDs, checkbook, pay order, traveler check, foreign currency card, etc., should be in the standard format, and it should be kept in safe and secure custody. Okay, that's very important, that unused bank forms and documents should be in the safe custody position of officer, and another responsible officer should verify it on regular basis. So it should be in custody of one person, and another person should go and verify it on regular basis. Then there should be a signature book. All the branches should have a signature book where specimen signatures are there, so that they can verify signatures anytime they want without any problem, without any hesitation. There should be telegraphic code. There should be secret telegraphic codes. These are the codes with the help of which instructions are sent to the other branches regarding what amount of payment should be done to whom and through what medium. So when it comes to store in charge, bank forms should be safe and secured. There should be proper signature book. There should be telegraphic code. Then something to dedicate employee. System should be designed in such a manner that work of one person is automatically checked by the another person. Mail should be opened by responsible officer. Mail should always be opened by a responsible officer. So, and mail will have a lot of important documents. Responsible officers segregation should happen, and uh, you should carefully check. There are intimations, instructions, whether they are genuine. You should match signature with the specimen signature book. So mail should be carefully checked and analyzed, and arithmetical accuracy of the books can be checked on daily basis by different person independently. So see, this is a very simple story just to group the items. Some points are connected with professional manager, some points are connected with store in charge, some points are connected with dedicated employee. Cash controls. First of all, there should be segregation of duty. Segregation of duty, the person who is handling the cash should be different altogether. The person who is managing, who is handling the cash should be different. The person who is doing the accounting should be different. The person who is doing handling primary book should be different. The cashier should have no access to customers ledger and day book. This is important safeguard. So there should be segregation of duty. Segregation of duty. Never, the person who is handling cash is different altogether. He's managing receipts and payments, and he's making a scroll. What do you mean by scroll? Okay, we'll discuss about that. So that person receiving and paying cash is different cashier altogether. Person who is doing the accounting is different altogether, and person who is supervising them is different. There should be segregation of duty. Whenever cashier uh, receives money, they are supposed to issue receipts. So generally, there's a counterfoil. The counterfoil cash receipt vouchers should be signed by the officer in cash department in addition to receiving cashier. Okay, so it's very simple, guys. Whenever cashier is receiving cash, they're supposed to issue receipts. So this cash should be checked by the cashier and also one more officer. So both should sign the counterfoil. I hope you understand what you mean by counterfoil. There's one big receipt, and after that there's a small receipt that's called counterfoil. When you go to bank, you have cash, you have that slip where there is a small part and the big part. Small part is called counterfoil and big part is called receipt. So you give it to the cashier. So cashier is supposed to go and check it. The other person is supposed to go and check it, put the signature, and give the counterfoil back. When it comes to payment, again, payment should be made only after voucher have been passed for payment by proper officer. Again, payment should be first approved by the person saying that there's enough money in the account, and then the other person should give the cash. So first of all, there should be segregation of duty. Person handling cash and doing accounting should be different. Supervising is different. While receiving the money, you give the counterfoil. It should be signed by two people. When you pay money, again it should be approved by one and then paid by another. Then there should be scroll. Scroll is what? Scroll is a simple piece of document where in chronological order cashier keeps writing how much received, how much paid, how much received, how much paid, how much received, how much paid. So it is a simple record of all the receipts and payments which happened during the day in a chronological order. So total of the scroll, receipt side and payment side scroll will be passed as a single entry in the day book by independent person. So guys, when it comes to controls, there should be segregation. There should be, at the time of receipts, there should be two signatures. At the time of payment, there should be again two signatures. They should maintain scroll for all the receipt payments. Daily cash. Chief cashier should test check daily cash. In addition to normal checking by chief cashier, cash should be test checked and daily and counted in full occasionally by responsible officer unconnected with the cash department. So it's very important. In addition to normal checking, chief cashier should do normal checking. Apart from that, on test basis, a responsible officer, independent officer should also do cash counting, and cash should agree with your day book. Cash custody should never be kept in hand of one person. It should be always in hand of two persons. High value receipts and payments. High value receipts and payments should be verified by higher officer and branch manager. These are the controls in a sequence which should be there when it comes to cash. Okay. Now clearing. What is clearing? It's simple, guys. Let's understand what is clearing. Let's see. So let's see. There is a numbering also. Mr. A gives SBI check to Mr. B. So it's a 1 lakh rupee check. 1 lakh rupee check which is going from Mr. A to Mr. B. And now Mr. B will go to the bank, ICICI Bank, where he's having his account, and give the check and deposit the check, that encash it and put it in my account. Now what ICICI Bank will do? So first B is going to get the check, then B is going to send the check, he is going to deposit the check. Now the clearing process starts. ICICI Bank will send this check to clearing house, that listen, clearing house, I got this check of rupees 1 lakh, which says that money from customer of SBI 1 lakh is supposed to come to my customer. So ICICI Bank is going to get the check and give it for clearing. So for them it is outgoing clearing. Outgoing clearing. They are going to send it to clearing house. They are going to use system CTS, check truncation system. Truncation system. They are going to scan it, send it to SBI. For them it is inward clearing. SBI, that listen, SBI, this is your check from your customer, and check the signatures, check whether check is properly prepared, signatures, and give 1 lakh rupee, which has to be given to ICICI Bank. After SBI check everything, they will transfer money which will go to ICICI Bank, and they will inform Mr. B, oh, your check is cleared now. They will also inform Mr. A that money is deducted from your account. This is how clearing will work. So bank which is sending the check for clearing, it is called outgoing clearing. Which is receiving, it is called inward clearing. And if you see funds, ICICI Bank is getting funds, so it is receiving branch, and SBI is giving funds, so it is paying branch. So whenever clearing happens, the complete process will happen, and it will be outgoing and incoming for one of the persons, and is paying and receiving branch for one of the branches. I hope you are clear about this. Now you need to first explain the system, that customers issue check from one person to another, checks from one person to another, and they expect that as soon as check is deposited, you should get it in the bank account. Okay, but that doesn't happen. In between, what happens is clearing system. You explain the system, that how check received, okay, check received goes to the bank, how it is goes to the clearing, and how clearing happens. Explain clearing system. Explain in very simple words what is clearing. It's very simple thing, that whenever checks are issued, whenever checks are issued, it's a very simple clearing. In clearing, the funds are transferred from one bank to another as per the checks given. That's a clearing system. There's a clearing house, and there's a check truncation system which plays an important role in the whole process. So for some branches it is outgoing clearing, for some incoming, for some it is receiving branch, for some it is paying branch. Then once this happens, then explain check truncation system. Again, that is a part of system itself. If bank receives any check of 5 lakhs or more, of 5 lakhs and above, it is inward clearing. They will have to pay as per the clearing. They should definitely talk. They should definitely talk to the customer and then process this clearing of check. Is for amount of 5 lakhs and above. Signatures are extremely important. Signature on checks are extremely important, because they are going to decide whether check is genuine or not. So carefully see the signature, match it with the specimen. Match it with specimen if you are having. Unpaid checks. Now checks which don't clear, unpaid checks, should be either sent to the customers, that listen, check didn't clear, to the customers at the recorded address, or customers be informed to collect the same from the bank branch if particular check doesn't clear. Okay, basically if checks, we got the check but then it bounced, it should be sent back to the customer, your check bounced, whatever check you have given to us, it has bounced, it is not valid. Okay, that is unpaid check. Next is internal control with respect to loans advance. It's an age old question. There should be good internal control system for ensuring credit worthiness. Then there should be good authority structure and sanction should be made as per them strictly. After sanction, proper documents should be made, agreements, promissory notes, letter of hypothecation, etc. Then after that, uh, once sanction is done, documents are prepared. Go and collect the securities from the responsible persons. Obtain the securities. Okay, they should be kept joint custody or two such officers. So obtain the securities, financial instrument, whatever is given as a security. Obtain those things. Then, if it's immovable, ensure it is registered in the name of the bank or at least original documents are with the bank. Adequate margin should be deducted for fall in value of the security and other contingencies as per RBI guidelines. There should system for creditworthiness, system for sanction, preparing documents, and system related to security. Then, on regular basis, information is received. On that basis, drawing power limit should be computed, and none of the limits should be crossed. And finally, see the operations of the account every year, once in a year. Is it operating properly? Is there something wrong with the account? Demand drafts. You know about demand drafts. So, I simply explain what is demand drafts. You pay at one location, demand draft is created, and you get money at one location, you pay at another location. That's a demand draft. Signature on the demand draft should always match with the signature in the specimen book. So you explain what is demand. See, internal control with respect to demand draft. First of all, the custody of the unused demand draft is very important. It should be with the limited number of people. Not everyone should have access to it. Then there should be standard signatures which should be there unless there's some contingency. Proper signature should be there. As soon as DD is made, intimation should be sent that DD is made. As soon as they pay, intimation should be sent that account is debited. So there should be basically good system with respect to demand drafts. Interbranch account we have discussed in detail that multiple branches are involved. The branch which initiates the transaction informs the other and vice versa. If there is a credit balance, if there is a net credit balance, it will go to other liabilities. If it's a net debit balance, it will go to other assets. If the balances are outstanding since long, then it should be investigated. What is the issue? Internal control system with respect to credit card operation. First of all, storage. Unused credit card should be carefully stored at one location with physical security. No one should have access to it. So credit cards are safe. Next, whenever you want to issue credit card, first go for credit assessment. What is the credit worthiness of the person? How much loan debt he will be able to repay? How much loan they will be able to repay? Then how much is the existing see, first store them properly, and then after proper screening only, then only our credit card should be given with proper limit. Then as the person goes for making payments with the help of credit card, there should be proper system which checks with the server whether the limit is available and then accepts the payment. There should be a system which checks credit card limit on continuous basis whenever they want to make payments. Then once the payment is done, there will be settlement confirmation. So there should be control over storage, then critical evaluation. Then once people start paying payment about the card limit. So basically, guys, let's see once again. You have good control over storage. It's safe. Once people apply, see the credit assessment, then give the card with limit. Every time they make the payment, the system should ask the server whether the limit is available. Every time payment is made, system should inform payment is made. It should charge customer immediately. Their limit should be reduced. Then next day or within few days, settlement should be done and the merchant should be paid the money, reimburse the money. Bank should make a statement and give it to the customer and ensure that it is regularly recovered. Keep monitoring that proper payments are being done, proper receipts are being done. It is happening on continuous basis. If amount is overdue for a long period of time, it will become NPA. So monitor that also. There should be system monitoring it. Guys, next is cash balance. How to do audit of cash balance? It's very simple. The best way to verify the cash is to go for physical verification. Randomly select the locations and the ATM centers, branches where cash is present, and go and do physical verification. And simply after physical verification, match it with the cash register or ledger balances, whether it tallies or not. Simple. I don't think they are going to ask this in exams. Then balance with RBI. Balance with RBI, again, it's very simple, straightforward. You should take confirmation from RBI. Take confirmation from RBI how much cash you are having of this particular bank, and the confirmation ledger balances, they should match with each other. Sometimes they are not going to match. In that case, a reconciliation statement. A reconciliation statement will be prepared. Reconciliation statement will be prepared. That's so. Go through that reconciliation statement properly. It may happen that we have sent cash to RBI, they are yet to receive it, or RBI has sent cash to us, we are yet to receive it. Difference can be because of that. It's a temporary difference. It is acceptable. Fine. It can be because of that RBI has given us some interest income. We are yet to record it, so we need to record it, or they have charged some expenses. We are yet to do it. Okay. So if they are in reconciliation, if there are temporary items which are getting cleared subsequently, it's absolutely fine. But if there are unrecorded incomes, unrecorded expenses, or some discrepancies, mismatch, it should be taken seriously. It should be resolved. Generally, RBI informs. Generally, RBI informs on regular basis if there are any credit debit entries originated in statement provided by RBI remaining unresponded more than 15 days, then that should be taken seriously. So quickly, just look at the reconciliation. Temporary items, they should clear within few days. Like we have sent the cash, they are yet to record it. They will record it. It will go away from the reconciliation. Or vice versa, they have sent cash, it will record it by us, it will go away. So temporary items should go away in some days. And whatever other entries are there, if it is unrecorded income expenses, it should be recorded properly. And if it is something else, then it should be resolved. We should go and inquire into that. Now let's see, balance with the other banks. It's on the same lines, guys. Same, copy paste, same. Again, confirmation is the most important thing. We are having account with the bank, so ask for the confirmation. Confirmation and the balances should match with each other. Just like a commercial organization has bank account, on the same lines, we are having a bank account with the other bank, and same, we need to match it with the confirmation. If not, go for reconciliation. Again, same things. There can be temporary items like checks. We have deposited the checks, but they are not yet realized. They're not yet realized, or we have issued the check, but the payment is not yet done. It can happen that checks are pending in clearing. So you should see whether subsequently they are cleared or not. It can happen there are outstation checks. Again, see whether subsequently cleared or not. If outstanding interest or expense interest, it should be recorded immediately. Then apart from that, there should not be window dressing. Yeah, there should not be window dressing. Sir, how window dressing can take place? Listen, let's see an example. There should not be manipulation. Suppose, let's take an example of two entities, not just banks. It can happen anywhere. So A Limited is having 500 crore balance, B Limited is having 200 crore balance. This is the fact. Now, they want to manipulate these balances. So what will happen? A Limited will send check of 50 crores on 31st of March. Okay. Now, A Limited is not going to record it. They will not record it, and they will be all comfortable. Whenever auditor comes, they will say that, okay, see, this is the balance in the bank. Okay. And this is the bank statement. This is the confirmation. Everyone is showing 500 crores is absolutely fine. You don't need to worry. Okay. So even if they don't record 50 crore check in A Limited, auditor can be fooled easily. Even if they don't record it, auditor will not know about it. And in B Limited, there will be different auditor. They will record the check as 50 crores and the balance will go to 250 crores. When auditor will come in B Limited, they will show, see, I have received the check of 50 crore on 31st of March. I should record it. The point is, actual money is only 50 crores. But because it takes time, that money goes out of one account and goes in other account, the whole process takes time. They are using this particular time window to do manipulation. There's only 150 crore with A Limited, but by issuing check, it is recorded in B Limited also. So there's only 150 crore, but appearing in balance sheet of both. One more thing, this is called kiting. This is called kiting. One more thing can happen. Even they can issue check of 50 crore. Now A Limited will record it and B Limited will not record it. Okay, B Limited will not record it. So this is kiting, reverse kiting, and they can keep increasing the balances. So auditor should look into it carefully. Such kind of manipulation should not happen. Same thing will be applicable if the banks are outside India also. And if it's outside India, ensure that they are converted at proper rate in Indian currency. Now guys, so cash balances, balance with RBI, bank balances, they were not so important. Now important, audit of investments. So if you're doing audit of the investments, very important thing that every bank should have their own investment policy. It should clearly define in what kind of instruments they will invest, in what kind of sectors they will invest, what will be maximum, what will be minimum, and what will be the percentage criteria. And this policy should be as per RBI circular. For example, these things given in green are from our side, no need to write it in exam. Like for example, RBI says that you should never invest more than 15% of the capital funds. You're more than 15% of capital fund in one company. And you should never invest more than 40% of your capital funds in a particular group. Not more than 15% in one company, not more than 40% in a group. Then we talk about, then further they say that when you invest, always ensure that you are not investing more than 30% of the other company. 30% of paid up share capital of the other company. Okay. So these are some of the things which are given in RBI guidelines. First thing is every bank should have its own investment policy. It should clearly define a lot of things which will be useful for the fund managers, and it should be as per the RBI guidelines. And broad objectives that they want to maximize returns. They want to take limited risk. Clearly, objective should be set. Okay, we want to maximize return. Everyone wants to do that, but this is the maximum risk which we are prepared to take. And it should separately state objectives for own investment and objectives for investment of customers. See, banks have their own investment. At the same time, they give one more service, PMS, portfolio management service. In portfolio management service, they are managing funds of the customers. So investment objectives there are going to change. They'll be different as per requirement of the customer. So very good, properly drafted policy should be there as per RBI guidelines. It should be separate for own investment. It should be separate when you are managing funds for others, when you are performing portfolio management services. After policy, there should be segregation of investment function. So, like the complete investment process, you are going to find three functions majorly. First, trade. There are people who decide what to buy, what to sell, when to buy, when to sell, at what price to buy, what price to sell. That's a trade function. So fund managers are going to do that. After that, there is settlement. Actual receipt payment of money, actual receipt payment of shares should happen. That is settlement. And continuous monitoring that we are not breaching something important, whether it's our policy, whether RBI guidelines, whether any law, and whether risk is under control. Monitoring, settlement and monitoring. And third is accounting function. So trade is called front office, settlement and monitoring is called middle office, and accounting is called back office. There should be segregation of duty. One person should not do everything. Tasks should be broken and distributed amongst different people. Some tasks, front office will do the trading, middle office will do settlement and monitoring, and your back office is going to do accounting function. Okay, so there should be clear segregation of duty. Then apart from this, there should be separate accounts for own investments and for investments on behalf of client. Separate set of accounts. For own investment is different, for PMS client it should be different. In fact, accounts of PMS clients and their statement should be audited by the external auditor, and Separate report should be given on them so that PMS clients are rest assured that their money is properly invested and all the returns generated are given to them with all the transparency. Have proper policy. Then next, have segregation of duty, separation of function. Now, every time buying selling happens, it should be properly authorized. In bank, depending on the value of the investment you are buying and selling, there should be proper authorization. Sometimes authorization is required by the committee, ALCO committee, asset liability committee, or sometimes maybe board of directors. So as per authority matrix, proper authorization should be there. Then whenever you buy investments, okay, there will be conditions, covenants attached with that. Ensure that when you buy investment, you follow the covenants and conditions. For example, there can be lock-in period of 3 years. So first, when it comes to documents, clearly see whether it was properly authorized, whether terms and conditions followed. And then when we go for accounting, check carefully. Every time you buy and sell investment, there will be a contract note. Broker is going to send a contract note clearly showing at how much we have bought, sold, what were the taxes. So buying and selling should be at that particular price. That's called contract note. That's called broker's note. For daily transaction, a contract note is generated. And for overall cumulative effect, a bill is generated. So ensure that amount is as per these contract notes and as per these bills, as per these monthly bills. So once we have a policy, we have segregation, we bought the investments, then comes the earning. Income from investments. See, income from investments, if it's debenture bonds, you are going to get interest. If it is shares, you are going to get dividend. And many times nowadays you get, sometimes you get dividend warrants, interest warrants, sometimes it is electronic transfer. Lot of times TDS will be deducted. Ensure that TDS is deducted at proper rate and you are getting TDS certificates. Apart from that, when you sell investment, profit loss is going to arise. It should be computed accurately and posted to P&L. So earnings from investment can happen in two ways, in the form of interest debenture, interest dividend, and in the form of profit loss. Next is physical verification. Now at year end, we need to physically verify. Now there can be variety of investments. Now the investments which are available, see, if the investment of 1000 crore, if there are investments of 1000 crore, you will be having say around 200 crore physical certificates. So you should go and see whether we are having investment of 200 crores physically in the form of debentures and bonds. Then apart from that, okay, some investments are going to be in electronic form, demat form. So suppose 300 crore is in dematerialized form. So if it is dematerialized form, then in this particular case, you need to see demat statement or depository statement. And in depository statement, it should be written that yes, bank is owner of investment of 300 crores. Then some investments are going to be in government securities. Suppose government securities. Now, government securities are managed by RBI's PDO, Public Debt Office. Public Debt Office, and they maintain SGL, Subsidiary General Ledger. Basically, SGL is an electronic record just like DMAT, and they maintain all the details of government bond, who is owner of how many bonds. So in SGL statement will understand, we are owner of 300, 200 crore, 300 crore, whatever it is. Okay. Then apart from this, there will be other, say 300 crore with the custodians. When we have custodians or brokers or other intermediaries, when we have very high value investment, sometimes we want custodian to keep it under proper protection. Or sometimes when we are buying and selling, we want to keep it with the broker itself. We need to take confirmation from them. So at year end, guys, it's very simple. At year end, if there are some things are available physically, go for the physical verification. If they're demat statement, see the statement. If it is government security, then go for that. If they're custodian brokers, go for that. One more thing, very interesting, very interesting. Suppose 100 crore. Many times we buy the investments from a bank. Suppose we bought investments of 100 crore. But the selling bank says that I am not having physical certificates right now. I am not having physical certificates right now because the person who has issued the person who has issued these securities is yet to deliver it to me, or I bought this investment, I am yet to get the certificates. So may sometime it may happen that we have paid the money, but selling bank says that I am not having investments physical certificates right now with me. I am going to give you in few days. So as a proof that they have received the money and they are going to deliver so and so investments, they give BR, that is bank receipts. Bank receipts are acknowledgement that money is an acknowledgement by the selling bank that money is received and investments will be delivered in some time. Bank receipt should be satisfied within 15 days. Within 15 days, security should be given and should be satisfied. Okay, there are strict norms with respect to bank receipts. It should be in proper format, signed by proper authorities. It should be serially numbered, and it should be satisfied within 15 days. So sometimes you are going to find a bank receipt also. So when it comes to physical verification, there can be some physically available. Go for that. Sometimes a demat form is available. Go for demat statement. If can call government securities, go for the SGL statement. Sometimes it can be custodian. Go for that. Okay. Apart from that, there is a e-Kuber. E-Kuber is a platform of RBI where banks can log in and find out how much government bonds, which government bonds, how much government bonds, and what is the value of the government bonds from the e-Kuber platform of RBI. Then there are bank receipts. Bank receipts, a very simple statement, a very simple form is given by the selling bank, as I have explained. Sometimes investment are held in the name of other person. The person can be a broker, person can be a foreign broker, or if investment is foreign nation, so person can be a resident of that particular nation, or it can be a trust, it can be a society. So there should be a clear declaration that these investments are of the bank but held in our name for temporary purpose. They will be transferred whenever they will be transferred, and there should be transfer deeds signed by the holders that whenever bank wants they can transfer it in their own name. So now at the year end, verification is done. Reconciliation. At the end of the year, you should take in balance sheet what is the value of the investment. You should keep adding all physical certificates, demat certificate, physical certificates, demat certificate, government securities, SGL, everything, and it should add up. It should add up, and the balance should match with the balance sheet. So reconciliation should be there. Then next is examination of valuation. So at year end, after physical verification, we go for valuation. Now, in case of banks, investments are divided into three categories: held to maturity, available for sale, held for trade. Three categories are there. In all the three categories, there is a different method of accounting. The cost at which it is recorded changes. The frequency of valuation changes. Way of valuation changes. Where profits will be posted when we do revaluation, that is also going to change. So RBI has categorized in three categories. You explain that, and the method of accounting, frequency of valuation, way of valuation, and transfer of profit loss is going to change. It should be as per RBI guidelines. Even in case of NPA, in case of investments, if any installment or amount is overdue more than 90 days, it will be declared NPI, and provision should be made for such investment. Just like we declare NPA for loan, NPI should be declared for investment, and provision should be made. Then, so guys, if you have realized this, it's in a sequence. First comes policy, then comes segregation of duty, then comes documents, then comes earnings, then at year end comes physical verification, reconciliation, and valuation. Now, some special points. Can shifting happen within the categories? Yes. RBI's detailed guidelines which explains can shifting happen from in within the categories. If you want to take something in HTM category from available for sale, if you want to shift investment from available for sale to held to maturity, it's a very big thing. Okay, board of directors approval will be required. Taking something to HTM is a very big thing because in HTM things are valued at cost, so you are immune to market fluctuations. If you want to do that in the middle of the year, suddenly BOD approval will be required. If you are dealing on behalf of others, yeah, then you should sit with the client, get the mandate, get the objectives pretty clear. What are your objectives? You want high growth, you want moderate growth, you want high risk, low risk. Get it clear. Take prior approval from them that we are going to do trading on behalf of you. Okay, we are going to do, so that prior approval should be there. And then as the returns are generated, interest, dividend is received, profit loss is there, it should be properly accounted, and benefit should be transferred to the customer. Okay, if bank has done something wrong in managing PMS accounts, sometimes this happens that they go against the objectives, they take wrong decisions, they do some irregularities. In this case, a huge penalty or huge liability can be imposed on the bank. So we should carefully see whether such liability exists, and it should be properly accounted. Now, special purpose certificates. Listen, guys, auditor has to issue some certificates, but then in module also there's a mistake. We cannot do much about it. Just they are simply repeating that separate account should be there for own investments, and investments on behalf of the clients. Okay, so the same thing is repeated, but in short, yes, from time to time auditors are supposed to issue certificates, a special purpose certificate with respect to investments. In module they have not specified it. Okay, so we are going to stick to this right now. We are also not going to go in detail in those certificates. Audits and reviews. Half yearly review should be conducted. For the investments, whether investments were made as per the proper policy, whether proper procedure was followed, whether proper documents are maintained. Okay, is it as per RBI guidelines? Banks should undertake themselves, they should undertake half yearly reviews of the investment portfolio, and they should see these things. Okay, so every half year, every 6 months, this review should happen. Then the internal are required to separately conduct concurrent of treasury transactions, and as a result of their report should be placed before the CMD once every month. Bank should not forward copies of internal audit report to RBI. However, major irregularities observed in these reports and position of compliance thereto must be incorporated in half yearly review of the investment portfolio. What they are saying that, okay, first of all, bank should set up a committee staff for the half yearly review, which ensures that investment activities were proper as per the policies, procedures, and objectives are achieved. Then apart from that, internal audit should concurrently keep on auditing all the treasury transactions. That means, see, when investments are bought and sold, it's a treasury transaction. Every month report should be prepared and given to CMD. This report need not be sent to RBI. No, need not be sent to RBI. But if there are irregularities, it should be included in the half yearly reviews. Income from investment, simple. If something, the safest is income guaranteed by government. If income is guaranteed by government, generally investments are, when it comes to interest income, we follow accrual basis. In government guarantee also we follow accrual basis. But if they are not regularly paid, if there is a irregularity, they are not properly serviced means, are we getting installment on regular basis? If are we getting payments on regular basis? If we are not getting money on regular basis, then we will reverse accrued income and shift to cash basis, same like loan, no change. In case of other debenture interest, we follow accrual basis. As soon as it become NPI, we reverse accrued income and we shift to cash basis. When it comes to mutual funds, we go for cash basis. See, in case of mutual fund, NAV is computed on daily basis. NAV, net asset value is computed on daily basis, and as NAV increases, automatically returns are booked in books of accounts of bank. So no need to book separate returns. We need to pass entry when we get money. So dividend is booked when we get cash. When we get money, that time dividend is booked. Then dividend income from shares. Dividend income on shares. It should be booked when the right to receive dividend arises. Okay, it's very simple, straightforward, simple message. So in majority is accrual, it becomes NPI, reverse the earlier income, go for the cash basis. Mutual fund cash basis directly cash basis. And when it comes to shares, when right to receive dividend arises. Last thing, guys, and this is CRR SLR. whatever deposits bank get a lot of deposits. They get savings account, they get current account, they got fixed deposit, they got recurring deposit, they got cash certificates, whatever deposits they get, 5% should be maintained with RBI as CRR, and 25% should be maintained with the bank itself in the form of the securities gold bullion, with R cells. That is called SLR, statutory liquidity ratio. So we have CRR and we have SLR. It's very important for banks to comply with the both. If they don't comply with that, RBI is going to get strict action against them. As an auditor, we are supposed to verify whether CRR and SLR requirement is fulfilled or not. CRR is not very important, meaning we know that percentage of the percentage of the deposits should be maintained with the RBI, that is CRR. Okay. Regarding, so it's very simple. We need to know what is the level of the deposits, apply the percentage, we'll get the cash to reserve ratio. It is given in different act with respect to different banks, but all the banks are supposed to do that. Audit is supposed to review whether this balance is maintained and report accordingly. Not very important. Important is SLR, and that's huge, 25%. Statutory liquidity ratio. Now explain the meaning first. That every bank is supposed to maintain around 25% of the deposits they have received. Okay, deposit they have received in the bank in the form of liquid investments, cash, bonds, bullions, others. Okay, now we know the meaning. Let's go into the technicalities. Okay, so when we call deposits, the technical word is DTL, demand and time liabilities. These deposits are liabilities for the bank. So we have to the bank has to maintain 25% of deposits. The technical word is 25% of DTL, demand and time liabilities. Savings account is on demand, current account is on demand, fixed deposit is a time deposit, cash certificate is a time deposit, recurring deposit is a time deposit. Okay, so 25% of DTL. So what auditor is going to do? Auditor has to select 12 odd dates. There was an MCQ on this. 12 odd dates. Auditor has to select 12. Odd means random. 12 odd dates from 12 months. Statutory central auditor is supposed to randomly select 12 odd dates from 12 months. 12 odd dates from 12 months, not being Fridays. It should not be Friday. And MCQ was exactly on this point, not being Friday. Sir, why not being Friday? Let me explain. See, the complete functioning, complete CRR, SLR functioning of the bank, complete functioning is fortnight based. Fortnight means 14 days. 14 days means 2 weeks. It starts from Saturday on one Friday, 1 week is over. On next Friday, second week is over. So starts from Friday, one Friday, second Friday, 2 weeks are over, 14 days are over. That's called fortnight. Banks operate on fortnight basis and do reporting to RBI on fortnight basis. Now understand clearly what they have said. So, and this calendar is completely prepared by RBI and informed to the banks. Okay. Now, so in a year there will be around 104 fortnights. 100 no, not 104. Sorry, not 104 fortnights. 24 fortnights. Okay, 24 fortnights will be there. Now understand this. It's very easy, interesting. In fact, SLR that we have to maintain for current fortnight, banks have to maintain same level of SLR, statutory liquid ratio, SLR, for the complete fortnight, for the complete 14 days. Banks have to maintain same level of SLR for complete 14 days for the current fortnight, and it is based on level of the deposits, level of the DTL which is existing as on last Friday of second preceding fortnight. That means, see, we'll have to go to previous fortnight. That will be called as first preceding fortnight. Then we will have to go to before that. That will be called as second preceding fortnight. Second preceding fortnight. And then second preceding fortnight. And then have to go to last Friday. This is called second Friday. This is called last Friday. This is called reporting Friday. And we have to see the level of the deposit as on that date. Suppose that is 1000 crores. So 25% of 1000 crores, 250 crores should be maintained in SLR during current year fortnight. So one level of SLR should be maintained for the complete fortnight. For the complete fortnight. Okay. And that is based on level of deposits as on last Friday of second preceding fortnight. Why they did this? So that bank gets in between, there's some time lag. Bank get some time to do the trades and make proper investments available. So what's going to happen on this particular date? See, on this particular date, bank is going to know that okay, we have deposits of 1000 crore. They will get in between these 14 days to make all the trades, to make all the adjustments, to maintain SLR of 250 crores, and finally in the present fortnight they will have to maintain it. By this they get a time lag of 14 days in between. So let me freeze. Whatever SLR we maintain as on today in current fortnight is dependent on level of the deposit on last Friday of the second preceding fortnight. Okay, now we know the meaning of SLR. Now we know that we need to select 12 odd dates. Odd dates means random dates and not being Friday. Why not being Friday? Because bank as such keeps reporting. To RBI for the Fridays. So leave Fridays. We have to check whether proper SLR was maintained on these 12 dates. And we have to make report. Send to the top management and RBI. And inform them whether amount, whether DTL was computed properly. To find out how much SLR you need deposits, that is DTL, demand and time liabilities of the bank. You need DTL and you need to apply the percentage. You need DTL. So whether DTL was computed properly, and then whether corresponding liquid assets were maintained or not. In the report for these 12 dates, we need to clearly mention whether for all the 12 dates DTL was computed properly, what was the SLR requirement after applying 25%, and whether that much SLR is maintained or not. Now, how we are going to do audit? First, audit is supposed to go to RBI website, download the circular which deal with what should come in DTL, what should not come in DTL, read it carefully and have absolute clarity about inclusions and exclusions of DTL. We are going to discuss it later. Then, inform all the branch auditors. So we know that in PSUs they are separate branch. Inform all the branch auditors. Listen, branch auditor. We are going to tell them. See, we are the HO auditors. We have selected 12 odd dates. Okay, and now we know for these 12 odd dates they belong to which fortnight. We know that, and we know the corresponding Friday also. Corresponding Friday for which we need to get DTL. So we know exactly, we know position of HO on this for 12 odd dates. We know corresponding Fridays, and we know position of demand and time liabilities, deposits for HO. Now we are asking you branch auditors that these are the 12 odd dates, these are the corresponding Friday. You along with the staff generate the trial balance for those Fridays. trial balance for those Fridays. So generate the trial balance, audit it, check it, and send it to us so that we know what is the level of deposits, at branches for those corresponding Fridays. So all the branch auditors will be informed the 12 audits corresponding Fridays, and they will be instructed that you perform examination audit of these 12 trial balances and send it to head office. Many of the branches are going to remain unaudited. So communication will be sent to them that, okay, whoever is the branch in charge, branch manager, you generate the trial balance. These are 12 odd dates. They are the corresponding Fridays. You generate the trial balance for these Fridays, examine that, evaluate them, and send it to us. Then, now at head office, for 12 odd dates, we already know balances at head office. Then we have balances from the audited branches. Then we have returns from the unaudited branches. Now, auditor need to ensure that all the trial balance, head office trial balance, audited branches trial balance, unaudited branches trial balance, everything is collected, nothing is left out. It is complete, no branch is left out. Then ensure that proper addition is done. Okay. Then ensure that randomly that, okay, this trial balance matches with the communication from the branch auditor. This trial balance matches with communication from the unaudited branches. Ensure all the branches are covered. Ensure that they are correct. Randomly check they are correct. Ensure that it's properly added. And finally, you get balance. You get total deposits as on corresponding Fridays. You'll get total deposits. Now, while getting these deposits, you need to keep in mind these things. There was MCQ on this. There are some exclusions. Some credit balances appearing in trial balance of bank should not come in detail. What credit balances should not come? Let's understand. Reliance ka PM, RIL PM, okay, R for recoveries. If bank has recovered some money from the borrowers, if bank is recovering some money which was already written off as bad debt, which was not expected, so they are going to pass entry cash account debit to recovery from bad debts. It's a credit account. Okay, it was not expected. It's a credit account. Now this credit account is not a liability for bank. Bank is not supposed to give this money to anyone. It's not a liability. It should not be counted. If money is received out of recoveries from the bad debts, the credit balance in the account is not a liability. It is not payable to anyone. It should be excluded. It should not become part of DTL, demand and time liabilities. Then next is I for Indian currency. Now what is that? Suppose bank has received 10 lakh rupees from a importer. So bank pass entry cash account debit to money received for foreign payment 10 lakh rupees. It's a credit balance. Bank has made corresponding dollar payments to the foreign party, whoever sent the goods. So money is received from the importer and dollar payment is already done. But this knockoff credit balance is not yet adjusted because final exchange rate is not yet clear. It may take few days. So as on 31st March, as on some date, it may happen that bank is having a credit balance in account. The thing is that it is not yet adjusted because for final foreign exchange rate is not with the bank right now. It may be received in 1 or 2 days. This money is not liability. This is not payable to the customer back. We are not supposed to pay this money back to the importer. It's not a liability. It should not be included in DTL. It should be excluded. So account credit balance generated in recovery is not a liability. Don't take it in DTL. If you're getting Indian currency, there's a credit balance account. Again, it's not a liability. Don't take it in DTL. Link branches. What are link branches? See, link branches are very important. It's like very important communication point. Link branches represent branches of the bank in a particular region, they communicate with RBI, they communicate with other banks, they communicate with corporates. So link branches are connecting points of the region. Now what will happen? Listen. So there's a link branch in Mumbai and they take a lot of work from the corporates. Reliance says that I want to pay 10,000 crore dividend across India. So take this 10,000 crore. It gives to link branch of HDFC. They will receive the money. Cash account debit to Reliance dividend account credit 10,000 crore. Now, Reliance will issue HDFC checks across India. Everyone will start withdrawing money from the HDFC branches across India. And all the branches will keep paying the money. What is happening? Money is received in link branch and payment is done from other branches. So a credit balance is lying in the link branch and lot of unadjusted debit balances are lying in other branches. Now the payment of 9,900 crore is already done. There is a credit balance, unadjusted credit balance lying in the link branch, and in all other branches there is a debit balance which is lying. They need to get adjusted. But as you get information and clarity, we do this adjustment. It takes time. So if there is a credit balance in the link branch which is not yet adjusted, find out that it is not a liability. We are not supposed to pay it back to anyone. It should be excluded from DTL. RIL ka PM. Then paid up capital and reserves are not liability. Paid up capital, reserves, credit balance in PNL are not liabilities. It should not be included there. Loan from RBI, refinance from government entities like Exim, National Housing Bank, SIDBI, NABARD, etc. They are not regular deposits. Even they should not be covered. Margin money. Listen, many times bank keeps margin money. If you want loan from bank or some guarantee from bank says that give liquid cash to us. Many times bank keep margin money with them. This margin money is not a regular deposit that it should be paid anytime people want. It is not a regular deposit. It should not be covered in DTL. Credit balance generated in recovery, not in DTL. Credit balance generated by getting Indian currency, not come in DTL. Credit balance in link branches, unadjusted, should not come in DTL. Paid up capital reserves and shareholder account should not come in DTL. Margin money, again it's a credit balance. It is not a normal deposit, should not come in DTL. Now these things should come in DTL. New CBI order, Nostro account. If Indian bank has gone outside India, gone to foreign country, opened a foreign currency account with the foreign bank, lot of transactions will happen in this account. If this account has become negative, that means there is an overdraft. If the foreign bank account has become negative, that means there is an overdraft. That means we have taken loan from the foreign bank. If we have taken loan from the foreign bank, it will be counted in DTL. Now listen carefully. If you take loan from the Indian bank, it is not counted in DTL. If you take loan from the foreign bank, it is counted in DTL. Because when you take loan from Indian bank, it is called due to Indian banking system. And when you take loan from outside, it is called due to others. RBI says that if amount is payable to others, payable to foreign banks, it should be counted in demand and time liabilities. So they are saying in Nostro account, lot of foreign currency payment are made. Customers say that pay so much amount, we pay it. On the request of customers, on request of parties, we make a lot of foreign payments. In the process, that account can become negative. That means we have taken the borrowing. That means we have taken the loan. It should come in DTL. New CBI, C stand for net credit balance. If inter-branch adjustment account is a credit balance, if inter-branch adjustment account is a credit balance, net credit balance, it is shown in other liabilities. It is payable to someone in short term. It will come in DTL. This point is repetition. Borrowing from abroad. We have already discussed this in Nostro. Borrowing from abroad is considered due to others, it will be counted in DTL. Borrowing from banks in India is considered due to Indian banking system, it will not be counted. Interest, accrued interest. Accrued interest is also a liability. The entries are passed generally on the cutoff dates, month end, quarter end, year end. Now, these even that should be included in DTL. So even that is included in DTL. Now, once you do this inclusion exclusion, finally you will get DTL balances. For these 12 dates, you will get DTL balances. Apply 25%, get this is the SLR that should have been maintained. This is the SLR that should have been maintained. Now go and see on these 12 dates, what is the value of government bonds? What is the value of bullion gold? What is the cash we are having? Look at the liquid investments. If liquid investments are enough or more than what is required, that means SLR requirement is fulfilled. In reporting, we need to specify that okay, we did audit, we selected these 12 audits, the calculation of DTL was proper on these 12 audits, this was the requirement, this is the value. We need to talk about each and every date. We also need to specify how many branches were unaudited, because data from these branches is unaudited, clearly specify. Now, there's one special point, not in reporting. Recently, there's a change in the system. RBI has designed a new system for SLR and CRR reporting. It is ADF, Automated Data Flow. So, auditor should plan its examination of CRR and SLR keeping in mind ADF, Automated Data Flow system, which is made by the RBI. Guys, this is everything which we have studied. We started from here only. This much is more than sufficient when it comes to bank audit. Simply cover them. This is a chapter which needs to have an overview just before the exams.